Good morning. It is 9 a.m. on Wednesday, January 19th. This is Yahoo Finance Live. I'm Julie Hyman. That, my friends, is Brian Sozzi. Let's take a look at what's going on with the futures here this morning. A lot of focus continues to be on earnings. We've got Dow futures heading higher by about 1/3, S&P futures up 0.5%, Nasdaq futures up 0.7%. And despite the concern over higher bond yields, we are seeing some strength here this morning. Executives on earnings. We'll hear from the CEO of Procter Gamble and the chairman of Interactive Brokers on what will drive growth this year for those two companies. A blockbuster tech deal, the largest ever for Microsoft. We'll discuss how its agreement to buy Activision came together and what it means for the broader gaming industry. And as we continue our focus on big bank earnings, there's a new kid on the block. Lender Sofi just won a bank charter and its shares are surging. We'll dig into that a bit later in the show, up 17%. But we start this morning with the big traditional banks because we keep hearing from them. Bank of America and Morgan Stanley both out with their numbers, and Brian Chung continues to be on the case. And speaking of continuations, Brian Chung, we continue to see this theme of loan growth recovering to some degree on the one hand. On the other hand, fixed income trading, not so great.
Absolutely, and it is kind of fitting that the final day of the big bank earnings are one consumer bank and then one money center Wall Street bank that are reporting. But let's unpack the numbers that we had gotten before the opening bell this morning, starting off in Charlotte, North Carolina, with Bank of America, again, one of those big four banks. Revenue clocking in just short of the street's estimates at about $22 billion. Adjusted earnings per share on the bottom line of 82 cents. You could see that beat the street's estimates of 76 cents. The real story for Bank of America is in their traditional kind of consumer-facing business, right? How much do they make on loans? And we saw that net interest income, which is basically the interest collected on loans, came in at $11.4 billion. That's an 11% increase year over year. And then non-interest income, that's basically the fees collected on those same products, coming in at $10.7 billion. That's an 8% increase. Now, keep in mind, Bank of America is among those large banks that announced recently they'll be reducing overdraft fees and eliminating non-sufficient funds fees. So pay attention to that non-interest income in the quarters to come. The CFO, Alistair Borthwick, telling me on a call this morning that he expects any loss in income there to be offset eventually by savings on expenses because a lot of call center issues actually concern those types of fees. But Bank of America getting a nice boost in pre-market trading, up almost 4%. But let's shift gears to Morgan Stanley down in Wall Street. Their revenue coming in $14.5 billion, beating the street's top line estimates, and they beat on the bottom line as well. Adjusted earnings per share, adjusting for that big Eaton Vance acquisition, coming in at $2.08, beating the street's estimates of $1.94. Now, the big story for them, as you mentioned, Julie, fixed income net revenues down 31% from a year ago. Equity underwriting took a step down. That's because IPOs and SPACs simply cooled off during the quarter. We did see financial advisory revenues up thanks to M&A action. And these stories are all the same as Goldman Sachs. So what really differentiated Morgan Stanley, which is a big reason why you're seeing a pop in the pre-market trading up over 5%, is because comp and benefits up only 4% compared to Goldman 31% year over year. So it seemed like Morgan Stanley just had a better handling of expenses in that quarter, which is a big reason why Goldman Sachs sold off as much as 8% yesterday, but Morgan Stanley could get a bump this morning. However, still important to know, Morgan Stanley has got a higher efficiency ratio than its peers at around 66%, so it could be some more work to do. We'll see if that earnings call happening right now offers a little bit more color, guys.
Brian, bank earnings season is officially over. What's one of your hottest takeaways?
Yeah, I was going to say, you guys are done with me after 3 consecutive business days of these bank earnings, but I think the big story, that pendulum is shifting from the big money center Wall Street banks towards the consumer-facing banks. Wells Fargo, Bank of America, those are the banks that stood out during this earnings season. It's not because their loan pipeline was already showing growth or that their net interest income was already going to the moon, but in a rising rate environment, that's going to take some steam out of risk assets, which means that those trading desks over at the likes of Goldman Sachs, Morgan Stanley, JP Morgan Chase will not be the main source of revenue for those banks anymore. Really, where you're going to get a lot of that boost is in the heightening yield curve that allows these types of banks that are underwriting loans to get a little bit more interest income. That's going to be a big story for, again, those big consumer banks and also the super regionals and the regional banks that we don't cover as much as well. They are likely going to be winners from that steeper yield curve, which means that that pendulum that we've seen over the last 2 years of maybe the money center banks were really best positioned through that pandemic, starting to change around now.
Don't worry, Brian. We're never done with you. After all, there's a Fed meeting next week. Oof.
Yeah, that's it.
Don't you worry.
You guys can't get rid of me.
All right. Thanks so much, Brian. Appreciate it. Also on earnings watch this morning is Mr. Brian Sozzi, and that's because we heard from Procter Gamble, which raised its sales forecast after coming in with numbers that beat estimates. And Sozzi, the company's raising prices, right?
Yeah, Julie, we should have kept Brian Chung here. We talked about inflation and how it's impacting P&G and what the Fed might do. But look, I talked to CEO John Moeller. The new CEO of P&G officially took over on November 1st, known inside the company as Mr. P&G. I talked to him ahead of the show on what he is seeing in terms of inflation, really after a pretty strong quarter for the company.
We've announced price increases in the majority, I think 9 out of 10 categories. Some of those price increases have not yet come to the shelf. They haven't yet come to market. So we're going to work through that before we take the next step.
Do you see any signs we are nearing peak inflation, just from your standpoint in your business?
There are some commodities that are starting to modestly roll over, which is encouraging. There is capacity being added to some of the input supply chains, which is encouraging. On the other hand, in markets like labor and transportation, I don't expect any near-term decreases.
Julie, what is interesting too, just looking at P&G's results, sales rose faster than volumes in all the company's business segments, despite really several rounds of price increases from P&G. But the company did warn that they will see $2.3 billion in commodity cost headwinds in its current fiscal year. This is the second fiscal quarter for P&G. That is up from a $2.1 billion estimate just 3 months ago when Procter Gamble reported. So the inflationary environment remains pretty hot. P&G will likely push through some more price increases soon. But by and large, Mueller is telling us that he's not seeing consumers trade down to those private label products.
Very interesting stuff. And I know they're also coming out with some innovations in existing cleaning products. You were talking to us about that in the break. So we'll talk more about that a bit later, and we'll hear more of your interview with John Moeller of Procter & Gamble. Coming up next, though, it's been about a year, right, since we first started watching these guys, AMC and GameStop, in a broader way and saw the big meme stock craze really hit. We're going to talk about what retail trading could look like for this year, as well as numbers from Interactive Brokers. We'll talk to founder and chairman Thomas Petterfy next.
Interactive Brokers saw a 56% increase in customer accounts in the fourth quarter as the rise in markets lured in investors. Investors are liking the numbers, with shares up about 2% in the pre-market here. Joining us now is Interactive Brokers founder and chairman Thomas Peterffy. Thomas, always nice to see you. So big quarter of growth in customer accounts, like I just mentioned. But on the call last night, you guys did warn that that is likely to slow this year to about 30% to 40%. Why would that be the case?
Well, first of all, it's 56% for the year, right? So the 56% is an annualized rate. So in 2021, we added over 600,000 customers. But what's more important is that we have done over 2.5 million trades on the average day. It is difficult to keep the high growth rate on new customers as the number of old customers grow, right? I mean, you know, when you have 1 million customers, it's easy to do 56% is 560,000 customers. But when you have 2 million customers, you would have to do a million plus in order to remain at 56%. So that's you know, as you grow, it's very difficult to keep a high growth rate.
And Thomas, certainly want to dig more into the quarter, but I was on the call yesterday, and your comments on the Federal Reserve really caught my attention. You noted that you are extremely worried about higher interest rates this year. What is driving that worry, and what are higher interest rates likely to mean for the average investor?
Well, the reason I'm worried about high interest rates is that, you know, the Fed is talking about raising rates to 1% or maybe even 2%. When inflation is 7%, 1 or 2% doesn't mean anything. So if they really wanted to stop inflation, they would have to raise rates to 4, 5, 6%, right? But at that rate, the debt service on the $29.3 trillion of debt would become so incredibly expensive that they, at 3.25, for example, it would be $1 trillion, and that would just add new deficit spending. And new deficit spending, all that does, it raises the rate of inflation because it puts more money into circulation. So I think they are in a box. They can't raise rates much above 1 or 2%, and inflation can stay up there for a long time, and people will get used to that, and it will become endemic. So that's the reason for my fears. Now, what that means for customers is that customers will probably be best off taking unleveraged positions, and you know, maybe come to us, because at Interactive Brokers, our margin rates are only about 1% over Fed fund rates. So that is the reason why our margin rates, I mean, the amount of margin we have outstanding, grown to $54 billion in 2021, and that's a 40% growth relative to the preceding year.
Hey, Thomas, it's Julie. I wanted to get you to expand on that margin loan growth that you saw, that you just alluded to almost $55 billion. So as rates go up, do you not see a decline in demand for margin loans because it's going to get more expensive for customers to do so? Does that also take some liquidity out of the market?
I do not expect that to happen as long as inflation also goes up, right? So as long as real interest rates are negative, as they are today, they are negative 6% or negative 7%. I don't see that. That's what matters. The absolute rates don't matter.
And also, it makes me think about the fact that as I mentioned a few minutes ago, that we're about a year out from the sort of meme stock surge, right? And retail investors really getting more involved in the market. As we see rates start to go up this year, how do you think that whole trend is going to evolve?
Well, I do hope that investors will refocus on fundamental values, because this meme stock idea, I mean, it's fun, but it is not sustainable. So I think a lot of people will lose a lot of money on these meme stocks, and that's I mean, it's not good for the market, and it's not good for the people. So I welcome the idea of meme stocks coming down a bit in value.
Thomas, are you still bullish on the outlook for the options market this year?
Definitely. So options markets are increasing. The trading volume is increasing tremendously. In the last few months, the markets have been handling 40 million contracts a day. Interactive brokers customers represent 10% of that, namely 4 million contracts a day. I mean, this is an unheard of daily volume, and it's just absolutely amazing. So most people are beginning to focus now on option combinations, like you buy a certain strike, you sell a strike higher on calls if you're bullish, or do the reverse if you're bearish on with puts. And so while you take a $50 stock, if you want to buy it on margin, and margin is 50%, say, you still have to put up $25,000. Now, if you want to buy a call option on a $50 stock, you can do that for $200 or $300 or $400. So it's a very big difference. And if you are using combinations such as a bull spread, where you buy a lower strike and sell a higher price, higher strike call, then you have to put up a small fraction of that, and so that gives you a tremendous ability to build specific risk profile positions, and it's a lot of fun. I always thought that. That's why I spend most of my life trying to computerize the options markets. And now that we are there, I think it's tremendous.
Yeah, that worked out well in the end. And Thomas, finally, I want to ask you about crypto too, because it seems like you've sort of had a come to Jesus moment when it comes to crypto, or at least not as antagonistic as you once were. It seems like you're willing to sort of throw a little bit of money, personal money at this, and also, of course, allow crypto trading on the platform. What changed your mind? What was sort of the critical mass or the turning point for that? Mm-hmm.
Yeah. So this issue is being misunderstood. I was never opposed to crypto. I was opposed to the Chicago Mercantile Exchange listing futures on cryptos, but I wasn't even opposed to that. I was opposed to the margin that they wanted to impose on crypto futures positions, because now we have a little bit more history, but it's still an extremely volatile product, right? So Bitcoin right now is, say, $42,000. But there is nothing really to prevent that $42,000 price to go to, say, to double overnight, right? So that means that unless they impose 100% margin, which they do not, I don't exactly know what the margin is, but I expect it would be about something like 30 or 40% of the volume. The problem is that it is the broker that holds the bag when customers take on positions where the product goes against them, and the customer cannot pay the losses. Now, the issue is that there are smaller brokers in this game who have very little capital, and they are quite prepared to, they take out their earnings out every month or every quarter out of the company, and they are quite prepared to go bankrupt if some crazy things like that happens. But you know, larger brokers like ourselves are in a more difficult situation because, you know, we have a lot of capital in the business, and we cannot afford to have a lot of customers default on us.
All right, we'll leave it there. Always great to spend some time with you. Interactive Brokers founder and chairman Thomas Peterffy. Good to see you. We'll talk to you soon. All right, Sony shares just got slammed in the wake of Microsoft announcing it would buy Activision Blizzard. More on this hot mover coming up.
Well, we are still mulling over and digesting the huge deal announced yesterday, Microsoft to buy Activision Blizzard for almost $68 billion. That price, by the way, once you include debt, goes up to about $75 billion. Microsoft's biggest acquisition ever. And a lot of sort of TikToks this morning, Brian Sazi, on how the deal went down. Of course, Activision has been in a weakened position because of the various investigations it's had to undergo internally into sexual harassment, into gender pay disparity. The CEO, Bobby Kotick, has been under a lot of scrutiny. And as Bloomberg and the Wall Street Journal tell it this morning, Phil Spencer over at Microsoft, who heads up gaming there, had sort of been in talks with Kotick for a while. They'd sort of gone back and forth, but Activision had also approached other companies, including Meta, the parent of Facebook, didn't get any takers there. And then eventually Microsoft is the one that prevailed.
You still get the sense, Julie, this is a reluctant seller in Activision, Blizzard, and Bobby Kotick. I mean, he's been one of the biggest power brokers, really, in entertainment, going on 10 to 15 years. But it was very interesting to see what Bloomberg reported in that profile, that behind-the-scenes look at the deal, where Kodak actually reportedly reached out to Facebook/Meta about making a deal with them. And it is interesting that Facebook/Meta would rebuff Activision Blizzard. Sure, they have cultural concerns here, but this is probably one of the most powerful companies in gaming. 400 million monthly active users. I mean, that is a significant audience to bolt on to the initiatives in the metaverse that in many respects Facebook is leading.
Yeah, but maybe they just didn't felt like it was too big, felt like it didn't make strategic sense. That
Or
would have been the
regulatory.
biggest acquisition by.
Or regulatory.
So,
Let's keep in mind. I mean, it's going to be hard
yeah.
for Facebook to get through any acquisition.
Yes, that is a great point also. And so now this morning, I think gaming folks in that world are sort of taking a look at this different landscape. This combined company going to be the third largest by revenue in the gaming industry, behind Tencent and behind, now I'm forgetting the other one that they're behind. You remember?
Nintendo?
Sony, which brings us to how Sony shares have been trading. There's some concerns here, it seems, about exclusivity, right? With the PlayStation, that there will be, it seems like in the initial comments here, Microsoft has said it will come out with more Xbox exclusives, its own gaming platform. So it wouldn't shut PlayStation out entirely by any means, but it seems like that Sony's falling on these concerns that maybe it's going to lose some of the piece of the pie.
Yeah, and if you're Sony, you have to think now, what is your play? I mean, do you have, with the significant capital at your disposal and with the strength really that has gone back well over 10 years in the PlayStation, do you go out there and make a play for an Electronic Arts? What is your play? Do you try to go out there and make a play for Take-Two before it closes the deal on Zynga? I'm sure these are just some of the considerations Sony is now having inside its own boardroom.
I'm sure it is. So anyway, we'll continue to watch these stocks and see what happens. We're going to talk to Brent Thill over at Jefferies a little bit later on. He covers Microsoft, to talk about all of that, and also the perhaps cultural challenge of Microsoft having to absorb Activision with its various issues. Some of the other stocks that we're watching right now, I want to talk about Sofi also, because the stock is just having an incredible move this morning. It's up by nearly 20%. And the Office of the Comptroller of the Currency granting it a U.S. banking charter. This is after it bought Golden Pacific Bank as a way to get that charter for the combined company. I mean, you've been following this one for quite a while, Saz, and it's just fascinating, the growth that Sofi has seen in terms of its evolution from a lender to now being a more fully fledged fintech and now bank.
No, we've CEO over at Sofi, Anthony Noto, is one of the first people that actually came onto our network when we launched. So we've been following his story very closely. When he came in here to essentially save Sofi, at the time when he came, they were dealing with cultural problems of their own. And by and large, this has been a complete transformation of Sofi under CEO Anthony Noto, a host of new products under him. You have the IPO that occurred that has come off by and large pretty well. And now this is the final piece to the puzzle, I would argue here, and you're seeing the stock go up really significantly, the top trending ticker right now on the Yahoo Finance platform. This will help Sofi officially compete with some of the biggest banks in this country. They can help lend money more competitively and gain more business. And once they get those customers in there with these deposits, perhaps upsell them to other services it offers.
Yeah, and just to put the move today in perspective, the stock has been down as of late, right? We've been seeing a pretty big tumble for the shares. And I was just checking, when you see a move like this, you have to wonder if there's a short squeeze going on. About 11% of the shares as a percentage of float are sold short. So that could be one of the reasons that we are seeing that big boost in those Sofi shares today. There you're looking at the futures, and we got the opening bell ringing right now. And there indeed is the opening bell on this Wednesday morning, with all three major averages set to open in the green. A little bit better of a tenor for some of the bank earnings today, at least in the way that they're trading. And of course, we continue to watch Procter Gamble and some of the other earnings companies as well. I just want to mention one more mover that I'm watching, and that is United Health Group. the biggest health insurer in the United States. The company coming out with earnings that not only beat the average estimate, they beat the highest estimate out there. Adjusted earnings of $4.48 a share. Revenue also coming in ahead of estimates, and the company reaffirming its outlook for 2022. Remember, the company also owns Optum, which is a health services business, pharmacy management business as well. And it has just been contributing increasingly to United Health's overall number as well. One more thing to mention as well, when you're talking about the health insurers, you have to talk about the so-called medical loss ratio. That's a percentage of premiums that get paid out to services. Medical loss ratio, 83.7% for the company. And the company also, by the way, confirming its projections for Medicare enrollment for the year ahead. That's particularly significant because Humana, remember, earlier this month came out and cut its projections for Medicare enrollment, and that stock tumbled at the time. So United Health basically communicating here that it is not experiencing those same kind of challenges. So we'll watch that stock today. And we're also watching Mr. Jared Blickery, who's with us now to talk to us about what is going on this morning in the broader markets. Hi, Jared. Oh, Jared, I think you're muted.
There we go. Hello, Julie. I'm just watching the S&P 500 futures contract on the Wi-Fi Interactive. You can see this is a 3-month chart, and basically the market has gone sideways. We have kind of a sideways uptrend right here, but nominal at best. What I am noticing this morning is a potential hammer candle, and that's a technical configuration in the chart, the candlestick chart that we're looking at here. We've had some of these before, kind of similar situation in the Nasdaq, but is it going to last? We had almost a 90% down day yesterday in the markets, and that's when 90% or more of the contracts, or excuse me, of the listings in a particular index, this would be the S&P 500, were down for the day. So a lot of times you get a relief rally the next day, but is it going to last? We're going to have to see. Here's the sector action for today. We have materials, that's up the most, almost in line with consumer discretionary, tech, and energy. All those are up about 0.6% or more to the downside. We have industrials, utilities, financials rounding out the bottom. And since we have those Bank of America earnings this morning, let's take a look at what that stock is doing. You can see it's up about 4% right now, really getting their costs in order, unlike some of the other firms have been able to do, like Goldman Sachs and JP Morgan. Here you can see they're up almost 50% over the trailing year. And let's get a check of Morgan Stanley as well. We got that stock up about 30% for the year, trading sideways over the last few months, but financials have really been on the move, and Morgan Stanley has just kind of been trading in a range. So take that with a grain of salt. Want to get a check of the travel sector because we are seeing a mixed picture. We have Carnival Cruise Lines and Norwegian, those are down, but we do have some signs of life in Southwest Airlines and Delta. Those are up about 1/3%. Elsewhere, where are we seeing some movement? Yesterday, we saw a little bit of a mixed picture in software, and today we're seeing finally a bounce back. Now, this is a sector that's been beaten down over the last few months. You can see only Cisco in the red, that's down 0.2%. But interestingly, Cisco and IBM, those are two stalwart technical stocks that have actually been doing well in this. So interesting to see that we're seeing a little bit of love in some of those beaten down stocks. But again, will it last? That's that's the critical question. Turnaround Tuesday, we need to know that answer by 10:30 a.m.
All right. We will be watching to see if we get that answer by that time. Of course, we still have to get earnings from all these companies as well, so we'll see how they withstand those numbers. Jared, thank you. Just wanted to also get a quick check on the big earnings stories of the morning. There we are seeing green and then some. Bank of America, Morgan Stanley, Procter Gamble, all trading higher. What's interesting is we see some of the same challenges for the banks in particular as we saw with their competitors, where their competitors traded down. These guys are trading higher, maybe because they got beat up at that point as well. But we'll keep watching them to see how this proceeds through the session. And at 10:30 also. Coming up next, we're going to talk more about the bigger picture for the markets, where you should be allocating your money. PIMCO portfolio manager Aaron Brown will be with us on the other side of the break. been a rockier start to 2022, as we have seen tech stocks in particular, software stocks in particular, as our Jared Blickery was just outlining, on the decline. Oil prices have been on the rise. So what does this tell us, if anything, about how the rest of the year is going to go? Aaron Brown is with us now, PIMCO portfolio manager. And Aaron, you wrote in a recent note about the so-called fat tail risks that are out there. In other words, that there are some possibilities of pretty divergent outcomes for markets, for the economy this year. You know, given that we've already come through a couple of years where there were pretty divergent possible outcomes, how do you game those out, sort of post the lessons of 2020 and 2021?
So first, I think it's important as a starting point to look at what the growth backdrop is and what your base case is likely to be. And we're still in an environment where growth is still going to be pretty good. And while we're certainly decelerating from a exceptionally strong backdrop that we experienced last year, the rest of 2022 from a growth perspective is still going to be very supportive for stocks. That said, as we're entering into an environment with obviously higher inflation, where the Fed is going to start to really, raise rates and start to remove a lot of the accommodation that's been in the market, that does pose these left tail risks that we haven't experienced, certainly over the last couple of years. And so I think it's going to be much more of a dynamic trading environment going forward in 2022 than what we've seen, certainly over the last 18 to 24 months. And so for that, I think it means investors have to be more active, a little bit more disciplined in terms of, taking their profits and also cutting losses in a much more active manner.
Aaron, when you say dynamic, do you mean we're at the risk of seeing some more corrections in the markets this year as the Fed tries to get out in front of inflation?
Yes, I definitely think that we're going to experience more volatility in 2022 than what we've seen, certainly over the last year, but even going back over the last decade. We started to see in 2021 volatility creep up. I think we're going to see volatility creep up even further in 2022. And, as we reach these sort of transition points in the market, and the biggest transition is going to be the Fed starting to hike rates, that typically means that you're going to have bigger corrections throughout the sort of path of, what I think is where we're going to end the year higher in terms of markets, but we're going to have bigger corrections along the way.
And given all of that, you are sort of looking at longer term trends that maybe are going to be somewhat agnostic as all of that's going on. They might trade lower along with it, but eventually it seems like the outlook would be stronger for them. I'm thinking about things you mentioned in your note, like digitization, sustainability. I know you're looking at semiconductor makers as we continue to have a sort of struggle with the shortage in the industry, but also a lot of demand from industries like automakers.
That's actually entirely correct. I mean, when you think about what these secular trends are going to be that are going to drive the economy over the next 5-10 years, I think that increasing semiconductor usage in everything is going to increase. So if you just think about your home, we have chips in your cars now, you have chips in your refrigerator, you have chips in your, obviously your mobile devices. And I think that usage of semiconductor chips is likely to increase over the next 5 to 10 years. And not only is the number of chips going to increase, but the sophistication of those chips is also going to increase. And it's a pretty limited market in terms of those semiconductor companies that are able to produce the sophistication of the chips that are going to be needed for the secular horizon. And so I think that that's a trend that is here to stay. And it really does tie into the automation trend and the digitization trend as well. So I think that, taking a little bit of a longer term horizon in terms of your investment portfolio, particularly in an environment where we think there's going to be more volatility, is really the right move for investors.
Aaron, where else can you hide out? If one is concerned about what might happen to the markets because we get 3 rate increases, 4 rate increases, where else can you go?
I also think that really looking at increasing ESG in the portfolio is also another secular trend that's here to stay. And so if you think about, industrial manufacturers, if you think about, broader, companies, they're all adopting more ESG friendly initiatives. So I think that companies that either manufacture in an ESG friendly way or that are really supplying ESG, raw materials, I think are also going to be sort of a secular horizon. I also think that in an environment where we are continuing to experience volatility likely due to inflation, I think taking some inflation protection in the portfolio through commodity oriented stocks, I also think makes sense in this environment. And particularly those stocks like copper that both thread the needle between ESG friendly as well as commodity exposure, I think are also good investments for 2022.
We'll be watching all of them. Erin, good to catch up with you. Erin Brown is a portfolio manager at PIMCO. Thanks. I want to bring you the stat of the day. Now, we were just talking about corrections and whatnot. Goldman Sachs' shares are knocking on the door of a bear market. They are down 16% from their high that they reached back on November 2nd, which was a record high, by the way. So the shares now down 16%. And of course, that was pushed along by a 6.5% drop in response to the company's earnings yesterday. Well, we're going to take a quick break. When we come back, we will hear more of Saz's interview with the CEO of Procter Gamble as the shares rise almost 3.5% in response to earnings. We'll be right back.
Consumer products giant Procter & Gamble is out better than expected quarterly earnings, but the company is warning again about pesky inflationary pressures. I spoke with P&G's new CEO, John Moeller, about the quarter and the company's outlook.
It's interesting. If you look at our business prior to the pandemic, we were growing about 6%, very strong growth on the top line. Our portfolio and strategy worked for us during the pandemic. We maintained essentially that same level of growth. And as you saw in the quarter that we just completed, another 6% growth quarter. So our products are increasingly relevant to consumers across the world. They provide protection from a healthcare standpoint, hygiene for the home, and really help my my family in a time of need. And we're seeing that reflected in demand across categories.
What behaviors amongst consumers are you seeing really sticky? Since the last time we spoke, despite Omicron, people have become more mobile, but what have you seen really stick?
Still spending more time at home. I think all of us are, and therefore, more clothes to be cleaned, more dishes to be washed, more meals at home with family, need those paper towels. I would say the other sticky change has been a pretty significant shift to products of quality that I know and trust, again, to address my family's needs in this difficult time. The data point there is what's happened with private label shares, both in the US and in Europe. They tend to be the lower priced offerings in the category. And market shares are down and continue to be down past 3, 6, 12 months, both in the US and in Europe.
Are you surprised to see that P&G and a lot of your rivals have pushed through price increases? You would think consumers would be trading down a bit, no?
If I just reflect on our business, we've never been in a better position in terms of the superiority of our offerings, the efficacy of those products to do the job they're designed to do at a time of high need. So you put all that together and price elasticities decline. We're seeing it's still very, very early, and this is a bumpy road, so there will be bumps on this road. But to date, our price elasticities are 20 to 30% lower than we were expecting. And as I indicated, typically at this point in the cycle, there's a shift down to private label, which we're not yet seeing. So we're going to stay on the front foot with innovation, continuing to improve products, packages, communication, our retail execution. And through that, actually, despite some price increases, improving value for consumers.
Within the earnings, John, you did raise your outlook for commodity inflation to, I believe, about 2.3 billion from 2.1 billion or so. But given the success you're having pushing through price increases, do you plan to push through more?
We've announced price increases in the majority, I think 9 out of 10 categories. Some of those price increases have not yet come to the shelf. They haven't yet come to market. So we're going to work through that before we take the next step.
Do you see any signs we are nearing peak inflation, just from your standpoint in your business?
There are some commodities that are starting to modestly roll over, which is encouraging. There is capacity being added to some of the input supply chains, which is encouraging. On the other hand, in markets like labor and transportation, I don't expect any near-term decreases.
There are, I can tell you really for the past few weeks, John, my Twitter feed has been dominated with photos on Twitter of empty shelves in grocery stores. Take us through what you're seeing in your manufacturing plants. Are you able to get enough product to the market right now?
Our supply organization is doing a tremendous job to keep products on shelf. If you look at the US, I believe we're at 94% of demand. So there's still work to do. And obviously that differs by category, but we're doing everything we can to bring products to shelf and keep supply in stock to serve consumers.
Are there certain categories where you can't keep them in stock?
It varies over time. When we have, obviously this will be obvious, but when there are significant surges in demand in any category versus the norm, we struggle. Now we're working on a number of focus areas to strengthen the execution of our strategy. One of those is supply and anticipating a wider variance in demand. So we'll get there, but we do have work to do.
Have you seen any worker absenteeism in the plants because of the pandemic?
We have a very dedicated group of colleagues that are dedicated to the business, they're dedicated to each other, they're dedicated to making a difference in the lives of consumers around the world. Of course, in the middle of large COVID outbreaks in different parts of the world, there are quarantine needs. My children aren't at school and need to be cared for. I have a family member who needs to be tended to. I have difficulty securing transportation. All of those affect daily availability of people to do their jobs, but they're working through it in a very, very impressive and committed way.
You know, one of the benefits, you've touched every part of your organization, COO, CFO, and now CEO. What are you seeing in terms of global growth? The consensus appears to be things will slow down this year, but from your seat, how do you see it?
Strong, at least as relates to our categories. I don't have insight into the entire economy or other categories, but we've seen no slowdown in demand. We did see a little slowdown in the fourth quarter in China, where our growth, top line growth, was flat versus a year ago, but still 12% on a 2-year stacked basis, and still over 6% globally, with our second largest market essentially flat versus a year ago. And we don't look at the market as something that's handed to us. I mean, obviously, the world and what's going on does affect market growth, but we also affect market growth. And that's fundamental to our strategy to grow markets as a way to sustainably grow our business and grow share.
Lastly, John, you're now the top guy calling the shots. And in recent weeks, P&G has made some acquisitions in the prestige beauty category. Is one of the reads that under your leadership, you're going to be a little more aggressive in growing out growth categories like this?
These are projects we've been working on for some time. The first step was consolidating our portfolio into daily use categories where performance drives brand choice. And we've been saying for some time that we're committed to win in each of the 10 categories that we've chosen to compete in. And there are a couple categories where we would benefit from a broader portfolio in that winning endeavor. And one of those is beauty and skincare. These are projects we've been working on for some time, so I wouldn't take it in any way as a signal of change related to leadership. It's just a fundamental part of our strategy.
And that was P&G's new CEO, John Moeller, on his better than expected quarterly results. All right, coming up, Sleepy Kohl's is firing back at its new activist investor. We'll have a hot take on this battle straight ahead.
Brian Sozzi remains on Kohl's watch as the company is under activist pressure once again. In fact, you spoke to the activist yesterday, Soz. What did he have to say? What did we learn?
Well, first, yesterday, late in the evening, Julie, Kohl's rolling into the muck, which is unlike them when it comes to these activist investors attacking the company. Normally, you have to wonder if the executive folks over at Kohl's have a pulse. But Kohl's saying this in a press release, quote, "We have continued to engage with McClaren since the settlement, which was in April of last year, and are disappointed with the path they have taken, an unfounded speculation in their announcement and letter." Kohl's going on to say in its press release, highlighting their performance over the past year, their stock price, and the institutional knowledge of their board of directors. One source familiar with this situation told me last night that this press release was embarrassing. Now, I did talk to McClellan's managing partner, Jonathan Duskin, who is leading point on the company's new activist push against Kohl's. Here's what he told me.
I've seen it a couple different ways. Obviously, we've done this a long time, and sometimes you have a capable leader that just doesn't have a good supporting cast or doesn't have the right direction from the board, doesn't have the right initiatives, doesn't have the right incentive structure, and doesn't have the right counsel and guidance. You know, retail is it's not, we're not splitting atoms here, but it's complicated, and every initiative seems to have two sides. And I think I think the quickest way for shareholders to get the greatest return is if we're able to work with Michelle and really put her on the right path to success. But there's a question mark.
And who Duskin is referring there, of course, is to Kohl's CEO, Michelle Gass. Gass has been the CEO of Kohl's since May 2018. Stock price down about 20% under her watch. And hence you see an activist like Duskin come into the picture. Engine Capital also now involved. So you have two activists and firms firing away on the company, begging them essentially to explore strategic alternatives for the entire business or split off their e-commerce operations, or in Duskin's case, look for perhaps to create a REIT, a real estate investment trust, for some real estate holdings that value, at least by his math, about $8 billion. But this is a fascinating campaign, Julie. It's going to come to a head soon. You cannot continue to be attacked by activists at a public company and not do anything about it. And that essentially is what has happened over Kohl's since Duskin settled with the company on April 13th last year. Really, the only thing Kohl's has done is come out here with a $2 billion share repurchase program, has not reached out to independent financial advisors to explore strategic alternatives. It's going to have to do something. Something's going to happen soon.
All right, well, we'll count on you to keep watching and see what that something may be. The suspense. Oh, the suspense. All right, thanks so much, Saz. All right, we are going to take a quick break. Before we do, we are seeing stocks hang on to some gains here early on this Wednesday morning. We've got the Nasdaq leading those gains. It's up by 0.9%. And coming up in the next hour, more on the big gaming deal that everyone's talking about. Of course, Microsoft buying Activision. We'll get Jefferies' Brett Thill and his take in a moment.
Welcome back to Yahoo Finance Live on this Wednesday morning. I'm Brian Sozzi alongside Julie Hyman. There's been another big earnings day for the markets with results out of Bank of America, Morgan Stanley, and Procter Gamble. And the markets are taking the generally solid results in stride after Tuesday's market drubbing. You're seeing all the major indices so far in the green in the session, which is certainly welcome after yesterday's beatdown. Now, here are a few other things we're watching for you at this moment. Cleaning up, P&G is out with an earnings beat this morning as sales rose for products like Crest whitening strips and Tide laundry detergent. P&G CEO John Mueller told me consumers aren't balking at recent inflation-driven price increases. And scoring a big win, shares of fintech Sofi are surging after the company received approval to become a bank holding company. The stock is the #1 trending ticker right now on the Yahoo Finance platform. And it's Power Hour here on Yahoo Finance. Zoom CFO Kelly Stuckelberg stops by as the company prepares to hold its first Work Transformation Summit. We'll also talk with Sonder co-founder Francis Davidson as the lodging outfit debuts on public markets today. But first, Julie, over to you on the Wi-Fi Interactive.
Yeah, I'm going to take a look at what's going on in markets here this morning as we see stocks pushing higher. I wanted to start with bond yields because we really saw equities take their cue from yields yesterday when we saw them pushing up. And the 10-year yield is still at 1.85%, so it's still an elevated level given, vis-a-vis where we have seen it recently, but it's down a basis point today. So I guess direction matters, and that little bit of a drop or relief in yields is allowing a little bit of a gain in stocks here today. There is one thing, though, that was in place yesterday that is still in place today, and that is oil prices continue to push higher. So not seeing any relief on that front, on the oil front here this morning. Here you see crude oil futures, WTI up above almost at $87 a barrel, in fact, up almost 1.5% on the session. Let's break it down within equities and see the patterns that we are watching. Microsoft was recovering some of yesterday's losses after the announcement that it was buying Activision. The shares are up 3.5%, and you've got pretty broad strength coming in technology here today. In particular, as we talked about earlier with our Jared Blickery, some of that strength is coming within software in particular. And if you look at the equal weight picture, even more notable, the bounce back that we are seeing in technology. And of course, this is after we have seen some pretty weak performance thus far in 2022 from this group. Here's the year-to-date look for those software companies. Also wanted to look at the sectors and what we are seeing in today's session, switching back on over to an intraday look. Even though oil prices are higher, energy stocks are pulling back. And even though bank stocks, including Bank of America and Morgan Stanley, are higher in the wake of their numbers, the XLF, the financial ETF, is trading lower. But we've got tech leading the pack here with the XLK up by 1.2%. Very quick look at these banks here this morning. Bank of America up 2%, Morgan Stanley up about the same, but the rest of the banks under pressure, and that's part of the reason why we're seeing that drop in the XLF. Brian?
An expert market tour as always. Thanks, Julie. Now, Microsoft's $68.7 billion deal for Activision Blizzard is still reverberating throughout markets, as seen in shares of Sony falling off a cliff today. Let's stay on the deal with Jefferies analyst Brent Thill, who covers Microsoft. Brent, nice to see you. Now that we've had some time to digest this really shocking deal in many respects from Microsoft, do you think it's a home run for the company?
I think it's going to be a good deal. I'm not just going to say it's a home run. Obviously, it's their largest deal, and M&A can go in a tailspin quick. But ultimately, when you think about the 25 to 30 plus million people on Game Pass, and they want to get to billions of users on their system. And these can be casual users on a mobile device. They can be hardcore users. You could be entering the metaverse in a new experience. And I think Microsoft, has always been forward thinking in terms of the markets that they're in and is looking forward. The beauty of Activision is a lot of their content is own content. They have already close to 40% of the revenue on mobile. They have some franchises that need a little bit of a jump in terms of excitement that Microsoft can probably put into it. And also, obviously, you had massive cultural issues at Activision when we've never seen 20% of a company sign a petition to remove a CEO. That's unheard of in our industry. So there are a number of factors that we think Microsoft can help with. It's over a year of cash flow. They're still sitting on the nuanced transactions. So you're looking at, digesting a cumulative 88 billion of M&A. So many will ask, well, is Microsoft out of organic, energy and excitement around their portfolio? And I think the answer is no. We think the core software business is alive, but there's no question when the CEO of Amazon says that gaming could be bigger than Amazon Prime Video, you got to listen. And that tells you a lot about where the gaming industry is going, where Microsoft can have a role. And again, this has historically been a lower margin business versus their core software business. If they can convert this to more subscription and cloud and not have as much hardware, clearly there's a lot of margin leverage in this business over time. So we like it. Look, it's going to be a long fight. This is going to take this entire year to get this deal closed, and that's why the spread on the transactions, pretty wide right now. So we think it gets closed. It's just going to take time.
Yeah, and in terms of the what you were talking about in terms of the subscription revenue, I mean, 400 million monthly active users, certainly attractive to Microsoft. I want to go back to the cultural question for a minute, Brent, because I've been really preoccupied with that side of this deal. As you say, it's going to take a while to close the deal. There are reports that Bobby Kotick is going to exit, even though right now they're saying he's going to stay on, but there are reports he'll exit once the deal closes. Can indeed Microsoft solve the cultural problems at Activision?
They can, because if you look at Nadella and Amy, and I've talked about them being the best two co-pilots in tech, they have a strong team, and I think ultimately having followed them for so many years and believing that they are aligned to the right direction, they'll solve it. Look, I mean, Bobby's a brilliant guy, right? He built Activision into what it is, and right or wrong, I think clearly there's concern that they need to make some changes. And so I'm not saying that he's the issue. What I'm saying is they need to change, right? They just need to change up. And this is another huge reason why this deal makes sense is for the Activision shareholders as well as the employees. This is a chance where Microsoft just threw not a lifeboat, but like they pull up in a mega yacht and it's like, hey, everyone get on and let's go. And so I look at it and say, look, I've said this repeatedly, we're working for the Microsoft team. They do it right. They are competitive. They are focused, but they do it with integrity. And I think ultimately the employees at Activision are probably going to be pretty excited to be part of that culture. Look at what they've been able to achieve over time. So I think it's an upgrade for a lot of the Activision employees. And again, all you have to do is look at what Nadella has done. And if anyone doubts me, read his book on empathy and leadership. And it's pretty inspirational in my opinion. So I don't want to get all soft on the culture side, which I think is important, and the business side we're here to talk about. But I do think it's an important element of this for shareholders and for their employees.
Brent, there are reports out this morning that Activision reached out to Facebook, but Facebook rebuffed them. Now, you cover Facebook. Do you think this deal with Microsoft now puts pressure on Facebook to go out there and make a big deal in gaming to support their metaverse rollout?
It's going to be like the chess pieces are moving quick, right? I mean, that's going to put pressure on everyone in the industry. And so when you think about, Take-Two and Zynga coming together, in the last month, and you've got this transaction that leaves Ubisoft, Take-Two, and really EA as the only ones that the entire industry can go after. Is Netflix excited about gaming? Probably. Amazon told us that the gaming business could be bigger than Prime Video. We know, right? What is Sony going to do? Like there's only a few assets with more acquirers. So that's a good thing, if you're in this industry. And our gaming analyst has been, Andrew Erkowitz has been highlighting this, covering the space for so long that this is no doubt going to, there's going to be a lot of other bidders for other assets, and the space may consolidate very quick. So I think that underpins the excitement of gaming. Look, Facebook I think has a strong on-ramp with the Oculus for the metaverse. The challenge with the Oculus right now, this is due diligence for my kids. They need more games. They need more content. And so clearly they're going to be, I wouldn't be surprised if Facebook went on and did some small studio acquisitions. Doing this transaction probably is not right up their wheelhouse.
Interesting. All right, we'll leave it there for now. Jefferies analyst Brent Thill, always appreciate talking to you. We'll check back with you later. All right, the government's website for at-home COVID tests has debuted. Yahoo Finance senior healthcare reporter Anjali Kamani has more on this. Anjali.
That's right, Brian. So today is the day that we know is supposed to be the full launch of that at-home COVID testing site, covidtest.gov. We saw a soft rollout yesterday, and of course, as expected, some glitches there. Reports of individuals who live in multifamily homes like apartments or condos having trouble ordering if someone else who already lives in the building ordered one. And so we've seen that USPS has taken action, asked for complaints to be filed, as well as call-ins to help figure out the situation. The reports were very few and far between. So largely speaking, many people reporting that it was really quick and easy to get those. Meanwhile, today we're expected to hear from President Joe Biden discussing ongoing response to the pandemic, and that includes rolling out free N95 masks to Americans through retail pharmacies as well as community health centers. And those are the same sites where we know vaccines were distributed through. That's 400 million N95 masks from the national stockpile, which as of January has sent more than 750 million. And it's really the largest deployment of personal protective equipment in the United States history. We're seeing that shipments are starting this week and arrivals to these sites probably late next week through February, when the program is expected to be in full swing.
And Anjali, we've been in this for a long time now, because 2 years ago this week is when the first COVID case in the United States was discovered, was reported, was confirmed. And as part of our coverage of that unfortunate anniversary, you had the chance to speak with Anthony Fauci about all of this. What stood out to you?
Well, we talked about a lot of things, really, but one thing I asked him specifically was whether or not he expected that we would be here at this point in time. And here's what he had to say.
Well, I think virtually everyone thought that when we had a vaccine as effective and safe as the vaccines we'd have now, that we would get enough people vaccinated that we would handle the variant that we were dealing with, and that we would have a diminution of infection, not only in the United States, but hopefully, if we were able to get vaccines to the low and middle income countries, that we could also essentially get our arms around, as it were, the pandemic globally. The things that were not anticipated was the extraordinary capability of have multiple sequential waves of new variants.
So as you can hear a lot there, specifically looking at, what was unexpected and how this virus really surprised the top public health officials in the country, but also in the world. Back to you.
Anjali Kamani, thanks so much. All right, be sure to tune into our COVID-19 special airing today from noon to 1 p.m. Today marks 2 years after the first COVID case was discovered in the U.S. We'll take a look into the road ahead as the world continues to navigate the pandemic. All right, coming up, the uproar from airlines over the rollout of 5G continues, with some saying they will cancel flights. Julie is back with the details next.
Well, major international airlines are canceling flights to the U.S. today amid growing concerns that the rollout of 5G service could interfere with aircraft technology. Emirates, Air India, and Japan Airlines, among several airlines that have announced cancellations. Verizon and AT&T said yesterday they will delay 5G implementation within 2 miles of airports. The rest of the 5G networks will go live today. New York Attorney General Letitia James says her civil probe into the Trump Organization has uncovered evidence of, quote, fraudulent or misleading valuations made by the company to obtain loans and tax benefits, including of Trump's New York City apartment. James is now seeking testimony from Donald Trump, as well as his children, Donald Trump Jr. and Ivanka Trump. Trump and his lawyers say the investigation is politically motivated. James's office says it has not yet decided whether the new evidence merits legal action. And Puerto Rico has been given the green light to end its nearly 5-year bankruptcy. A district judge has approved a new debt adjustment plan intended to reduce Puerto Rico's $135 billion in liabilities and revitalize its economy. The plan, which cuts Puerto Rico's debt by 80%, marks the largest municipal debt restructuring in U.S. history. It's set to go into effect on March 15th. And another story that we continue to watch today has to do with Peloton. We talk about it a decent amount here on the program. There was a report yesterday from CNBC that the company had hired McKinsey to do an assessment of its business, to review cost structure, maybe eliminate some jobs. And then the Wall Street Journal reported later yesterday that the company is set to start charging customers hundreds of dollars in delivery and setup fees, effectively an increase in price here, $250 for delivery and setup of some of its bikes, $350 delivery and setup for some of the treadmills. That starts on January 31st. Now, it was interesting because the shares were a little rocky yesterday. They started to reverse higher after that report from the Wall Street Journal, but the shares, Saz, they haven't been doing so hot. Down 80% since the record high they reached back on January 13th of last year. Recall they went public in September of 2019 at $29 a share. They haven't gone below the IPO price basically since the pandemic in April of 2020, but they have been heading in that direction.
Yeah, it would probably make sense, Julie, if they do cut back on some of these stores. I believe they have over 120 stores, which essentially just act as showrooms for treadmills and bikes. So if they're looking to cut costs, that is probably one way to do it. But look, Julie, this was a $167 stock on December 21st of 2020. It is now 30. The haircut in valuation that has come to Peloton is just absolutely striking. In many respects now, it is deserved, just given how their financials have shaken out the past 2 quarters. But there is a lot of concern, I would say, on the street going into this next earnings report from Peloton in a few weeks.
And again, $29 was that IPO price. So getting back nearly down to that level. We'll see what the next shoe to drop might be. We're going to take a quick break. Coming up, Engine #1 CEO joins us to discuss how the firm is reshaping the future of ESG investing. Also, its new approach after winning the battle against Exxon. We'll be right back. ExxonMobil made headlines yesterday by announcing it is targeting net zero emissions by 2050. One investor that's pushed for changes at the company is Engine Number One, and the CEO, Jennifer Grancio, is joining us now. Jennifer, I want to talk in a moment about sort of the bigger picture for the year, but I do want to first get your reaction to this Exxon news. There were some sort of quibbles with the company not including sort of downstream companies it sells to, consumers it sells to in this emissions target. But overall, what's your reaction?
Our point of view is that Exxon has made changes since our campaign a year ago, which is great. We think there's further to go. And our campaign added 3 independent directors to the board. And Exxon has taken steps on capital allocation discipline and emissions targets. We think that there's farther to go. We'd love to see more targets and strategy on what happens before 2050. And we'd love to see continued progress on the scope 3. But we do think they've moved a lot since we started to engage with them.
And, to your point, 2050 is a long time away. When you look at ExxonMobil specifically and the oil and gas industry more broadly, 10 years from now, what do you think it should look like?
We think that, and actually I'm going to bring this back to why did we start Engine Number One in the first place? And so from an investment perspective, if companies have a big social impact from a workforce perspective, or they have a big climate impact, i.e. emissions, it's the responsibility of the CEO and the board to think about how the business is changing, how customers will hold them accountable, and the return on long dated oil and gas projects that are still 10, 20, 30 years before they pay back. So to answer your question, we think in emission sensitive industries that boards and CEOs should be having targets and should have an approach to how they're making money at 5 and 10 and 15 years. So we think we'll see more progress there.
Jennifer, we cover a lot of very large consumer products companies. We just talked to P&G CEO this morning, strong quarter from them, but a lot of them arguably are not doing enough in terms of ESG and bringing their waste down for the products that they sell. Is that another area of opportunity for Engine?
Yeah, and the way we think about it is as investors, we're an investor on behalf of other investors. So we manage assets for investors. And we think investors have an opportunity like you would in a political election. You have a vote and you should use it as a way to have a dialogue with these companies. And so our whole business is predicated on doing the work on how environmental and social and governance issues show up over time in the economics and the financial value of a company. So we're very active owners. We work with companies all the time. And every year you have a chance as an investor to vote on what the company is doing. And so that is what led us to launch the Engine Number One Transform ETF. The ticker is VOTE. And what we do there is we work every year with companies on how are they being transparent about what they're doing and how can investors hold them accountable on making the right decisions and embedding the climate and the social and the workforce into how they're running the business and driving value.
And in terms of how that ETF is done, we've seen an increase in the price of the ETF. Basically, it tracks the S&P 500, but allows you to, as you say, sort of have a voice here. And you guys are also introducing some transparency measures when it comes to the votes that you're making as part of your ownership through VOTE. In other words, the whole shareholder meeting process is still swathed to some extent in a little, if not secrecy, then opacity, right? And so talk to me how this is going to work on a meeting by meeting basis when you go to these and when you vote on shareholder measures.
Yeah, so the VOTE ETF is radically transparent on how we vote shares. We think that's a problem in the asset management industry, and we fixed it with the VOTE ETF. So it holds the largest 500 public companies. And every year as an investor, you have an opportunity, you have a voice to influence what those companies are doing. So we work through that. We look at every single company every year. And what we do that's very different is we are in favor of voting for proposals where there's a climate or social or governance issue that we think if the company does something differently, it'll result in long-term economic value. So we go through all of them. Maybe I share a couple of examples if that's helpful. One is the Tesla, which has already had their annual meeting for the year. And if you're a vote shareholder, your point of view on Tesla would be that they should have a diverse workforce in terms of gender and race, because they're operating businesses in building cars and battery plants in places where there's an abundant set of diverse workers. And so that's an example where we voted on a proposal that simply suggests that Tesla should disclose diversity of the workforce. Because if you have that information, you can understand what Tesla's doing, there's transparency, and you can hold them accountable. So that's an example of what we'll do for investors. And what's very different than the rest of the kind of fund and ETF industry is we then will disclose that immediately. You can find it on our website, and we'll even publish some sort of case studies and stories about how we come to each of these decisions. So it gives investors a voice.
Fascinating stuff. And really, as we've talked about before, just the beginning of this kind of wave. Jennifer Grancio, always good to catch up with you. Engine number one CEO, thanks for your time this morning. We're going to take a quick break. When we come back, we'll discuss the future of work with Zoom CFO, Kelly Steckelberg.
Zoom is hosting its first Work Transformation Summit, where industry leaders will gather and bat around ideas for the future of work. For its part, Zoom remains in remote work mode during the pandemic, but will likely move to a hybrid model post-pandemic. Let's talk more about this with Zoom CFO Kelly Steckelberg. Kelly, always nice to see you. Thanks for joining us. Help us think about this future of work. Does the physical office play any real role as we start to move beyond the pandemic?
Yeah. Hi, good morning, Brian. It's really interesting because work is evolving from historically have been a place to now being a space where we come together. And what we heard from our employees is they want to gather and they want to be in a physical proximity together to collaborate, to socialize, and to see their colleagues, but not necessarily to get their work done on a daily basis. So we are announcing our work styles. And this is after a long time of listening to our employees, talking to them about what's really important to them. And there's going to be 3 work styles that we're going to have at Zoom. The first and the largest population will be hybrid, as you said. They will have the flexibility to come to the office on a periodic basis. For some individuals or some teams, that might be a couple days a week. Others, it might be a couple days a month. And these are largely employees that live within a commutable distance to one of our offices. We will have a sizable portion of our employee base that will be fully remote. So these are employees that either were hired into a remote position initially, or during the last 2 years have moved beyond a commutable distance. I'm a perfect example of that. I have left the Bay Area and now living in Central Texas. And then the third and really smallest population of our team will be individuals that are in person. They do have in-person roles, but these are based on the roles and responsibility of it. They are people like our workplace team that are taking care of our physical spaces, as well as our IT organization that are managing servers or other supplies in the offices for us.
Kelly, I've had some friends recently try to go back to the office. They've navigated that pretty well, but they still have meetings and they walk into a conference room and they still don't know how to act. Map this out for us. What does that conference room experience of the future look like?
This is such a great point, Brian. Like having the right technology and strategy around your conference room solution, both hardware and software, is imperative to having a successful office reopening program. And Zoom has been working very closely with our customers and innovating around this. And there's a couple of key innovations that we're really excited are part of our Zoom rooms. One of those is Smart Gallery. So those of us that have been working remote for a long time, we've all become very accustomed to this experience where we can see everybody's face on the screen. We can see their names. We can tell who's talking very easily. And you lose some of that when you have some employees working in a conference room together and some that are remote. What Smart Gallery does is it recreates this experience by having a view of the room, but also having an individual view on every person that's in that conference room. So if I'm the person that's not there, I still have a really clear view of everyone who's there. I can be, included in the discussion in a very easy way because I can see everybody. I can see their reactions on their faces. And that's one of the innovations that we've done. We've also done something called companion mode, because we've heard from many people that the other benefits you get from a Zoom meeting is things like the chat functionality, the ability to participate in polling, and companion mode gives you that when you walk into a conference room, you can join a meeting silently from your laptop or your mobile device, and then still have those features, but you join with your camera and your mic off, so it's not disruptive, but you get to participate fully in the meeting.
Hey, Kelly, it's Julie here. So I'm curious, as you've been working at home and as you've surveyed your employees, like what was the most sort of head exploding moment for you? I guess I mean that in a good way, meaning like what was the most revelatory for you in terms of what people were saying or what you were experiencing that you didn't sort of expect from the at-home experience?
I think there's 3 things. I think, first of all, 85% of not only our employees, but we did a survey recently with Momentum, and 85% of employees that are currently working remotely say that it's most important that they get to choose. So having choice, the employee having choice is the most important thing for them. And so we want to ensure that our employees get just that. And that's what our work styles are defined for. Also, only 1% of Zoom employees said they wanted to be in the office full time. We're going to end up with about 2%, but that's based on the roles that they have and those responsibilities. And then last but not least, which I found so interesting, is our employees, they miss their colleagues. They want to come together. But the top 3 reasons people wanted to be in the office, it was really around that. It was like around socialization and collaboration, because we have all adapted so well to getting our work done remotely. We don't need to be in the office any longer to accomplish that, but we can benefit from other aspects like seeing our friends and colleagues.
And so do you anticipate that you guys will do, as you said, it's going to eventually probably be some kind of hybrid model. How do you sort of organize for people to come into the office and have that social aspect and still, kind of logistically, how do you get that all done?
Yeah, so the way that we're thinking about it is a couple things. First of all, we are opening our offices and testing and learning and experimenting. We know that we all knew how to work together when we were all in the office. We've all learned how to work together remotely. And now we're going to have to all learn how to work together in a hybrid environment. So we are doing a couple of things. First of all, we will have a way that employees can reserve a desk so that you'll be able to go on and see, like I can look the night before and see like, hey, my team will be in the office tomorrow. I would like to join them. So you can plan accordingly. We also will encourage managers and teams to self-organize. It's not going to be programmed by the company, but self-organize around days in the office that might work best for them. So for example, my team, maybe finance and workplace, Tuesdays and Thursdays are the days that generally we come to the office if it works for people. And then the other thing is that employees will have the opportunity to work with our people experience team, especially our managers, to learn how to manage in this environment. It's a very different experience, and we want to ensure that everyone is empowered and able to have an inclusive opportunity and experience, and that's what we'll provide to our managers to make sure that they feel supported in this experience.
Well, good luck at the summit today. Zoom CFO Kelly Steckelberg. We'll talk to you soon about earnings coming up.
Sounds great. Thank you, guys.
All right, lodging outfit Sonder debuts on public markets today. We'll chat with Sonder's co-founder Francis Davidson on the other side of the break.
Wanted to get a quick check on the markets because we are seeing them now dip into the red. Not a big drop, but nonetheless a pretty sharp reversal from seeing stocks trade higher for the first hour or so of trading, with the Nasdaq earlier up as much as 0.9% or so. Now it's down almost 0.1%. So we'll dig into that and figure out what's going on, what is responsible for that downdraft that we are now seeing. Now, though, I want to take a look at a stock that is up a bit today. It's called Sonder Holdings. It just started trading today after completing a SPAC, or I should say a de-SPAC transaction with Gore's Metropolis 2. Sonder, kind of a combination of a hotel and an Airbnb. In other words, it's something you rent in various cities, but it is not owned by an individual, but rather managed by this company, Sonder. Francis Davidson is the co-founder and chief executive officer of Sonder. Hopefully I have described that Well, Francis, I've stayed in a Sonder before, so I have some familiarity with it. I'm curious who your customer base is at this point. Is it people traveling for work? Is it families? All of the above? What does it look like?
Yeah, listen, I mean, we're a hospitality disruptor, and we focus primarily on serving the needs of millennials and Gen Z. So our median age is much lower than other hospitality brands. But what's really important is that we design and we operate these beautiful hotels and apartments, and you can stay for a night, a week, or as long as you'd like. And so that means that digital nomads can stay with us. It's the business traveler, but really 80% of our demand is for leisure stays. And what really kind of draws our demographic in is the services that we offer that can be accessed through the app. The homegrown technology that we have allows us to maintain price points that are really competitive and offer really high quality and consistency, which really resonates with the next generation modern traveler.
Francis, mobility has been hit recently because of the Omicron variant. Has that impacted your bookings or night stayed at all?
Well, through the entire pandemic, I think we've demonstrated quite a lot of resiliency. So, of course, the pandemic's not been a positive news story for the travel and hospitality industry over the last couple of years, but relatively to the industry, our performance has been really stellar. Even Q3 of 2021, we showed that we generate about 20% more revenue than the comparable properties nearby us, which is a premium that we managed to sustain or exceed throughout the pandemic. And so our occupancy rates as early as summer of 2020 were already about 70%. And so we've managed to find these kinds of use cases, like I mentioned, folks that are on the road, that are working remotely. Perhaps I myself spent 9 months staying at 25 different Sonder spaces throughout 2020. And so a lot of new use cases that we're using, we're very agile in kind of identifying these pockets of demand in a time where transient demand is a little bit less robust.
To your point, I was also looking at revenue per available room, which tends to be the hospitality industry's way of measuring how you guys are doing. $126 in the third quarter. And that trends above traditional hotel companies that I was just kind of scanning, Hilton and Marriott as a couple of examples. Is that kind of RevPAR sustainable? What do you see as the sort of long-term rate?
Well, listen, we're very optimistic about the recovery of travel generally over the next few years. I think there's a long-term trend of especially millennials and Gen Z spending a disproportionate amount of their incomes towards experiences and not goods. And so I think that's a positive long-term trend for us. And we've shown throughout the last 22 months that we've been very creative at finding ways in order to keep our properties full and the occupancy really attractive. And that's been demonstrated in the RevPAR figures that you just quoted.
What doesn't your platform do today that you see it doing in a couple of years?
Well, we want to keep investing in technology. I think this is really the answer for this business. The reason we can be successful is because we've created a mobile app, which allows our guests to request a series of services very efficiently, frictionlessly in a modern fashion. And so we want to keep investing in guest-facing technology tools, but also there's a lot that underpins our entire operation that makes it possible for us to automate and streamline a lot of the work in the back end. That's really the magic. The reason why, if you go on Sonder.com or on our app and you see so many amazing spaces with great reviews, you'll notice that the price points are actually quite affordable for the level of quality that you're obtaining. And really technology is the answer there. It allows us to really operate these places so efficiently that we can offer an elevated experience at a price point that can be afforded to the many.
Yep, full disclosure, the one I stayed in was in New Orleans, and it was a pretty enormous space. I was pleasantly surprised by the size of the thing. Francis, you said you spent 9 months last year on the road, staying at different Sonders. Did you have a favorite?
Oh God, it's such a tough one because we've got amazing spaces. One of my favorites is, for example, the Hyde in Philadelphia, former hat factory. It's really industrial architecture, and we had a partnership with a series of artists that came in and did custom murals. We've got amazing properties in London and across the entire U.S. and most Western European capitals. And so, the trip took me to 21 states and many countries in Europe, and I was just kind of mind blown by the quality that we were able to offer, and again at a price point that really is accessible to the many.
Well, congrats on the first day of trading. We will catch up again soon. Shout out, by the way, to the balloons with your ticker symbol behind you, SOND. Pretty clever. Francis Davidson, co-founder and CEO of Sonder. Appreciate it. We're going to get another check on the markets, and we come back, try and dig into what is going on here behind this latest downdraft. We'll be right back.
Welcome back to Yahoo Finance Live. Julie, where did our market rally go? Seeing some red out there on the Yahoo Finance platform.
Well, let me take you inside the interactive because I'm trying to suss out where it did go. And I'm seeing a couple culprits here. We've got consumer discretionary stocks that are now the worst performers, down by about 0.75%. Energy stocks also weak here. That's the XLE that you see here, and the XLF also. The financials are trading lower. Now, even though we had positive results from the likes of Bank of America and Merrill Lynch, US Bancorp came out with numbers that missed estimates, so that's one of the worst performers in today's session. Counterbalancing all of this to some extent, we got consumer staples, we got utilities, we got healthcare. By the way, the XLK, which was more solidly in the green earlier as we saw a recovery in some of the software stocks, that has pretty much melted away as well. So that also seems to be at least partially responsible. And if we switch on over to what's going on with the software stocks here, still mostly in the green, but you have more red contenders than we had earlier. And some of the green contenders have given up some of their gains. So that's partially what's going on here. Looking back on over here, I want to check on some of the trending tickers that we are watching. Within financials, we talked about it earlier. Sofi Technology is getting a huge lift today, although it's smaller than it earlier was, on the news that it did succeed in getting an Office of the Comptroller of the Currency bank charter. And so those shares are trading higher. Bank of America still holding on to gains. US Bancorp, which I mentioned, down by 7%, Saz, after that company missed estimates. So yeah, that's dragging down. Even though you've got Bank of America, Morgan Stanley, the biggies, US Bancorp not helping matters here today.
Look at P&G, Julie, too, really gaining strength throughout the session, up close to 5%. I mean, John Mueller, we talked to him earlier on in the show here, striking a positive tone here on consumers being able to just digest these price increases they have pushed through.
Yeah, and even though, again, on the overall line here, when we look at stocks, under the surface, under the hood, you have some pretty significant increases. I mean, in big companies, United Health Group is another one. That stock is up some 1.5% today after that company came out with numbers that beat estimates. So there's plenty of the green on the screen if people want to find it. It's just that we are not seeing as much of an increase. Earlier today, fresh grapes. What's fresh? Do we know what fresh grapes is? That one sticks out to me. Vine. It must have something to do with wine. There you go.
The only thing I know is fresh coffee, Julie. Fresh coffee. I'm going on cup 7. Fresh coffee.
Fresh coffee, that's the Sazi company right there. Fresh stimulants in the form of energy drinks as well, of all kinds. That does it for Saz and I today. Hopefully he's done for the coffee. I hope for his health's sake. We'll be back here tomorrow, and Brad and Akiko are going to take you through the next 2 hours of trading.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. We're seeing stocks trading pretty flat about 90 minutes into the trading day right now. The Dow and the Nasdaq in the red, just barely there, and the S&P 500 right around the flat line. Despite strong earnings results, Treasury yields continuing to move higher. The yield on the 10-year T-note topping the highest level in 2 years, touching 1.9%. Before retreating just a bit. Mass deployment. The Biden administration vows to ship out 400 million N95 masks after the CDC updates its mask guidance, while Americans flood the government's new website to order free at-home COVID tests. And tackling the global chip shortage. We've got a conversation with Commerce Secretary Gina Raimondo about the supply chain snags leading to price pressures across industries. First, though, earnings season rolls on today with the latest or the last of the big banks to report. Bank of America in the green after reporting a 28% profit jump in the fourth quarter. As always, we turn to Yahoo Finance's Brian Chung, who's got the big banks covered for us today. Brian.
Hey, Kiko. Well, the final of the large banks rounding out the earnings season for the fourth quarter. We got earnings from both Bank of America and Morgan Stanley before the bell this morning. Let's unpack the earnings, starting off in Charlotte, North Carolina, with Bank of America reporting revenue of $22 billion on the top line, just a smidge short of the street's estimates, but beating on the bottom line, 82 cents of adjusted earnings per share. The real story for Bank of America is, again, in that bread and butter consumer-facing business. How much do they make on loans? You could think of this in two different types of buckets. The first being basically the interest collected or net interest income that clocked in at $11.4 billion, an 11% increase year over year. And then non-interest income, which is kind of the fees collected on those same products, coming in at $10.7 billion. That's an 8% year-over-year increase. Things might be looking up further for net interest income, especially if the Fed follows through on higher rates this year. And by the way, we have to talk also about credit quality. It seems like we haven't been talking about provisions for credit losses in a number of quarters. That was the biggest story in the depths of the pandemic, but credit quality continuing to get better, which is a reason why Bank of America was able to release almost another $500 million in provisions in the quarter. But let's shift gears now and go over to Morgan Stanley, less of a consumer-facing bank, more of a traditional Wall Street bank. Fixed income equity underwriting businesses were down, although financial advisory was up. There's a lot of M&A activity going on in the space. And for all the other banks that we've been highlighting, the big story has really been about expense management, right? Particularly rising banker pay and comp and benefits at Morgan Stanley only up 4%. Compare that to their peer Goldman Sachs, which saw comp pay go up by 31% on a year-over-year basis. And the CEO, James Gorman, saying on the earnings call earlier this morning, it's really not just inflation. He says that their company's business model is pegged to performance, not necessarily inflation. Doesn't necessarily explain why they did so well this quarter, despite the fact that their pay remained low, although interesting to see if that's going to remain a story in the quarters to come. But again, that rounds out all the other bank earnings for the fourth quarter. We're expecting some other super regionals, but at least for the sixth largest bank, that wraps up the fourth quarter earnings, guys.
Yeah, the wage pressure is really an interesting narrative to be following here in the banks. Thanks so much for that, Brian. Well, banks certainly not the only ones to report today. Brad, we're looking at shares of Procter Gamble also getting a pop in the session, up more than 4% now. And really the story here all about price hikes helping to offset rising costs for commodities as well as freight costs. The company raising its outlook for sales growth in the year, now calling for a 3 to 4% increase in fiscal 2022. And Brad, when you look at that number, that's a little higher than the 2 to 4% they projected prior to the call today.
Yeah, absolutely. And when we think about Procter & Gamble and kind of continuing to move forward from here, the standout year-to-date performance that they've had, or at least over the past 52 weeks, we should say, the performance that they've seen up by about 29% over that point in time. And what they were calling out here, the volume and price increases, and then some of the categories that they did extremely well. And you saw standout in healthcare, and now also that raised guidance you mentioned. We also want to take a quick look at the interview that took place earlier here on Yahoo Finance as well. With the CEO of Procter & Gamble. I believe we have a short clip of that.
We've announced price increases in the majority, I think 9 out of 10 categories. Some of those price increases have not yet come to the shelf. They haven't yet come to market. So we're going to work through that before we take the next step.
Do you see any signs we are nearing peak inflation, just from your standpoint in your business?
There are some commodities that are starting to modestly roll over, which is encouraging. There is capacity being added to some of the input supply chains, which is encouraging. On the other hand, in markets like labor and transportation, I don't expect any near-term decreases.
And so that was the CEO of Procter & Gamble. And just again, to put those numbers into context here for that fiscal year 2022 guidance, all-in sales growth they're expecting, they are increasing that from a range of 2 to 4% to now at the high end, coming in at a range of 3 to 4% versus that prior fiscal year guidance as well.
Yeah, and John Mueller there sort of repeating comments he said earlier today, which is that more price increases could be on the way. That's something to watch closely, of course, because we've been trying to figure out, what that line is for consumers. At what point do they start to pull back on spending because of those price increases? Our next guest says earnings growth is going to continue to be the big driver in the markets, with results mitigating concerns about inflated valuations. Let's bring in Alex Shaloff, Bernstein Private Wealth Management co-head of investment strategies. Alex, it's good to talk to you. We're not right in the middle of the earnings results, but we've certainly got a big picture here from the big banks that have reported so far. What's your impression, and what are some things that have stood out to you?
Well, while we are early in the earnings season and we've heard from big banks, it's a little bit of a back and forth between what's important to Wall Street and what's important to Main Street. And in some quarters, you get terrific earnings from the banks and everyone says, well, that's not reality. That's Wall Street. That's not Main Street. In this quarter, we've had good earnings. We've had good results, some weak guidance. But again, this is Wall Street. We'd prefer to look more across the entire spectrum of companies and look at the companies that have exposure to Main Street, that have exposure to the consumer. I think today was a really big bellwether, frankly, that really showed that consumers with $1.3 trillion of excess savings have the ability to spend through this inflationary cycle. That's what's important.
Consumers also monitoring very closely to see exactly where companies will either incur some of the costs as a result of the higher prices that they've got to pay on the production side, or even as part of the workforce is demanding higher wages as well, as we know at this time in this inflationary environment. So the consumer's navigating this and trying to figure out where some of the efforts to curb some of that price inflation, where that will kind of mitigate the amount that they're paying either at the pump or at the grocery store, and all of the different realms that they are contributing to this broader economy.
Yeah, we try to separate out what, I don't want to use the word transitory because transitory is dead as a doornail, as established by the Fed. But what we try to do is separate out what are the longer term implications of inflation, the things that will take a long time to go away. You raise labor costs, that's spot on. We have much more job openings than unemployed workers. It's going to take a long time to work through those 10.5, 11 million job openings. So we'd expect to see persistent pressures on the labor front as it relates to inflation. Our view is that the supply chain disruptions, which have been pushing goods prices higher, do start to come down as those kinks work through the system. But we can all, as consumers, expect to pay more for big ticket items. You're going to continue to see dealer markups on new cars. You're going to continue to see price pressure on the upside for used cars. You're going to continue to see long waits for dishwashers and refrigerators and these type of big ticket items, and expect, as you said, to pay more at the grocery store for those everyday items. But again, we believe that consumer balance sheets are strong enough to withstand and spend through this cycle.
Alex, you mentioned this conflict that we're seeing between Wall Street and Main Street. Obviously, investors like it when these companies say they're going to, in fact, increase prices because of their prices going up as well. But that's got to hurt consumers, too. When you look at that push and pull, what are some companies that you think are really strongly positioned to ride out the continued price pressures? Procter & Gamble certainly getting a pop today on the back of what we heard from John Mueller.
So you're absolutely right. It's not everybody. There will be companies that don't have the brand power, that don't have the differentiated product set to be able to withstand this inflationary pressure and not keep up with price increases. But one thing that's important to note is this is the first time we've had inflation in years. So a lot of these companies haven't raised prices in 5 years, 7 years, 9 years. So even companies that are at the lower end of the value add spectrum will still be able to add something to their pricing to keep up with inflation. It's really, the question is, who are the brand leaders who can really drive price growth? And that's a question, that's part of the reason why the market's a little wobbly today and for the last couple of weeks, is that's the question. What are the companies who win from this cycle and who doesn't?
What do you believe that sets up for earnings growth over the course of the rest of this year?
Well, we came into the year as a consensus expectations of 9% earnings growth. There's been a few calls for that to maybe be 7.5 or 8. That's less important, whether it's 8 or 9 or 7, than the direction of any types of changes. If we can get through this quarter with clearly good earnings, but some change in guidance without meaningfully disrupting our view of high single-digit earnings growth for this year, then the market can do, the US market can do well this year. Last year was a year of tremendous earnings growth. Actually, the S&P multiple did not expand at all, it contracted. It was about earnings growth. So it's reasonable to expect a cooling off in earnings growth. The numbers just don't, the math just doesn't work. We're gonna have 2 years of 30, 40% earnings growth. So as long as we come in with a consistent number that's high single digits, mid to high single digits even, we'll be fine this year.
In terms of the numbers that we get this quarter mitigating, as you pointed, concerns about inflated valuations. There's been a lot of attention, obviously, on the high growth names, the big name tech companies, about whether, in fact, they can continue to grow at this pace as we see the rates rise too. We've seen a significant pullback. Do you think that's been a bit overdone, that we could see a little more support once we get those earnings results?
Yes, it is overdone. And if you think about what the analog is, it's 1999, right? These overpriced technology, the dot-coms that had no earnings. This time it's different. A lot of things in this cycle are the same as they have been in other cycles, but not in the technology space. The biggest names are profitable with tremendous earnings growth. And right now, the sell-off in some of these names have provided very interesting entry points because these are profitable businesses with tremendous earnings growth.
All right, that is Alex Sholoff, who is the Bernstein Private Wealth Management co-head of investment strategies. Alex, we appreciate the time here and the conversation on the day. We'll check back in the future. And everyone, switching gears here, we got to get to a Yahoo Finance trending ticker. Sofi is soaring after the fintech company passes the last regulatory hurdle to becoming a bank holding company. The stock moving higher on the day, holding on to gains of about 13% as of right now. In order to become a bank, Sofi is buying the California community lender Golden Pacific Bancorp and its Golden Pacific Bank subsidiary. That merger announcement was announced last year. We'll continue to keep close eye on shares of SOFI as we move on throughout the rest of today. Well, coming up, everyone, game on for Microsoft and Activision, but do workplace problems at Activision prior to the blockbuster deal mean game over for Activision CEO Bobby Kotick? Perhaps there's a parachute on the horizon? We've got more on this after the break. Welcome back to Yahoo Finance Live, everyone. Well, Microsoft acquiring Activision, it's captured the attention of gaming investors and fans as the industry further consolidates. So what now for the industry, for the employees, and for the fans as well? Also for the CEO, who had presided over Activision Blizzard's storm of workplace misconduct even prior to the acquisition. Here with more, we've got Yahoo Finance's Dan Howley. Dan, we want to bring you in on this, as we do know you've been tracking this extremely closely. So what comes next?
So right now, what we're seeing is that Activision Blizzard CEO Bobby Kotick will leave the company after the acquisition is complete. He's going to stay on for a while, and then once everything is kind of settled, he will leave the company. That's according to reports that we're seeing right now, and that's kind of a big deal. I mean, not kind of, it is a big deal considering he's led the company for so long, and because part of the controversy that's going on right now at Activision Blizzard is because of his handling of workplace discrimination and sexual harassment. You'll remember that there were reports that he knew about these different issues going on and didn't bring it up to investors. That's being looked at by the SEC. There was obviously a part of a report, I believe, by Bloomberg or the Wall Street Journal, saying that he had threatened to have an assistant killed, basically over voicemail. So this is something that has been ongoing. There were walkouts demanding that Kotick basically resign or be fired by the board. The board stood by him, though. But now that Microsoft has come in, and according to the various reports, this is basically Microsoft saw Activision Blizzard in a weak position and said, look, we can give you guys the money to basically make this kind of go away. Bobby Kotick leaves, we get Activision Blizzard, and we integrate our culture into the company itself. It'll be better for everyone, including obviously employees. And that's kind of how this all went down. Now, what this means for Microsoft is that they get that huge library of games. They're going to be able to further build out their Game Pass service, which, I mean, I use it and it's an incredible deal. Eventually, they're going to raise the price on that, most likely, similar to how we've seen Netflix do over the years. They'll subsidize it right now, and then down the line, when more people get on, they'll start to raise the prices. It means that they'll be in the mobile gaming space, and it means they get a lot more exclusive titles. Now, what that means for gamers is great for the Game Pass stuff, especially if you don't necessarily have a good gaming laptop or a good console at home. You could play that on a Chromebook using the cloud service. If you're a PlayStation or Nintendo player, though, it's problematic because Microsoft's acquisition of ZeniMax shows that they're willing to make company titles from the companies that they acquire exclusive to the Xbox or PC. And that means that if you just spent $500 on a PlayStation and you were expecting to get access to the next Activision Blizzard title, you may not get that. And that's kind of the issue that we're seeing with this broader consolidation in the industry, is that it's really making people kind of have to choose more and more over the consoles that they pick up. Previously, you could get a console and figure, well, there's third-party studios out there. I'll still be able to get access to plenty of games. Now, that's not necessarily so much the truth. We still have a few big studios out there, but with Activision Blizzard gone, that's one of the big three outside of EA and Take-Two that are now kind of underneath Microsoft's umbrella.
Dan, really quickly on the culture issue, some interesting reporting out from the Wall Street Journal about the timing of this. You kind of alluded to the fact that this came down, or the initial call was made around November, when Activision Blizzard was going through all of these issues with sexual harassment in the workplace. How's it likely to go over with Activision employees? I mean, sure, Bobby Kotick may be on his way out, but in some ways, this is kind of being framed as Microsoft giving him an out through this acquisition.
Yeah, and I think that's something that a lot of Activision Blizzard employees are, responding obviously negatively to. A lot of them had, as I said, participated in walkouts, wanted Bobby Kotick gone, and now the idea that he's going to be able to make off with, millions of dollars, obviously is infuriating to a number of them. I follow a number of them on social media, and that's essentially what they're posting. On the flip side of things, for employees, it's good. If you talk about the overall culture, Microsoft seemingly has a very good corporate culture on its side. The studios that are underneath Microsoft, especially the Xbox division, they don't seem to have those kinds of issues. Phil Spencer, the head of Microsoft's gaming division, is well regarded in the gaming industry by both, industry insiders as well as gamers, by the way. That's pretty rare when you have gamers actually liking the head of a major gaming company like that. So it could be a very good thing for them in the long run, especially if they're able to integrate Microsoft's culture into Activision Blizzard's culture and kind of clean up the issues that they have going on there. So I do think that they're obviously going to be very upset about Kotick getting kind of away with this to a degree, but they'll still be benefiting from the integration of Microsoft culture into Activision Blizzard, which would likely pay off for them in the long run.
Yeah, these culture synergies are always challenging, right? In any kind of acquisition, and this could add to the layer of that. Staying in tech, we've got the Senate Judiciary Committee taking up a debate on that bill, really looking at trying to curb the power of big tech companies. There's an interesting divide here that we've started to see between the big tech names like an Apple and then some of the smaller names like Yelp, who've now published this letter to senators.
That's right. Yeah, this is the American Innovation and Choice Online Act. It's going to be debated in the Senate Judiciary Committee tomorrow on Thursday. And basically, what we're going to see out of this, and this is going to be Chuck Grassley and Senator Amy Klobuchar, and essentially they're the ones that are kind of pushing this forward. Basically, what they're saying is they don't want tech companies to be able to self-preference themselves, meaning if you look at a Google search and you look up a destination, that Google can't automatically put up the Google Maps directions. That's an idea of self-preferencing. If you look for something on Amazon's website, Amazon Basics doesn't immediately pop up, or in the App Store on Apple or Google Play Store on Android, that their apps won't be at the top of the screen. Now, if you do, by the way, search for things in those app stores, you will find that Apple and Google have moved their own apps down. You're not going to find them as the very first apps. But really what we're starting to see here is, as you said, this divide between the big corporations and the smaller ones. So a group that's being kind of helmed by the folks at Basecamp, DuckDuckGo, Y Combinator, Yelp, they've released a statement in support of this legislation saying that big tech companies quote, use manipulative design tactics to steer individuals away from rival services, restrict the ability of competitors to interoperate on their platform, use non-public data to benefit the company's own services or products, make it impossible or complicated for users to change their default settings or services or uninstall apps. And those are certain things that you still find on the likes of Android and iOS, especially that unable to uninstall apps part. So I do think that we're going to continue to see this. Whether or not this legislation goes forward, it really depends on how much these senators are willing to stand up to big tech. Obviously, there's huge amounts of money being used for lobbying by these companies. We've seen an increase over the past couple of years as the Congress has started to look more at big tech. But there are huge divisions between Democrats and Republicans as to how big tech should be corralled. There's problems with the way both sides see censorship or the issue of misinformation online, whether or not antitrust laws need to be introduced or current antitrust laws are enough. So it's still very much up in the air whether we'll actually see any kind of firm legislation even come to the full Senate floor, regardless, or fully passed on its own. But right now, it's still very much up in the air.
Yeah, and we've seen that divide among lawmakers in the number of hearings that we've been following that played out last year. But of course, that debate taking place tomorrow on that bipartisan bill. I know you're going to be watching that closely. Thanks so much for that, Dan. Coming up, doubling down on U.S. equities. We're going to explain why Goldman Sachs is advising clients to remain invested despite high valuations. That conversation is coming up after this break. Goldman Sachs Investment Strategy Group is doubling down on U.S. equities. After a banner year in 2021 with the S&P 500 gaining 27%, their latest outlook report is calling on clients to remain invested despite high valuations. Let's bring in Brett Nelson, Goldman Sachs Investment Strategy Group, head of tactical asset allocation. Brett, walk me through that thesis. I mean, I guess the question is, if you don't stay in equities, where else do you go? But what are you advising clients right now, especially in the face of volatility?
Sure. So the general recommendation, which we've actually been making since the trough of the financial crisis, we point out in the report that we've told clients to stay invested in U.S. equities 106 times since the trough of the financial crisis, and this report makes 107. So we certainly realize the recommendation is long in the tooth, but we've underwritten the thesis again this year, and it really comes down to a couple factors. So the first is that when the economy is expanding as it is now, and in fact, we're expecting above trend growth, the odds of a positive return in U.S. equities historically over any one-year holding period have been about 88% historically. And the skew of those returns is very favorable. There's a significantly greater chance of a 10% or greater gain in equities versus a 10% or greater loss. So given the economic backdrop, with us putting just 10% odds on a recession this year, we think that those odds continue to work in investors' favor. The second thing we would point out is along the lines of what you just highlighted, the kind of TINA narrative, there is no alternative, in that when we think about the returns on cash and bonds, they're flat to negative this year. And our return for equities is around 6%. Depending on other markets outside the US, it could be as high as 9%. But nonetheless, that additional risk premium that you're earning in equities, if we think about that relative to historical standards, is still attractive, even adjusting for the volatility. And so that's really the underpinning of our recommendation for clients to stay invested.
Within the sector opportunities that you're looking into right now and kind of forecasting as we move on throughout the rest of the year, where are those sectors that are perhaps best positioned for outperformance?
Yeah, so tactically, we've held this position last year, and we're again recommending it this year, in that we have an overweight to value versus growth. And there are a couple factors that underpin that recommendation. So we know that in the last few years, there's been a scarcity of growth. The last economic expansion was only around 2% annualized real GDP growth each year, which was very low by historical standards. So in that type of environment, investors were willing to pay a premium for growth stocks or stocks that could generate growth organically. We also know that we have had very low interest rates in the past several years. And as a result of that, the longer duration cash flows of those growth and technology stocks have become more valuable because they are being discounted at a lower rate. We think that now that rates have bottomed and have started to rise, and we've certainly seen a big backup in interest rates this year, as well as the fact that we expect another year of above trend growth, both of those factors work against the historical preference for growth stocks. And that's why, in our view, we're starting to see growth stocks struggle late last year and early this year already. So specifically, how are we expressing that? Well, we have an overweight to energy companies, S&P 500 energy firms, as well as MLPs or master limited partnerships, as well as just an outright long in oil itself through an option structure. And then we also have an overweight in the Eurozone banks.
Talk to me about the Eurozone banks specifically. I mean, is this sort of the same idea that we're looking at here in the US as we see the Fed start its tightening and hike its rates? If you look at something like the ECB, I mean, they've taken more of a patient stance as opposed to the Fed.
Yeah, so there's certainly an interest rate component to that. So we think that these stocks will be natural beneficiaries of just a rise in global interest rates. Even with the ECB being more patient, we still know that German 10-year bond yields are rising, for example. And the other dynamic is that these stocks are just fundamentally cheap. When we look at their price to book ratio relative to their profitability, they still screen as one of the most attractively priced sectors within the Eurozone. And we also think that investors might not fully appreciate just how much they've right-sized their balance sheets and improved their capital ratios. And the reason that's important is because that puts them in a position to return capital, especially now that the dividend ban has been lifted. And so we think that these stocks, have dividend yields 4 or 5%, which looks very attractive, as well as buyback potential. And so all of those factors, in our view, conspire to provide an attractive return for investors this year.
You got to walk us through the latest acronym and the evolution of different FANG names that we've seen over the years. Now we have FANGMANT, so FANGMANT. So break this down for us and why we're now evolving once again what has been a very popular kind of host of companies over these past several years in terms of growth acceleration that we've watched.
Yeah, so it's certainly been an alphabet soup in the last several years. The FANGMANT is Facebook or Meta, Apple, Netflix, Google, Microsoft, Amazon, NVIDIA, and Tesla. And so the reason we broadened it out is because we recognize that even when you're looking at the top 5 stocks within the S&P 500, these don't necessarily capture all of these names, which are obviously very big market cap weights in the market. And so our thought was to simply broaden it out to the universe of stocks that get the most attention in terms of what retail investors are trafficking in, especially through options, and what tends to be top of mind when people think about, big, large technology companies in the US. But, one of the main points that we make in the report is that we don't necessarily need the FANGMANT stocks to generate a positive return for our forecast for this year for 6% returns in the S&P 500 to come to fruition. And in fact, if the other stocks in the S&P were to be up around 10%, then we think that we could still achieve that even if our objective, our 6% objective, even if the rest of the FANGMANT stocks were down 5%. So the point is that we think that the kind of bifurcated market that we're seeing this year, where we have energy and financials up on the year and technology stocks obviously down, that trend could continue and could still allow the S&P 500 to generate positive returns this year, which is our expectation.
Something tells me FANGMANT is not going to take off like FANG, but point taken. Some good insight there, Brett. It's good to talk to you today. Brett Nelson, Goldman Sachs Investment Strategy Group, Head of Tactical Asset Allocation. Coming up, Commerce Secretary Gina Raimondo warns the chip shortage is a huge wake-up call. The details, as the official says, dependency on foreign chip makers is scary. That conversation is coming up on the other side of the break.
Welcome back to Yahoo Finance Live, everyone. In this week's episode of Influencers, Yahoo Finance Editor-in-Chief Andy Serwer sits down with U.S. Commerce Secretary Gina Raimondo. The two discuss the causes of this period of inflation, why business leaders see Omicron as a short-term threat, and also the Commerce Department's work on climate and broadband internet. Take a look.
If you get under the covers of the numbers, you realize that a third of the increase in inflation is due to car prices, which is stunning. You know, a third is due to car prices. Why is that? Because last year, auto production of cars was down by almost 8 million cars, 7.7 million cars. So supply is down, prices of cars are up 20%. And the reason, like the single reason or biggest reason that car production is down so much is because car companies can't get their hands on enough chips. And they will tell you that. If you go to production facilities of cars and trucks, by the way, you will see many, many cars fully assembled, but for chips. So it's pretty simple supply and demand. You know, I'm thinking back to Ec10, which I took 30 years ago. It's like we need to increase the supply of cars so prices will come down. And in order to do that, we need increase in semiconductor chips. So there's really a direct link between the two, and we need Congress to act so they can fix the problem.
And so there is the CHIPS Act out there, and I'm wondering where that stands right now and then how that would address this problem.
Yeah, so it's kind of stalled in Congress, to be very honest. The Senate worked hard, got the CHIPS Act passed, I think last summer, and it's been a little bit stuck in the House. Speaker says she's for it. I mean, she does support it, but we need to move it. And so why does it matter? It is essentially it's incentives that the Commerce Department could provide to chips manufacturers so they will make chips in America. If you ever, have time for kind of a really scary read, you should learn more about how dependent the United States is on other countries, especially Taiwan, for our supply of semiconductors. Like right now in the United States, we make none of the most sophisticated semiconductor chips, none of them. And we get the majority from Taiwan. So apart from the fact that we need to make chips in America so we can make more cars, reduce inflation, create jobs, it's a national security issue as well. We cannot be a secure nation economically or nationally secure if we get 60-70% of all of our chips from a single company in Taiwan. So in any event, Congress needs to move. They need to take action now. It'll send money to the Commerce Department. We'll set up a program here where we work in partnership with semiconductor companies, asking them to set up shop in America, making chips in America.
And so would this bill then prospectively help NVIDIA, AMD, Intel, Micron, those U.S. companies set up fabs here in the United States, which cost $1 billion. They're very expensive.
Yeah.
And also, would there be money for foreign companies as well, say like Taiwan Semiconductor, to build facilities here?
Yeah. So yes and yes. Mm-hmm. Yes and yes. We need. They cost many billions of dollars, as you said.
I'm dating myself. I remember when they cost $1 billion. It cost a lot more than that. Right? Yeah. It's
multiple billions of dollars. And look, these companies could be building more fabs, or fab is just a word for a semiconductor facility where they make chips. They could build them now in Malaysia, Taiwan, lower cost settings. We want them and need them to build them in America, hiring Americans to make this stuff on our shores. And by the way, yes, we hope that once Congress does its job and gets us the money, we hope, Samsung, TSMC, companies that are not American, but in allied countries, will be eligible if they put their facility in the United States of America.
And just one more question about that. I mean, do you think companies really get it that the supply chain, which was optimized for cost, needs to be optimized for other factors as well, like security?
Yeah, I think they get it now. I think they get it now. As you say, so well said by you, I mean, there's been an obsession for decades with just in time, obsession with efficiency. And we're realizing that in a world of severe climate change events where storms can take out a manufacturing facility or pandemics or other kind of disruptions, you need redundancy, you need resilience. Quite frankly, you need stuff near you and near your customers, not all of it in Asia. So I think that absolutely they've learned a very painful lesson. I mean, if you talk to folks who run auto companies or trucking companies, it's been a really brutal year. I mean, like I said, their production is down so significantly. They've had to lay off workers. They have whole facilities filled with half-built cars and trucks. They can't finish them just because they can't get chips. So, yeah, it's been a huge wake-up call for the private sector around how to build in resiliency, redundancy, just in case, to their supply chain.
Does all that speak to a decline in globalism? And you're the U.S. Commerce Secretary, and I don't know what your thinking is on that. I mean, obviously you have China on your mind as well,
yeah.
And there are the political considerations that impact supply chain. So what is your thinking on that?
Yeah, I don't think it does. Listen, I think globalism is and should be alive and well. In fact, you speak of China. I mean, the president's very clear on this. We have to work with our allies as we confront the threat and competition from China. And we have to actually do a better job of that, working with our allies in the Indo-Pacific, with our allies in Europe. That being said, look, we have, the United States, over decades, has just watched our manufacturing base wither. I mean, quite literally just wither. We've lost, I think, 30% of small and medium-sized manufacturers in America, gone out of business in the past few decades. So, there is a balance. We need to work with our allies. These supply chains are enormously sophisticated and global, and they should be. I was in Malaysia at the end of last year, and I visited the semiconductor packaging facility of an American company. It's sophisticated, it's huge, thousands of Malaysians work there. That is a good thing, but we can't make nothing in America. It's just, we have to, the balance is out of whack. We've taken our eye off the ball. To be a strong, vibrant global power, we need a strong, vibrant, advanced manufacturing industry in the United States of America with the workforce who can do those jobs. And that is a critical element.
In our worldview today, Secretary of State Antony Blinken is warning that Russia could launch an attack on Ukraine on very short notice. Speaking at the U.S. Embassy in Kiev, Blinken called on Moscow to choose the path of peaceful diplomacy over renewed aggression, vowing consequences for Russia if it opts for the latter. The comments came amid fears Moscow's looking to invade Ukraine as it builds up tens of thousands of troops near its border. Russia's also moved the military into Belarus for what it calls joint military exercises. Russia has denied any plans for military action. Blinken's visit to Kiev is the first of 3 stops planned this week to diffuse tensions between Russia and Ukraine, and he's set to meet with Russian Foreign Minister Sergei Lavrov in Geneva on Friday. Well, phones have been reconnected in Tonga following a volcanic eruption, but residents may have to wait a little longer to get their internet connection restored. Communication to the island nation has been largely cut off since a massive eruption damaged its only underwater cable connecting residents to the rest of the web. The government now says repairs could take up to a month. The explosion over the weekend marked the largest eruption in more than 30 years and triggered tsunamis as far away as Hawaii. Volcanic ash and salt water from the waves have also contaminated local water supply, raising concerns about a disease outbreak, including cholera. And over in Hong Kong, thousands of people are volunteering to adopt hamsters after officials ordered they be euthanized over fears of a COVID-19 outbreak. The order to kill 2,000 hamsters came on Tuesday after an employee at a local pet store tested positive for the coronavirus, along with several rodents. Since then, all pet stores in the city have been ordered to hand over their hamsters to be euthanized, and that's prompted scientists to weigh in from around the world, saying there is no evidence that animals play a significant role in human infections. Hong Kong has taken aggressive steps to control COVID-19 as part of China's zero COVID policy. Local animal shelters have reportedly been flooded with calls from pet owners seeking advice on what to do next. Well, coming up, remember the CEO who fired hundreds of employees over Zoom? Well, apparently he has re-entered the chat after being away for just 1 month. But how and why now? We're going to fill you in on the other side. We'll be right back. Welcome back to Yahoo Finance Live. Well, here's a story that is sure to get a lot of employees riled up again. The former CEO of Better.com, Vishal Garg, who became infamous, as you'll recall, Brad, for firing 900 employees over Zoom back in December, is reportedly coming back. In a letter that was reportedly sent to employees, the company's board of directors says Garg is returning to his full-time duties after using his absence to reflect on his leadership, reconnect with values that make Better great, and work closely with an executive coach. Brad, I'm curious to get your take on this, because as you'll recall, back in December when this happened, I mean, there was so much outrage, not just within the company, but outside, who said, look, this is just not the way to lay off employees. 9% of your workforce in one Zoom call.
Yeah, I believe the broader sentiment from anybody who read this story across social was just cringe when you think about the amount of different Zoom meetings that many of us had been going through over the course of the pandemic. And then for everybody who had made it to that point into December, and to have that really kind of, that kind of aware, or at least tone deaf approach, we should say, to understanding how this could be received, not only by employees, but also by clients at the end of the day, too, and customers who use the services of Better.com. And so it's also kind of coming with this broader fabric of what they were gearing up for, especially considering that there were reports, and at the time they were looking to go public. And so that is something that we've seen in the past, where companies are super cost conscious going into any type of public debut, whether it be a SPAC or direct listing or anything of the like. But again, just super cringe at the time when it happened. And we'll see, what's changed in his leadership strategy and his return now to the company.
Yeah, and it's worth noting that they've pushed off that listing since. And I think you're right when you use the word tone deaf, regardless of what was happening internally. The argument here is that that's just not the way to do it. And what we're hearing now is that Garg reportedly sent a letter to employees. So it wasn't just the board of directors. He sent in a letter to employees as well and apologized for the angst, distraction, and embarrassment that his actions caused. By the way, it wasn't just about the Zoom call. He also later accused employees of stealing from former colleagues and customers because they were unproductive. And he said they were only working about 2 hours a day. So a lot of damage control here. I'd be curious to see how much of the culture he can, or how much of the employees he can rally around him, because that's certainly increasingly a big part of employees sticking around is the company culture. And if you've got somebody at the top who is now known for taking these kind of actions, it's going to be a steep hurdle.
Right. It's an extremely competitive talent market right now. So retention is extremely key for this company. Yeah. I think a lot of employees have a little more leverage maybe once he steps back into that CEO role. Coming up, stay tuned for Yahoo Finance's COVID special. 2 years later, we're going to be speaking with top White House medical advisor, Dr. Anthony Fauci, about where the U.S. stands after the first COVID-19 infection in the U.S. was confirmed in Washington state just roughly 2 years ago. That is coming up after this short break. We'll be right back.
I mean, this has the potential to spread at a much more rapid rate, even if it's not as lethal.
So we just had this headline with respect to the CDC confirming its first case of the coronavirus in the U.S.
It's confirmed that one case from a traveler from China in Seattle has been confirmed just now by the CDC.
We went from being probably one of the most booming and productive economies in America, with cranes everywhere building new buildings and high unemployment, to an economy that is virtually shut down now.
We have therefore made the assessment that COVID-19 can be characterized as a pandemic.
To keep new cases from entering our shores, we will be suspending all travel from Europe to the United States for the next 30 days.
Our final numbers here will be below 23,641. That means the Dow enters a bear market.
Wait and see what happens is really the clear message right now from officials across the departments in the U.S.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. It was roughly 2 years ago today when the first COVID-19 case in the U.S. was reported. Test results in Washington state confirmed that case several days later. And over the next hour, we're going to be taking a closer look at the progress that has been made so far and the challenges that still lie ahead. I want to start, though, with where things stand right now. And Brad, these numbers really do tell this story. 334 million COVID cases confirmed globally, roughly 68 million reported in the U.S., and 854,000 people have died from the virus in this country alone.
That's right. And while the U.S. and the world still battles back against COVID-19, acceleration in scientific research, development, and production, they continue to offer a critical solution. These developments, they come in the form of testing to counter the spread of the virus and vaccines for protection against infection, plus the prevention of hospitalization and death. So in the U.S., by the numbers here, 209.3 million people have now been fully vaccinated, with 529 million shots total administered. And as variants prompt demand for people to know whether or not they have been infected, 3.4 million tests were still being administered on January 17th, 2022, roughly 2 years after the first COVID-19 case was tested for, Akiko.
You just alluded to that recent wave that we saw in infections. That's led a lot of people to say, why have we not seen the progress that we expected when the vaccines first came out a year ago? We had a chance to speak with top White House medical advisor, Dr. Anthony Fauci, about where things stand today and why some say progress has been slower than expected. Take a listen.
Well, I think virtually everyone thought that when we had a vaccine as effective and safe as the vaccines we'd have now, that we would get enough people vaccinated that we would handle the variant that we were dealing with, and that we would have a diminution of infection, not only in the United States, but hopefully, if we were able to get vaccines to the low and middle income countries, that we could also essentially get our arms around, as it were, the pandemic globally.
Want to bring in Yahoo Finance's healthcare reporter, Anjali Kamlani, who has really been on top of this story from the very beginning of the pandemic. And Anjali, you had that conversation with Dr. Fauci. It's not just about the vaccines, but it's also about the testing. A lot of people asking themselves 2 years on, why is it that it feels like we're kind of going at a slower pace in terms of progress? What more did you hear from Dr. Fauci?
Well, that really is part of it, right? And I posed the same question to him, quite honestly, because we also know that with the continued strain on access to testing, as well as masking, we know the Biden administration is set to announce N95s, and we've seen that upgrade push for masks. All of these things have been largely not communicated well in terms of what is unexpected and what was supposed to be unexpected. And with every turn, more doubt was sown, more frustration. And in addition, the focus on equity, and I think that has still largely lagged. We've seen, that it's still been really difficult to make sure that things are equitably distributed, or that the focus is on that. We see that with, the at-home testing right now. Reports saying that the White House is going to be looking at prioritizing the at-home test for lower-income individuals or areas where there's really seeing a surge. And so that really, is where we
we are 2 years later, where it hasn't been predictable in terms of when the waves will hit or how badly they'll hit, but we know that the waves are expected. And I think that kind of remains the bottom line here.
And Angela, I know you're sticking around for the hour, but I want to bring in our first guest here, Angela Rasmussen, University of Saskatchewan Vaccine and Infectious Disease Organization virologist. And Angela, you have been on our show throughout the pandemic, sort of giving us guidance as we sort of get the news. And Angela, just pointing to what we have seen most recently from the White House today, announcing that they're going to be distributing 400 million N95 masks. Also, that website for Americans to be able to get those free at-home COVID tests being launched overnight as well. How far does that go when you think about where we are today, the challenges that exist? How much progress can be made?
Well, I think it certainly is progress, considering that a month and a half ago, there was really no plan to deliver tests to people for free. People were going to only be able to source tests by getting insurance reimbursement for tests that they purchased themselves. There was no recommendation for wearing high quality masks. So we have made some progress. But as Angela pointed out, a lot of this has been communicated badly. And frankly, a lot of this response is too late. It's also insufficient. So 4 tests per household is really not enough for many households to actually give 1 test to each person in the household. And if you want to be using those rapid tests regularly to monitor whether or not you might be a risk for transmission to the rest of your community, 4 tests isn't really going to cut it, even in a 1-person household. So I think that there's still a lot more that the government could be doing in terms of giving people the tools to monitor their status and to keep themselves, their families, and their communities safe.
Let's also talk about the deployment of new N95 masks as well. The administration promising free masks, the timing of this, again, coming well after much of the PPE and that personal protective equipment was really being looked for by many households and individuals. And so even as it continues to go out with some of the variants of concern right now, notably Omicron and Delta still as well, what is the effectiveness that the White House is seeking to have with much of the deployment of those masks even now?
Well, I think it's pretty clear that masks are helpful in reducing transmission in the community. And certainly N95 respirators are more effective than a surgical mask, a medical mask, or a homemade cloth mask in particular. While all masks provide some benefit in the form of source control, which is effectively preventing people from exhaling potentially infectious particles into their environment, the N95 respirators provide protection for the person wearing them as well. So they prevent you from inhaling any virus particles that might be floating in the air as aerosols in the space that you're in. And they certainly do make it safer. Now, previously during the pandemic, we weren't able to do this or to make this recommendation because healthcare workers need those N95 respirators since they are working in such a high risk environment. But now that we have a surplus of those N95 respirators, I think that getting them out to people for free, since cost is certainly a barrier to using those high quality face masks, is a really good move. And I think we need to make sure that we can keep these respirators in people's hands as they start to return to work, as they return to school, as they return to living their lives outside of their homes once this wave passes.
Angie, I wonder, from your vantage point, I see that there are, 2 camps essentially out there. One saying, with Omicron, there are signs that this virus could be less fatal and just something that we can live with. And others are saying that that doesn't necessarily make sense chronologically. It doesn't mean that the next variant of concern is not going to be really of concern, can escape, vaccine protection, et cetera. How do you see this playing out, especially for how we should consider what 2022 is supposed to look like?
Yeah, I think this discussion about whether Omicron is milder can lead to some really harmful places. So it is certainly good news that in people who've had a prior exposure, prior infection, or have been vaccinated and ideally boosted, do tend to have a less severe disease caused by Omicron if they have a breakthrough infection. And I should add too that while boosters can't completely protect somebody from getting infected with Omicron, they certainly reduce the risk of being infected. So they do reduce infection, they do reduce transmission. It's really important to get those boosters. But there are still many, many people in the US, 40% of the population roughly that's eligible, that have not been vaccinated. And I'm not convinced that Omicron is actually milder in those people. And of the people who are being hospitalized, we are seeing the unvaccinated, again, having the most serious and severe outcomes. Furthermore, people who have been vaccinated who get Omicron don't necessarily, they might not die, they might not be hospitalized, but that doesn't necessarily mean that it's mild. Certainly people have taken a long time to recover from having a so-called mild case of COVID that doesn't require hospitalization. So the best thing that we all need to be focusing on is doing everything that we can to reduce prevalence in the community. That means wearing masks, taking precautions, and getting vaccinated and boosted. As you pointed out, Anjali, there is certainly a possibility that new variants will emerge. Worldwide, there are still 3 billion people who have not gotten any doses of any vaccine. So that's certainly fertile ground for new variants to propagate and emerge into the rest of the population. And frankly, we may not be so lucky next time. If it's significantly different than Omicron or any of the other variants that have circulated before, there's certainly the possibility of more breakthrough infections, and there's certainly the more possibility of a variant that is more pathogenic.
On the transmission part and getting it to a low point, I know there's lots of discussion now about the endemicity, tongue twister there, on this virus. But I wonder, looking back, I think initially, so much was unknown about how quickly the virus would mutate and whether or not it would be concerning mutations. 2 years later, what do we know about, and how did we get to the point where we're talking about endemicity versus getting rid of this virus altogether?
So frankly, I don't think that elimination is going to be possible with this virus. This virus infects a number of different animal species. This is actually one thing that my lab works on. And even if every human being on the planet was vaccinated, there's still potentially susceptible hosts in the form of other animals that this virus could get into. So endemicity is really what we're talking about. But I don't think a lot of people really have a good understanding of what endemicity means. Endemicity doesn't mean that it's milder. It also doesn't mean that it's spreading like crazy either. It means that there's a regular and predictable level of spread. So if we get to the point where the global population has reached population immunity, even if new variants that are emerging can infect people who have been vaccinated or immunized, that doesn't necessarily mean that the virus is just going to be spreading among them as if it were spreading through a susceptible population. As I mentioned before, even vaccines that aren't completely protective against infection do reduce transmission. And part of the reason for this is that they may not be able to stop the infection altogether, but they do reduce the amount of virus that a person is shedding. They reduce the length of time that a person is infected. And at population level, this significantly reduces transmission. And we've eliminated effectively or gotten to very, very low endemic levels of many viruses using vaccines that weren't completely sterilizing, meaning they didn't completely protect against infection. So I think that's what we're looking at with endemicity. But again, as long as a third of the human population remains unvaccinated and 40% of the US population remains unvaccinated, this is something that we're going to continue to see. We're going to continue to see epidemic spread of SARS coronavirus 2 variants like we're seeing with Omicron. And that is not a constant, predictable level of spread. That is a huge surge in new cases that can potentially overwhelm healthcare systems. So endemicity is really the goal, but to get there, we need to both reduce the amount of virus that's circulating in the human population and make humans in general less susceptible to being infected by vaccinating and boosting everybody that we can.
Angela Rasmussen, University of Saskatchewan Vaccine and Infectious Disease Organization virologist. Thank you so much for joining us and breaking all of this down for us. We really do appreciate the time here on the day. And continuing forward with our special, everyone, coming up, top White House medical advisor Dr. Anthony Fauci joins Yahoo Finance and explains where the U.S. stands after the first COVID-19 infection in the U.S. was confirmed in Washington state roughly 2 years ago. That's next.
Welcome back to Yahoo Finance Live. I'm Anjali Kimlani. We're looking at 2 years of the pandemic today as we enter year 3, still looking at the pandemic making its way across the country as well as the globe with new variants to worry about. I had a chance to talk with the director of the National Institutes of Allergy and Infectious Disease, Dr. Anthony Fauci, also the White House Chief Medical Advisor, about these 2 years, looking back on everything that we've achieved and what more is yet to come. Take a listen.
Well, I think virtually everyone thought that when we had a vaccine as effective and safe as the vaccines we'd have now, that we would get enough people vaccinated that we would handle the variant that we were dealing with, and that we would have a diminution of infection, not only in the United States, but hopefully, if we were able to get vaccines to the low and middle income countries, that we could also essentially get our arms around, as it were, the pandemic globally. The things that were not anticipated was the extraordinary capability of have multiple sequential waves of new variants that were very different in their characteristics. The Delta variant, which just exploded in India and then spread to the rest of the world, not only with its high degree of transmissibility, but also with its ability to induce significant illness in a substantial proportion of people, hence the large number of hospitalizations and deaths that we've experienced in this country and worldwide. And then to be, in many respects, unanticipated, to have a very bizarre and very different variant in Omicron superimposed upon the Delta variant that was starting to rescind. I mean, that's sort of like a double whammy punch in the head that you would get. That, I mean, obviously we were anticipating that there would be challenges, but there are a lot of conflating issues that made this a very, very complicated year. The number of variants, the escape from infection, from protection from infection, which I think is something that people need to understand better, that the vaccines, even though we want to get more people vaccinated than we have right now, if you are vaccinated and boosted, the chances of your getting seriously ill, hospitalized, or dying is substantially less if you're vaccinated versus unvaccinated, which brings us to the next confounding issue of where we are right now in the United States, where we have 63% of the total population vaccinated, which means 37% are not, where we have 72% of the adults vaccinated, which means 28% are not. So we have a highly effective, safe intervention that a substantial proportion of the population has not made use of. That is complicating our response to an already formidable challenge from a very evasive virus.
Certainly a little bit more evasive than you probably initially anticipated or were just not sure of from the start, which brings me to the point about the vaccines too, is the boosting. I know we've talked about boosting and getting that third dose for mRNA and the second dose for Johnson & Johnson. There are also a small pocket of people holding out for other vaccines, as well as a new report showing that maybe a fourth dose is not necessarily effective. And I know you've talked about waiting to see how long the protection lasts. And so I just wonder, these two sort of different issues at the same time, also adding, to the problems, people not being sure, as well as maybe waiting for other vaccines. Can you talk us through that, how you're viewing all of that when it comes to trying to encourage the public to get vaccinated?
I mean, obviously, this is the reality of the real world that we're living. It just seems rather unusual that people are waiting for something else when you have vaccines that have been given to now 9 billion people, or 9 billion doses of vaccine, when you have billions of doses throughout the world, hundreds of millions of doses in the United States of a vaccine that is incontrovertibly proven to be highly effective and safe, not in thousands of people, but in billions of people. So I'm not sure what people are waiting for when you say they're waiting for something else. the idea about a fourth dose, and I've said it before and I'll repeat it, is that we want to wait to see what the durability of protection against significant disease is with the third dose. So if you get breakthrough infections, which we are seeing with Omicron, with the vaccine and the third dose, the boost, if you're getting infected and you're either asymptomatic or minimally symptomatic, you may not need a fourth shot as long as you're protected against significant disease. And that's what I mean when I say the jury is still out as to whether or not we need a fourth dose. We might, it's entirely conceivable that we might, but I think before we rush to a fourth dose, I would be careful to see what the result of the third dose is. However, there's an exception to that. And the exception is in immune compromised people who very well may not have had a good response or any response to the prior vaccinations. We know now that when you give an extra boost to an immunocompromised person, someone who has a transplant or is on cancer chemotherapy or immune suppressive therapy for autoimmune disease, that you not infrequently can get them back up to a reasonably good level. So that's the exception. But for the rest of the generally normal population, I think it's important for us to see what the durability of the third dose of an mRNA and the second dose of a J&J is.
Absolutely. On that point, we know that there's some, especially in the finance world, the discussion is starting about whether or not this will become endemic by the end of this year. Meanwhile, I know that there are some cautioning that just because Omicron is quote unquote milder, even though that I know comes with multiple asterisks attached to it, that there could also be another variant that comes out in the meantime before we even get to fall of 2022. I just wonder if you can give us context on how we should really be thinking about the rest of the year.
Yeah, I think it's really prudent to look at it as the best case scenario and the worst case scenario. You hope for the best case scenario, but you get prepared for the worst case scenario. So the best case scenario would be that as we get into the months of 2022, that you get a combination of enough people vaccinated and boosted together with people who are infected and recover and have a degree of immunity. Hopefully they'll wind up getting vaccinated too. And you have a virus, a variant that has a lesser degree of pathogenicity where it infects a lot of people, but not very many people, relatively speaking, proportionally, get severe disease. Then you could get down to a lower level that is low enough that it doesn't disrupt society, nor create a greater risk that someone will get seriously ill. You will always get people with any viral infection that has any capability of pathogenicity, even though we accept it from year to year, like respiratory syncytial virus, parainfluenza, adenovirus, influenza, it doesn't really disrupt society because for the most part, it's a relatively benign disease in most people, even though there's always the risk of some getting ill. If we can get SARS-CoV-2 and COVID at that level, that would be the best case scenario. The worst case scenario is we're on our way there and we get hit with another variant that actually eludes the immune protection. I hope that's not the case. The thing that makes it less likely, but not impossible, is that by that time you will have so many people vaccinated and or already infected that you might have a level of community protection that may not get you away from the next variant, but would protect you from the severity of the next variant.
Messenger RNA, or mRNA as it's more commonly known, has been at the forefront of accelerated COVID-19 vaccine research and development amid the pandemic. One company even has it as its ticker symbol, that company being Moderna. Michael Yee, managing director at Jefferies, who covers this company, joins us now. Michael, good to have you here with us on the day. An inflection point for Moderna as a recognized name across the population, but how do you anticipate that it will translate into future growth for the company going forward?
Well, it's great to be here, and thanks for having me. I think there's a couple things to say. First is, 2021 was a spectacular year, obviously, for the stock. Really, came to the forefront and made global headlines. And I think the stock went to $450 and was widely appreciated in 2021. What I think in 2022 is that the overly high expectations and significant valuation is going to lead to challenges in 2022. And I think there's going to be a lot of money flow out of this name as people digest what's next for the company beyond COVID vaccines. And I think that's always going to be a challenging step for biotech.
Yeah, Michael, on that point, we've certainly seen it come in waves in terms of how the stock has moved. And we're looking at $179 a share right now. To your point, we've seen a bit of a pullback, but what do you think is fair value right now? If you consider just how high the valuations have run up and you think about the pipeline for Moderna, how close are we to that fair value?
Yeah, without getting too technical, what I would say is the stock's currently trading around an 80 billion market cap at current levels. They do have 25 billion of cash. So, still about 60 billion of enterprise value, which in our world, if they're going to do 10, 15 billion dollars a year is still, 4 or 5 multiple on it, which is generally where people like to put things. That said, the problem is that type of multiple reflects future certainty of those revenues being sustained. And if you look at the consensus numbers over the next few years, people still have the vaccine revenues falling. I think it is rational to believe that vaccine revenues will fall. So what I'm saying is, look, I think it's definitely plausible that this stock can go to 150 in the short to medium term as money flow continues to come out of this name and as people figure out, again, what is the next catalyst to really get this up.
Michael, Angela here. I know that the company is focused on a couple of different avenues, whether it be vaccine or treatments, but looking at mRNA specifically and the explosion of success that it has had throughout this pandemic, where do you think Moderna sits in terms of that success? I know you don't cover Pfizer, but they're the only real competitor at this point in time. We do know other larger companies are coming up behind as well, and there's a lot of interest right now. Does that factor into what you see as sort of the downward trend for the company's outlook?
I'm not too overly concerned about competition and other people coming around. To Moderna's credit, have been working on this for a decade. We got to give them credit, as well as BioNTech, Pfizer, for really blowing everybody away, including the big guys like J&J and AstraZeneca, for coming to the forefront within 12 months and coming up with this vaccine, high-end efficacy, manufacturing without a slip-up, and getting this around the world. And I know Dr. Fauci was just on, and a great testament to all that they have done together. But going forward, I'm really concerned more about what is the next product. Now, they had some flu vaccine data recently that was good. It didn't blow people's expectations away. And I really think caution people to wonder, is the platform overall really just the best thing for every application? Or was it great for a COVID vaccine, but is it going to work in cancer? Is it going to really be great in flu? Is it going to work in cardiovascular? And I think that's going to take some time to play out over the next 12 to 24 months. There's some data, not a whole lot of data. And I think, again, it's going to take some time for that to work out. So that's really where I think about the next leg. And it's really beyond what the platform can do as a technology, not necessarily so much the competition.
Michael, while we have you, absent purchase orders from governments or entities around the world for Moderna, for the broader acceleration that we've seen them come forward with in a solution such as the vaccine and all of the different ways that that could be kind of developed into some of the other products and solutions that you were mentioning a moment ago. Even for this COVID-19 vaccine, if we are entering into, as we've continued to discuss, the potential of an endemic and what that means for healthcare coverages, also kind of pricing in what the price looks like for a vaccine going forward. You know, where do analysts, where do investors kind of get the best sense about where that will continue to contribute on an ongoing basis?
I think it's a big debate, but I will tell you that the COVID vaccine endemic portion, realizing we'll only get one injection, not two, realizing that not everyone is going to get a booster as everybody did around the first time around, and realizing there's plenty of supply, and I would argue not many countries are going to order as much in the future, that the tail of the revenues will be probably half of where we are today for a variety of reasons, including you only need one, not two, and there's other players out there and not everyone's going to order, but that they do want to do a combination. So what I think is the most interesting value proposition is that they will try to combine the COVID vaccine with the flu vaccine. And the flu data was good, but not super great. And if they could combine that, that would allow you to get two things in one: higher end efficacy, all simple, very easy, and with some price and premium. So I would just like to, focus some attention on that. I do think that, again, the flu data is evolving this year, and that is really sort of, in my opinion, where they are trying to evolve with the vaccines over the next couple of years.
Yeah, Michael, feels like a strong warning for investors to say, set your expectations more realistically. It's not going to be the same as what we've seen over the last 2 years. It's always good to have you on the show. Michael Yee, Jefferies Managing Director, joining us there. Well, coming up, we're talking about the global response to COVID-19. We are breaking down how world leaders are handling the pandemic as experts urge vaccine equity. We'll be right back.
We won't end the virus this year. We may never end the virus. These viruses, pandemic viruses, end up becoming part of the ecosystem. People talk about pandemic versus endemic. This word endemic. Endemic malaria kills hundreds of thousands of people. Endemic HIV. Endemic violence in our inner cities. Endemic in itself does not mean good. Endemic just means it's here forever.
That was the World Health Organization's Dr. Michael Ryan speaking at virtual Davos, the World Economic Forum, about where things stand today. And Anjali, there's an interesting discussion here as we've been so focused over this hour on what's happening in the U.S. Sure, there are more and more people getting vaccinated globally. It's at more than 60% right now. But there is an increasing divide that we're seeing between the developed countries and the developing countries. And I wonder if you can touch on that, because that's something that we have been speaking about for the last 2 years, but haven't necessarily seen significant progress on.
That's right, Akiko. And really how this all got to the point that we're seeing it, you know what they say about best laid plans? That's sort of what happened here, despite the efforts of large philanthropies, despite the efforts of UNICEF, the World Health Organization, Gavi, creating that COVAX facility, getting some of that interest in finances and fundraising, and being able to get on board these countries who are willing to wait and participate both in distributing, the vaccine doses as well as being recipients. All of that really just fell apart. And it was a combination of, really multiple things. It was a combination of manufacturing errors. It was a combination of the Delta variant hitting India and really forcing the largest manufacturer to turn inwards domestically for distribution. It was just so many different things that sort of piled up one on top of the other that led to the point where we are now and let those variants come to light. And I feel like that's sort of where the focus is right now, is looking back and trying to mend the ways and ask of these mRNA companies that didn't really see, themselves playing as huge a role in this pandemic, suddenly having to rely on them so much more. And it was just, a lot of that is really what came to the head that we're at right now. I think is where most experts have landed.
I think it also highlights, with all of the different responses that we've seen around the world, when met with a new variant, as you were mentioning, Anjali, what the response looks like. And if you're building a response at the same time that you're trying to build a reopening, and where the general population is also heeding to the guidance of the health administrators and the health officials within those countries, and ensuring that they have the necessary, everything from personal protective equipment all the way down to ensuring that they have the necessary vaccines to inoculate against whatever that new threat is, to make sure that the detriment that was incurred early onset in the pandemic does not have to be lived through once again. And that's something that we're going to be continuing to track as each country has their own response mechanisms as well that they roll out.
Yeah, no question about that. Anjali, stick around here. We've got much more to come here on our special, looking 2 years on from that first confirmed COVID case here in the U.S. On the other side of the break, though, we're going to be doing a quick market check as we see all three major indices firmly in the green. We'll be right back.
Well, the Nasdaq was on course for correction territory earlier, but could it be marking a comeback here? Yahoo Finance's Jared Blickery is standing by with a check of the markets. Jared, good to see you.
Good to see you, Brad. Rocking the turtleneck game. I got some competition here. Watch out for that in the coming weeks. But I want to go to the Wi-Fi Interactive, where we have a little bit of relief in the bond market right now. 5-year T-note yield backing off down 4 basis points. And as we've been talking about, it's been surging recently. You can see the same thing in the 10-year T-note yield and also the 30 down a little bit less here. There's the 10 down 3 basis points and the 30 down 2 basis points. But let's get straight to the action. And you look inside the market, a little bit of a defensive setup for the day. We got consumer staples, followed by communication services, and then utilities, and then materials. So here's the story of what's going on. So we got that defensiveness in the staples and utilities. Communication services, one of the worst performing sectors of the year. Here's a year-to-date chart. You can see it's down 1.5%, but some names like Facebook, Alphabet kind of flagging there. So what I've noticed is some of the love that a lot of these sectors have been getting, like energy and financials, not so today. And instead, that love is going to a lot of the beaten down sectors. So here's my leaders sentiment indicator. We have KWEB, that is a Chinese ETF, up 2.23%. That's in the upper left. IGV is a software ETF. Then we have the ARC components. And then also on the top line, we have IPOs, solar energy, gambling. So a lot of these sectors that have been beaten down, just getting a little bit of a pop here. So it's kind of feeling like a dead cat bounce, but too early to see. Got to touch on the banks here. Just a quick check of Bank of America and Morgan Stanley, two of the few names in the green after reporting earnings. Morgan Stanley, the leader here, up over 1.5%. And also checking out the software sector. So software, as we've been talking about, has been beaten down, and we can see a lot of money flowing into it today. Here's Take-Two up 8%, HubShop up 4%, CrowdStrike also up 4%, along with Teladoc. So a little bit of a bounce back, but I think it's a little bit too early to say that we've gotten the all clear. And before I go here, let's take a look at Bitcoin, up about 1%. Tossing it back to you, Brad.
All right, thanks so much, Jared Blickery of Yahoo Finance, giving us the breakdown on the markets here with quite a bit of time left in trading here at about the midway marker. We'll continue to track that, as Jared will as well. Guys, coming up, the Biden administration ramps up free at-home testing today. But is it too little, too late? A doctor joins us next to explain the steps the president can take to counter the pandemic. Straight ahead.
Well, Americans now have access to free at-home COVID tests for the first time in this pandemic. The White House launching the website covidtest.gov, allowing people to order 4 at-home tests for each household. All of this comes as the testing sites continue to be plagued by long lines and delays. Let's bring in Dr. Eric Topol, Executive VP, Scripps Research Institute, and Director and Founder, Scripps Research Translational Institute. Doctor, it's good to talk to you today. So the website is up. That's the good news. Most who put the order in for those tests will get it for another week, potentially 12 days. How much of this is too little, too late?
Well, yeah, of course it is, but you got to give them credit. Finally, they came through. There's a lot of reluctance to do this, and it's just a start. It's associated also with tens of millions of N95 masks that are going to be distributed through pharmacies. It's something that we've been asking for a year, but at least we're seeing some response. And since the pandemic is far from over, this will help over the long run, over the year that we have to deal with this, at least for the months ahead.
Dr. Topol here. I know that, there was a lot of criticism of the prior administration, but there seems to be a lot building up for the current one as well. When it comes to responding to this pandemic, the U.S. seems to be either woefully behind or unable to really clearly message. I just wonder, looking back on 2 years, how do you think we're faring? Have we caught up at all?
Yeah, this is a really serious issue that I wrote about in Science yesterday. We have profound data deficiency here, and there hasn't been one word uttered by this administration in all their public addresses that they intend to fix it or even recognize that it's such a serious issue. We should know right now whether boosters are protecting from Omicron hospitalizations, and also whether the time, from a booster is significant, an issue, and so many other things that we should have that data, but we rely on other countries. In addition, there's a lot of infighting among the public health agencies. And if we had a secretary of HHS who was actually active, who showed up, we would have much better mediation, a single, unified, consistent messaging, whether it's for boosters or for high quality medical grade masks or for isolation guidelines. We have so much inconsistency. We must do better.
And so you've written about this extensively as well, including the things that the White House and President Biden cannot control: opposition to vaccines, masks, science, and main defense tactics. But what are some of the things that are in the control of the administration that you believe, even as some of the Senate Democrats and congressional Democrats are calling on more from the White House to come forward?
Right. Well, a really important question. Perhaps the biggest one, which obviously would have been ideally put in place on day one, was to block the misinformation and disinformation, anti-vax, anti-science, anti-mask, anti-mandates, everything. And that would have been needed a very aggressive team that every day debunked all of this, the lies, distortions, and falsehoods that are essentially having tens of millions of Americans not get vaccinated. So that would have helped. It still would help because we have such a large number of people in this country, so far different than most other countries now. We're over 60th in the list of countries as far as their population vaccinated, and similar in terms of getting boosters. So an aggressive counter aggression to all the anti-vaccine and a hall of shame every day to do fact checks, to name the names of the people and the organizations that are putting out this anti-science work. That would help. Obviously, we finally are seeing the promotion of high quality masks. The testing is a real debacle since day one of the pandemic back in 2020. And hopefully we're starting to see inroads to fix that.
Dr. Topol, really quickly on the booster point, we've seen one study out of Israel saying the 4th dose isn't as effective. We also know that Omicron is breaking through for that 3rd dose. What are your sense of more vaccine doses needed this year?
Yeah, this is really important. The public has a misread about the Omicron booster effect. it's really important to stress that it's a 90% reduction of hospitalizations with the booster, 90%. And perhaps after 3 months, it gets down in the high 80s, but that is excellent. That's as good as 2 shots were against the original strain of the virus. Now, yes, there are lots of breakthrough infections, but that's a different matter. So we are so vulnerable because our booster rate is very low. Now, the question you asked is about the 4th shot. The 4th shot in Israel, from the preliminary data in healthcare workers, it's only a few hundred. It doesn't show a lot of effect on reducing infections. But what we don't know is whether that 4th booster, if someone is now 4 months, 5 months out from the original booster, whether that's going to help to prevent hospitalizations, deaths, severe disease. That data isn't available yet. We'll know that in the weeks ahead.
Yeah, that's some sobering numbers there. Doctor, it's good to talk to you today. Dr. Eric Topol, Executive VP, Scripps Research Institute, and Director and Founder. Our thanks to Anjali Kamlani as well for joining in this hour as we look back 2 years since that first COVID case was confirmed here in the U.S. As we let you go here, we take a look at the markets. We're seeing all 3 major indices in the green right now, coming back off of the lows. The Dow up about 41 points. Much more to come here on Yahoo Finance Live. Keep it right here.
More market volatility as big banks wrap up quarterly results and the Nasdaq slips into correction before turning it around. But what lies ahead and what impact do yields have on equities as a 10-year touches 1.9% before retreating? Our analyst weighs in. Today, the White House officially rolls out its website for Americans to order free at-home test kits on the 2-year anniversary of the first case detected in the U.S. Separately, the Biden administration poised to make hundreds of millions of N95 masks available at no cost, Well, across the pond, Prime Minister Boris Johnson announced plans to drop the mask mandate. Why the divergence? We'll ask a medical expert. And as soaring inflation persists, putting money in the sock drawer for retirement is getting harder. What should you do now to make sure your dollar goes further later? We ask an expert how you should be funding your future. Welcome, everyone. Thanks for joining us. I'm Karina Mitchell, along with Alexis Christoforous, on this very choppy trading session on a Wednesday afternoon. Alexis, market seeing some decent upside on bank earnings earlier in the day, but that fizzled, and now they're flat. It's enough to make your head spin.
Volatility with a capital V on Wall Street once again, Karina. Stocks, as you mentioned, higher now across the board with some modest gains, reversing an earlier sell-off. So pairing the losses that we saw earlier today, and of course we had that broad sell-off yesterday. Investors continuing to eye those soaring bond yields over in the Treasury market, and we've got mixed earnings results from some big name companies today. We're going to dig into those in a moment. The Dow up now 41 points, the S&P gaining 13, and the Nasdaq snapping back up 68 points. Earlier, it had crossed that threshold into correction territory, having fallen 10% from its recent high. Let's take a deeper look inside the Dow for a moment, though, because what's helping to give the Dow a strength right now, in fact, most of the gain we're seeing right now is because of Procter Gamble. The stock is up more than 4%. The biggest gainer here after a better than expected earnings report. And by the way, we are going to speak with P&G's new CEO, John Moeller, a little later in this hour. He's going to talk to us about inflation, supply chain issues, and how consumers are dealing with higher prices at the grocery store. We've also got some strength in Microsoft, Walmart, Salesforce as well. On the downside, though, perhaps no surprise, we've got Caterpillar, American Express, Boeing, Goldman Sachs, and JP Morgan lower for a second straight day here after a mixed bag of earnings results from some of the big banks. Treasury yields building on recent gains. The benchmark 10-year yield pulling back a little bit, was at 1.9% a little earlier, now at 1.84%. Get a load of the 30-year yield, now at 2.16%. Also, commodity prices higher as well. Let's check in with Jared Blickery now for a closer look at the markets. And Jared, I guess we're going to start with the tech-heavy NASDAQ. It could be looking at, given the volatility today, a close that would put it in correction territory.
That's right. And no particular significance to this number other than it's a big round number. So just to go over that real quickly, you take the closing high of the NASDAQ and then you multiply it by 0.9%. So you get that 10% down. And then you need to close under that level. And that's when the media generates all their banners. And that's about all you get. But it is meaningful in a way because somewhat self-fulfilling there. We haven't had a correction in the NASDAQ in some time. So let's check out the sector action on the Wi-Fi Interactive, where we have communication services up the most today, followed by staples. That's a Procter & Gamble story, then utilities, and then materials. And it's materials where I want to kind of focus on now because the commodities market is running hot. And I'm going to go specifically to gold miners. And we can see these guys are popping today. And that's as gold is having its best day in a month. And you can see some of the gains there. AG, that's a silver miner. Let me put a one-year chart. A lot of these names haven't done much since that big pop we got in silver 2 years ago. That would be the third and fourth quarters of 2020. So these names finally finding some love here after being beaten down for a while. And by the way, that's kind of the theme of the day here, because a lot of the beaten down sectors and styles, those are what are bouncing back today. So it kind of leads to the question, is this a dead cat bounce? We don't have enough information for that yet, but it kind of feels that way to me so far. So up at the top, we have KWEB, that's a Chinese ETF, followed by software, then the ARC components. We got IPO, we got some gambling ETFs, emerging markets. So whatever has been beaten down kind of coming back today. Also want to hit the travel sector because Southwest Airlines just announcing that they are canceling 15 flights, and that's due to 5G concerns. We've been talking about that story that seemingly arose overnight at the last minute, but you got to imagine these air carriers and the FAA exercising an abundance of caution here. Elsewhere, let's see what else we have. We want to check out those commodities because the metals, as I was saying earlier, have broken out. It's not just gold. Palladium is at the top of the list. That commodity is up about 5%. Then we have platinum, also up 5%. And these charts kind of look like those gold miner and silver miner stocks that we were looking at before on a 2-year basis, just kind of chopping around, going sideways here. But as we know, the commodities market has been heating up recently, so that's something we want to keep an eye on. And finally, have to check out the price of Bitcoin, and we can see it is up 1.5% over the trailing day, and also so is Ether, up 1.25% there, guys.
Good to see in crypto having an update. Okay, Jared Blickery, we'll see you in a bit. Thank you. We'll keep it on the markets and bring in our markets guest, James Liu, Clearnomics founder and CEO. James, thanks so much for joining us. Another head-spinning day in the equity space. And I just want to start off by getting your sense of what's going on in the markets. You know, typically heading into rate hikes, equities actually perform quite well, but there is so much volatility. What are investors concerned about? Are they worried that the Fed is going to go too fast, too soon, or not do enough?
Hi, Karina. Great to chat with you. Well, to use a pandemic analogy, the Fed is preparing to vaccinate the economy against inflation. And we're basically seeing the market have this prolonged side effect as it adjusts to that period. And the reality is that that adjustment period will eventually wane. You know, at this stage in the business cycle, it's less about the level of rates than about the shock in interest rates. And that shock eventually will wear off. And we basically saw the same story last year in the first quarter when the 10-year jumped up quite a bit from something around 0.7 to 1.7%. And you basically have that exactly today. You need a period where the market gets used to the fact that the Fed may have to accelerate interest rates. Now, I think what compounds this and what makes investors even more nervous is the fact that the Fed has basically been behind the curve this entire time. And so now they're catching up to what many economists and investors had been thinking about and calling for in terms of fighting inflation. So that's only happening now. But overall, we think that eventually the market settles down here. The rotation underneath the surface will continue to happen between growth and value, and therefore sector positioning is very important. But from an overall index perspective, we still like U.S. equities here at this stage in the business cycle, and we think international stocks are also very attractive.
Yeah, I'm glad you brought up international stocks, James, because I want to expand on that a little bit. You know, emerging markets tend to be overlooked by lots of U.S. investors, and I'm wondering if this is going to be the breakout year for those EM markets, and if so, where should investors be looking to pour their money?
Yeah, Alexis, that's a great point. You basically had almost a 10-year period where U.S. stocks just did really, really well year in, year out for most of the last cycle. And that was generally because the economy was just growing really steadily. The U.S., as the engine of world growth, was doing really well. And, you know, there were signs that that could potentially change. It's only been a couple weeks to start this year, but emerging markets are outperforming other regions. And there's also the notion that they should catch up to the rest of the world because they've been lagging behind with the pandemic response. And so the benefits that we've seen in the U.S. and even parts of developed markets over the last 2 years, we could potentially see that with emerging markets, not just over the next year, but over the next few years as they catch up there. So overall, you know, the point is not to kind of dive deep in all at once. The point is to have that proper asset allocation where you're not ignoring emerging markets or developed markets, but you're holding a nice allocation alongside U.S. equities, you know, to balance all the different regions.
And James, you know, big banks just wrapped up their earnings outlook, and one of the overarching themes was more operating costs, bigger expenses, wage inflation. Yesterday, we heard 33% from one of the big banks. So is that a narrative that we hear going forward into the rest of earnings season? And then how does that affect profit margins? We saw P&G come out with earnings today and said the way they're handling it is they're raising prices. So far, the consumer is accepting that, but how long does that continue?
Yeah, I think what really helps is that consumers are still in a strong position. But you know, you kind of hit the nail on the head. The question is, do we get some sort of wage price spiral? From an inflation perspective, that is the concern for economists and the overall market. And right now, the answer seems to be no. I mean, that's the difference between today versus, you know, the 70s and early 80s, where inflation got out of control and it became baked into expectations, and it got out of hand in terms of what the Fed could basically do without inducing a recession. Today, you know, if you think about inflation, it is still very much the case that inflation is high because of year-over-year comparisons and because of supply chain disruptions, not necessarily because of monetary policy. Now, if that goes on for much longer, it could be baked into wages and cause a wage price spiral, but that's really not what most forecasts are calling for. They're calling for inflation to start to temper and to start to maybe fall by the second half of this year. Again, it's hard to predict because it's due to supply chain disruptions, but that's really the expectation. And if that's the case, then inflation could stay higher than average, especially compared to the last cycle. But it's not something where, we need the Fed to dramatically accelerate interest rates and Fed fund rate hikes in order to try to combat it.
And James, what are you doing with tech right now? Tough start to the year, and especially with regards to mega caps like the Amazons, the Metas of the world. What are you doing with these stocks?
Yeah, I think the challenge in tech, Alexis, is that it represents a number of different themes and a number of different trades. I think the initial reopening trades, the work from home trades, all those were very much long in the tooth, even the second half of last year. The things that worked before will probably not work going forward, right? The momentum factor that we saw work really well in 2020 and the first half of 2021, that's already started to reverse. And so looking forward, the parts of tech that should do well are those with just long-term secular stories about, digital adoption and things like that. The problem with tech also is that valuations are high. So at this point, it's very much a case-by-case, stock-by-stock story, not an overall sector story. And instead, what we would prefer, if we look at it from a sector perspective, are the more cyclical sectors that will benefit as interest rates are rising, as the economy continues to grow into the sustained expansion. So, obviously areas like energy have already done well this year, but you have areas like industrials, parts of the economy that will do well as we enter this middle phase of the business cycle with the normalization of Fed policy. Those are the areas we would rather be in, rather than simply investing in the things that had worked and the places where valuations are already very high.
All right, definitely a lot of cherry picking that has to go on this year compared to last. We will leave it there. James Liu, Clearnomics founder and CEO, thanks for stopping by today. And we want you to help step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. You can check it out today at yahoofinance.com/plus. Coming up, could the end of the Omicron wave be in sight? We'll find out ahead.
Some encouraging news today on the COVID front. The Omicron wave is starting to recede in parts of the U.S. that got hit with the variant early on, including Boston, New York, and Washington, D.C. And in the U.K., where Omicron has peaked nationally, Prime Minister Boris Johnson has lifted mask mandates in public places. Here to weigh in is Dr. Bhavna Lal, clinical assistant professor at the University of Houston College of Medicine. Doctor, thanks for being with us. I'm sure you also saw that the World Health Organization said that globally COVID cases slowed last week compared to the prior week. Are we near the end of this Omicron wave? And would also just like to get your thoughts on what's happening in the UK. Is now the time to be lifting that mask mandate?
So thanks so much for having me, and great questions. This is what we are all watching really carefully. First of all, I don't think this is the right time to be lifting any mask mandates. When you see a fall, this is when you have to be really careful and see how slow or fast the fall is going. This is not the time to be taking off the brakes on any mitigation measures. And yes, there's many models show or predict that we could be seeing a decline in Omicron cases towards the end of the month, early February. But again, the US is a large country, and just because we're seeing cases peak on the East Coast does not mean that we're going to be seeing that at the same level throughout the country. So for example, in Texas, where I am, we have a growth of 430% in cases, and many other states as well. And given that we're going to be seeing an increase in cases in other parts of the country, we're also going to be seeing the deaths also rising as well as the cases or the peak comes down. And whether the peak comes down fast or slow, it's all dependent also on different populations in the country. And as you know, there are places in the country that have different vaccinated individuals, different populations that are vaccinated and unvaccinated, and also great disparities in chronic diseases throughout the country, risk factors, et cetera. So hopefully the end is in sight. At this point, it's hopeful, but there's a lot of speculation, and we have to continue mitigation measures such as continuing vaccinations and boosters, masking, quality masking, and with N95s, KN95s, KF94s, and also improving ventilation and making sure that we have social distancing measures in place as well, and workplace safety.
Dr. Lal, I wanted to ask you, the WHO just came out yesterday with a statement saying there is no clear evidence that healthy children and adolescents need to get a booster shot. Of course, the FDA has approved that shot for 12 to 15-year-olds, the Pfizer, to get a third shot. I was wondering what your reaction is. And then tied to that, the UK, in Boris Johnson's announcement, he also said that effective immediately, starting tomorrow, I believe, school children will no longer have to wear masks. Is that something that you support, or where do you stand on that?
No, I don't support that. I think that we need to continue masking in schools. We need to have mask mandates in the US as well. And I think that in the UK as well, they need to continue masking for the safety of their kids and also for the safety of their teachers as well. And as far as vaccinations, we know that the vaccines have been used in the population from over 12 and over age 5 in America, and that is also helping prevent serious hospitalizations, severe disease and hospitalizations. So we want to continue to encourage vaccinations for all that are eligible at this point, which we know that these vaccines do help prevent severe disease, and we also know this helps in preventing large populations to get further infected. So if they're in their families, if the children are vaccinated, they'll less likely be able to spread the disease from school to their families when they come home as well.
Doctor, the FDA authorizing Pfizer's anti-COVID pill at this time when we're having Omicron surge. Talk to us a little bit about who this pill is right for. How should we be using it? And, some folks, especially those who don't want to get the actual vaccine, may look at this pill as a substitute for the COVID vaccine. Should they be looking at it that way?
No, so in no way should these oral therapies be any substitution for vaccination. Vaccination, we know, prevents severe disease and hospitalizations and deaths. And if people who are vaccinated do develop disease and are high risk, they have the option to talk to their doctors about the oral Pfizer pill, the Paxlovid, which is given within 5 days of symptoms. And it's really important for people to understand to actually contact their doctor if they do feel that they are high risk and would qualify to start this pill. But again, it's also to be noted that this pill is in short supply right now. And the only way that you really can ensure that you're going to have some prevention right now is to get vaccinated and get boosted. And just to keep in mind also, the immunocompromised and the elderly and children under 5 are also unvaccinated populations as well. We have to make sure that we vaccinate people for their sake as well. Immunocompromised are still at risk for getting severe disease. Even with 3 vaccines, people are getting hospitalized. So it's so important that for their sake that we continue mitigation measures and also continue to encourage everyone to take the vaccine and get boosted as well.
All right, Dr. Bhavna Lal, thanks for your time today. Coming up, P&G's new CEO is here to talk earnings and whether those high prices are now impacting our shopping habits. We're back right after this.
Welcome back to Yahoo Finance. Well, consumer products giant Procter Gamble is out with better than expected quarterly earnings, but the company is warning about continued inflationary pressure. Yahoo Finance Live sat down this morning with P&G's new CEO, John Mueller, for his take on the quarter.
You know, it's interesting. If you look at our business prior to the pandemic, we were growing about 6%, very strong growth on the top line. Our portfolio and strategy worked for us during the pandemic. We maintained essentially that same level of growth. And as you saw in the quarter that we just completed, another 6% growth quarter. So our products are increasingly relevant to consumers across the world. They provide protection from a healthcare standpoint, hygiene for the home, and really help my family in a time of need. And we're seeing that reflected in demand across categories.
What behaviors amongst consumers are you seeing really sticky? Since the last time we spoke, despite Omicron, people have become more mobile, but what have you seen really stick?
Still spending more time at home. I think all of us are. and therefore, more clothes to be cleaned, more dishes to be washed, more meals at home with family, need those paper towels. I would say the other sticky change has been a pretty significant shift to products of quality that I know and trust, again, to address my family's needs in this difficult time. The data point there is what's happened with private label shares, both in the US and in Europe. They tend to be the lower priced offerings in the category. And market shares are down and continue to be down past 3, 6, 12 months, both in the US and in Europe.
Are you surprised to see that P&G and a lot of your rivals have pushed through price increases? You would think consumers would be trading down a bit, no?
If I just reflect on our business, we've never been in a better position in terms of the superiority of our offerings, the efficacy of those products to do the job they're designed to do at a time of high need. So you put all that together and price elasticities decline. We're seeing it's still very, very early, and this is a bumpy road, so there will be bumps on this road. But to date, our price elasticities are 20 to 30% lower than we were expecting. And as I indicated, typically at this point in the cycle, there's a shift down to private label, which we're not yet seeing. So we're going to stay on the front foot with innovation, continuing to improve products, packages, communication, our retail execution. And through that, actually, despite some price increases, improving value for consumers.
Within the earnings, John, you did raise your outlook for commodity inflation to, I believe, about 2.3 billion from 2.1 billion or so. But given the success you're having pushing through price increases, do you plan to push through more?
We've announced price increases in the majority, I think 9 out of 10 categories. Some of those price increases have not yet come to the shelf. They haven't yet come to market. So we're going to work through that before we take the next step.
Do you see any signs we are nearing peak inflation, just from your standpoint in your business?
There are some commodities that are starting to modestly roll over, which is encouraging. There is capacity being added to some of the input supply chains, which is encouraging. On the other hand, in markets like labor and transportation, I don't expect any near-term decreases.
There are, I can tell you really for the past few weeks, John, my Twitter feed has been dominated with photos on Twitter of empty shelves in grocery stores. Take us through what you're seeing in your manufacturing plants. Are you able to get enough product to the market right now?
Our supply organization is doing a tremendous job to keep products on shelf. If you look at the US, I believe we're at 94% of demand. So there's still work to do. And obviously that differs by category, but we're doing everything we can to bring products to shelf and keep supply in stock to serve consumers.
Are there certain categories where you can't keep them in stock?
It varies over time. When we have, obviously this will be obvious, but when there are significant surges in demand in any category versus the norm, we struggle. Now we're working on a number of focus areas to strengthen the execution of our strategy. One of those is supply and anticipating a wider variance in demand. So we'll get there, but we do have work to do.
Have you seen any worker absenteeism in the plants because of the pandemic?
We have a very dedicated group of colleagues that are dedicated to the business, they're dedicated to each other, they're dedicated to making a difference in the lives of consumers around the world. Of course, in the middle of large COVID outbreaks in different parts of the world, there are quarantine needs. My children aren't at school and need to be cared for. I have a family member who needs to be tended to. I have difficulty securing transportation. All of those affect daily availability of people to do their jobs, but they're working through it in a very, very impressive and committed way.
one of the benefits, you've touched every part of your organization, COO, CFO, and now CEO. What are you seeing in terms of global growth? The consensus appears to be things will slow down this year, but from your seat, how do you see it?
Strong, at least as relates to our categories. I don't have insight into the entire economy or other categories, but we've seen no slowdown in demand. We did see a little slowdown in the fourth quarter in China, where our top line growth was flat versus a year ago, but still 12% on a 2-year stacked basis, and still over 6% globally, with our second largest market essentially flat versus a year ago. And we don't look at the market as something that's handed to us. I mean, obviously, the world and what's going on does affect market growth, but we also affect market growth. And that's fundamental to our strategy to grow markets as a way to sustainably grow our business and grow share.
Lastly, John, you're now the top guy calling the shots. And in recent weeks, P&G has made some acquisitions in the prestige beauty category. Is one of the reads that under your leadership, you're going to be a little more aggressive in growing out growth categories like this?
These are projects we've been working on for some time. The first step was consolidating our portfolio into daily use categories where performance drives brand choice. And we've been saying for some time that we're committed to win in each of the 10 categories that we've chosen to compete in. And there are a couple categories where we would benefit from a broader portfolio in that winning endeavor. And one of those is beauty and skincare. These are projects we've been working on for some time, so I wouldn't take it in any way as a signal of change related to leadership. It's just a fundamental part of our strategy.
Was P&G's new CEO, John Mueller, talking about earnings and the outlook for 2022. We're going to take a quick break, but on the other side of it, Toyota stock hitting a roadblock after the world's #1 automaker backtracks on output targets for the year. We found out why on the other side.
Shares of Toyota suffering their biggest one-day drop in nearly 2 years after the Japanese automaker warned it expects to miss its production target for this fiscal year, thanks in part to those supply chain issues and the global chip shortage. Joining us to talk about it is Jeff Schuster, President, Americas Operations and Global Vehicle Forecasts at LMC Automotive. Thanks for being with us, Jeff. So is this a Toyota issue, or should we expect more automakers to issue the same warning?
You know, honestly, this is something that is with the entire industry. Toyota maybe was a little optimistic with the restart of the plants towards the second half of last year, calendar year, and then into the first quarter of this year. But honestly, this is something that is going to be with the industry likely through the duration of 2022. And then we can maybe look at getting back to normal production levels on a sustained range and level in 2023. So unfortunately, it's going to be with us. So Toyota's not alone here.
I wonder how much is factored into this because of Omicron effects, so to speak, particularly in China with their, COVID zero policy. And then which vehicles are they prioritizing then? Is it their more profitable ones, for example, trucks?
Yeah, no question about it. Omicron variant in China, in Southeast Asia, where a lot of raw materials are and where the chip production has suffered. Those are going to be risks as we look at the start of 2022 and then certainly into the second quarter as well as we move past their fiscal year. So there's certainly going to be some additional risk associated with that. In terms of prioritization, again, Toyota's not alone here. Most automakers, including Toyota, is prioritizing those higher margin vehicles. Good news is demand is still there, not only in the US, but on a global scale. So that's why the prioritization of those higher margin vehicles to feed that profitability and to keep things running smoothly is the focus right now.
What should consumers, though, expect if they're going to be in the market for a new car come the spring? It's a popular time to hit the dealerships and buy a new car. Are these shortages going to lift prices even more? We already have record prices, we know, for used cars and some parts there. What is this going to do to prices and what's it going to look like for consumers in the market?
Yeah, and I wish I had better news for consumers. The challenge is going to be finding the vehicle that you want, number one, the content and features you want, the color you want, but then expect to pay more for it as well. As you mentioned, we've seen record prices really every month, additional highs in terms of transaction prices. I wouldn't expect to see that change. It may start to level off as we edge further into 2022, maybe by the middle of the year. But it's going to be a challenging year if you're out there shopping for a vehicle. Best advice would be to remain flexible in terms of what you're looking for.
And then, Jeff, I want to ask you, automakers have been plagued by these chip shortages for the entire year, right? How did a company like Tesla manage to mitigate that? They drove up production to their highest levels last year.
Yeah, Tesla obviously has been impacted as well. Clearly, though, they've been able to mitigate some of the shortages and risk. It comes down to relationships with the suppliers, potentially paying more for the commodity as well, for the chips. So I think there's a lot of different avenues to really approach and to mitigate that risk. And all automakers are looking at that right now. Tesla certainly has done well with trying to minimize the impact, though.
Is there one automaker in particular better positioned than others as you look at the landscape of vehicle makers at the moment, better positioned to weather this storm and come out the other side relatively unscathed?
I would say Toyota they were late to have any impact. They've been better positioned. The level of their impact, when we measure it compared to other global automakers, they're all in a similar arena of more than 1 million units of impact last year each. If we look at a Toyota, a General Motors, a Ford, a Volkswagen, But in terms of percentage, because Toyota builds more vehicles and sells more vehicles, their percentage is lower. I think those that have, again, the relationships with the chip makers, maybe the proximity to where chips are being produced in masses. So we are seeing some advantages right now with overall sales levels in China, but that affects mostly the domestic automakers in China. Looking across Japan and Korea, Southeast Asia, those that have good relationships there, I think are in a better position right now. So your Korean brands, Hyundai, Kia right now, Toyota, I think is also well positioned relative to everyone else, even though, again, it's still impacting Toyota.
What does it mean for EV makers new to the space like Rivian, for example, as far as trying to ramp up production? They're just starting to get going.
Yeah, no question. Any vehicle, especially a new automaker like Rivian, who has a lot of attention on them right now in terms of their launch. Launches are critical to get and execute correctly. And it becomes extremely challenging when you have supply disruptions and problems all the way through the supply chain. So it's a management nightmare, essentially, and something that they're going to have to watch very closely as they ramp up production of the vehicle. But that is something, and we saw it in 2021. If we go back to 2020 as well, and even Tesla had challenges ramping up the Model Y. So there could be similar issues, I think, with Rivian or anyone launching a vehicle in the start of 2022 here.
All right, Jeff Schuster of LMC Automotive, thanks for being with us. Straight ahead, how inflation is impacting retirees in today's Funding Our Future.
Welcome back. Well, inflation is making it harder to save no matter what your age, but for those nearing retirement, finding ways to offset its impact is crucial. Here with tips is Michael Fink, professor and director of the Granum Center for Financial Security in the American College of Financial Services. Michael, thank you so much for joining us today. How well equipped are seniors to fight off surging inflation? I know there's been a cost of living adjustment, a quite sizable one, the biggest in many years, but that's not sufficient to fight off what we're seeing as far as rising prices.
Well, and remember, that's only in their Social Security that they get an increase in the amount of income as a result of the increase in inflation that we've seen over the last year. For the rest of their investments, the news is actually not so great because they're not able to produce as much income from their investments, whether it be dividends from their stock investments or interest from their bond investments. Seniors are getting about a third of what they got as recently as 1994 from an investment portfolio that's balanced between stocks and bonds. So they're getting less income, and what they're buying is costing more.
Yes, that double-edged sword, right? So then how can retirees with limited income protect themselves, protect the money they do have from these rising prices?
Well, first of all, this is a very sort of idiosyncratic inflationary market right now. And what I mean by that is that there's just a few categories that have gone way up in prices. That would include energy, specifically petroleum energy. Cars have gone up in price. We've seen red meat also go up in price. I mean, it's like the worst situation for a man. So what we can do is we can be a little bit more judicious about how we spend money. We can spend money on categories that haven't risen as much. And for a lot of seniors, they do have more flexibility. If everything was rising by 7%, that would be a different situation. But we've seen a number of categories that really haven't risen much over the course of 2021. That's evidence that this is more of a supply chain issue. And seniors, unlike workers who have to pay money for gasoline, have to buy new cars, the workers are less flexible than seniors are. So seniors can be a little bit more flexible. I'm a big fan of delaying Social Security as a way of getting more inflation-protected income. This is something I think a lot of people don't think of enough, and that is that when you delay Social Security, and you can get as much as 8% more income if you delay from, say, 67 to 68, that is inflation-protected income. That is going to go up in years where inflation is higher. The other thing that you can do is consider investing in I-bonds now. So a couple can invest $20,000 in I-bonds, and those are also inflation-protected investments. They're what we know is a perfect hedge against a rise in prices for seniors in retirement.
You know, that lies in the face of the great retirement where you see people close to retirement saying, we want out now. You're saying, hold off before you claim Social Security, stay in the labor market perhaps a little bit longer. Anecdotally, what are you seeing from people who are close to retirement? How worried or concerned are they?
You know, I don't see a whole lot of concern, and I'm going to address that point that you just made because I think that's also a very important one. You don't have to claim Social Security when you retire. You can choose to retire. You can pull money out of your 401k to fund your lifestyle, but you can continue to defer Social Security as a way of increasing your inflation-protected income. So don't necessarily conflate retiring with claiming your Social Security. You can hold off on that. And in fact, that can be a very wise strategy as a way of managing the amount of taxable income that you get from your IRA savings, the defined contribution plan that you transfer into an IRA in retirement. So give yourself a certain amount of flexibility when it comes to spending, but also when it comes to where you're deriving your income in retirement.
Any other tips on how we can save money in retirement in addition to those I-bonds, which is definitely a viable option for some?
Yeah, I think, historically stocks have kept pace with inflation. So taking a certain amount of investment risk makes sense, but also be aware that if the Federal Reserve does go into a contractionary policy where they're raising interest rates, where the money supply is going down, that tends not to be so great for stocks. So don't necessarily rely on taking more risk as a way of bailing yourself out, but be prepared for the possibility that prices could rise. That's an added portfolio risk. It hasn't happened in a long time, but I think it may rear its ugly head in the next decade.
Okay, and then a lot of companies on the flip side taking matters in their own hands to sort of help retain staff and help with retirement, contributing more to their 401ks. We will have to leave it there. Michael Fink, professor and director of the Granum Center for Financial Security, the American College of financial services. Thanks so much for your time. And Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. We've got much more coming up. The images are like a scene out of a movie. Brazen bandits vandalizing and looting trains in Los Angeles County, some carrying your packages. Find out what's being done about it ahead.
Unbelievable video of train tracks in Los Angeles littered with open packages as a result of thieves stealing and emptying containers filled with consumer goods, looting everything from electronics to medication. With more on that, we're joined by Yahoo Finance's Danny Romero with the very latest. And it really does look like a scene out of a movie, Danny. What's being done to stop it?
Alexis, you said it. I would describe it, it's like a scene out of the Wild West. But unlike Hollywood, these aren't props. These packages belong to people from all across the country. Thieves are breaking into cargo train containers and stealing thousands of dollars worth of merchandise that belong to top retailers, Target, REI, Macy's. Our crew was out there and we caught some video of several scavengers that are, well prepared. They're just picking through the sea of trash, hoping to find some valuable goods that thieves left behind. And also another really scary scene while we were out there on Saturday was a train got derailed. And sources tell us that thieves are actually causing this derailment as a method to slow down the trains and allow them to hop on and rob inside these cargo containers. Union Pacific officials say that nobody on the train was hurt during the derailment, and the cause is still under investigation. But if you talk about the debris field, it really stretches as far as I could see from the point that we were standing at. We're easily talking tens and thousands of boxes, destroyed boxes with addresses from Oregon to Pennsylvania. Union Pacific Railroad said it is trying to protect its cargo by increasing patrols, as well as flying surveillance drones and working closely with law enforcement. But according to the rail company, From October 2020 to 2021, there has been an increase of more than 350% in thefts. While I was out there, I found a box that was addressed to Oregon State Police, and it was being shipped out by a local company called BPS Tactical Inc. It's a law enforcement gear company. And I called them up, I sent them photos of their package, and here's what they had to say.
It's really frustrating, and it's so these criminals are just taking over, and they just, I mean, rip the box open and take what they want, and there's just, I feel like we need to have consequences for stuff like this. It just makes me mad that something that, you know, we made that costs money and people work hard to make, and this trooper's not getting his equipment that he needs because somebody helped themselves to something that, you know, they shouldn't be taking.
You can hear it right there, the frustration that this is causing for businesses as well as consumers. The vice president of BPS Tactical told me they were shipping out an exterior vest that goes over the bulletproof vest of this Oregon State trooper. She said that it's worth about over $500, but she said that this has never happened to them before. And now, knowing what she knows now, seeing those photos of her package, she says it really won't change much in regards to the shipping method, but luckily all of their products were insured. Alexis,
yeah, you really feel for that woman. You really hear the frustration in her voice, as you said. And I wonder, what is the solution here? What is Union Pacific doing and what are authorities doing? Because some of the people arrested are just being let out in 24 hours.
Yeah, and I think that's a question on everyone's mind. You know, cargo theft is just the latest on a long list of problems causing shipping and causing shortages. In a letter to the district attorney's office, the rail company is blaming on the no cash bail policy, which in part is causing the frequency in these thefts. The company says more than 100 people have been arrested, but these thieves, they boast to their officers that charges will be pled down. So far, the rail company has reported a loss of $5 million at the beginning of December, and that amount is actually expected to go up in pretty soon once Union Pacific factors in those holiday shippings. But we also reached out to the district attorney's office of LA, and their response says that some cases being presented to their office are being filed in burglary and grand theft, but other cases just do not have enough evidence to prosecute. However, Union Pacific claims that local prosecutors aren't helping. Alexis, Karina?
All right, Danny Romero, thanks so much for that report, and great reporting there. Coming up in the next hour, oil prices now at a fresh 7-year high. What does it mean at the gas pump? We're going to talk about it coming up.
2 years after the first COVID cases were detected in the U.S., experts are still struggling to find a way out of the global pandemic. Yahoo Finance's Anjali Khemlani sat down with top White House medical advisor Dr. Anthony Fauci to check in on the road ahead. Oil hits a 7-year high with no end in sight to sky-high prices. We speak to an expert to discuss the outlook for energy prices and the risk posed by geopolitical tensions. And coffee is back. While restaurants still struggle to recover from the effects of the pandemic, Americans are flocking to their local barista for their cup of joe ahead while Java Jolts are bucking the trend. I'm Karina Mitchell along with Alexis Christoforous. Thanks for stopping by on this Wednesday afternoon. There is certainly a lot of volatility in the market and investors in a cautious mood. Here with some of the biggest market movers, let's bring in our Yahoo Finance's Jared Blickery, who's been watching it all. Jared, want to start with P&G. It is the Dow leader with better than expected results and a positive outlook.
That's right. Usually we don't kick off the hour with a consumer staple, but we will in this case. And let's go to the Wi-Fi Interactive. I'm going to sort by performance, and you can see indeed Procter Gamble is the Dow leader. And let's just get a 2-year look so we can see what it's done throughout the pandemic, because this is the biggest day for it. Stock is up 3.7%, as you can see on your screen, but that's enough to be the most since, I believe, April of 2020. So let's get to some of the analyst commentary. I think the key line here is that the company was able to maintain their EPS forecast. That means that they're not getting squeezed on margins and they have some pricing power. So here's Jefferies. They are recommending the stock with a buy price target of 185. You can see that's about $23 above the current price. There was some concern from investors ahead of the results at the tough cost environment that would cause the company to trim its EPS outlook. However, it didn't happen. Instead, PG remarkably reaffirmed its EPS guidance of 3 to 6% growth, which now reflects a $1.10 per share headwind from commodities, freight, and effects, versus prior and initial guidance of 90 to 70 cents, respectively. So really absorbing some of those higher costs there. Also saying, this is Jefferies again saying, PG's portfolio momentum was evident in the strong second quarter of results. We believe PG's higher core sales reaffirmed EPS guide should be good enough to drive shares higher today. Also, Truist recommends a security with a hold price target of 145. That's a bit lower than the current price. And they are saying the sales boost was largely expected, didn't expect pricing actions to be fully offsetting the margin pressure. So net, another strong quarter for the company, though share price reflects business momentum. So a couple different outlooks there. This is consumer staple. You don't expect them to necessarily be leaders, but in this defensive environment, guess what? Consumer staples, that is the #1 sector today.
All right, want to talk some chip stocks now, and I know that shares of the Dutch chip maker ASML. Wow, that's a lot of red on that screen. They're under some pressure today. I mean, I know they landed a pretty big contract from Intel recently, but I guess that's not helping the stock any.
That's right. It's important to note that this is a chip company, but they make the materials and the devices that actually manufacture. So Intel is a customer of theirs. Taiwan Semi is a huge customer, so is Samsung. So they supply the parts for some of the biggest chip makers on earth, and therefore they're a pretty important bellwether. So let's go through what Wells Fargo is saying, and I'll get some other commentary as well. They're saying, while the first quarter outlook comes as somewhat of a disappointing surprise, our initial view of the ASML print is positive. This is a messy print, but the company's strong growth outlook is clear. Evercore, which recommends it with an outperform, they're saying this is a very mixed quarter with fast shipments, a clear source of volatility. The first quarter outlook is a bust, but this is entirely a timing related issue. The firm remains positive on the stock. So you can see this is a company, it's not one of the high flyers like NVIDIA, different kind of company, so apples to oranges, but it has been flagging sideways, I'd say, over the last probably 6 months or so, and just kind of looking for support at that 700 level. Guys?
Okay, and then finally, Jared, Sofi shares soaring today after being granted a bank charter.
That's right. This comes from the OCC and the Federal Reserve, and this is a big deal. This means that the company is going to be able to tap the liquidity at the Fed, and if there's ever another emergency and those emergency lending facilities are open, they can benefit from those Federal Reserve spigots. Let me put a max chart on here for Sofi. This is a company that has had a little bit of trouble after some really initial enthusiasm around their IPO a couple years ago. it really faded. And you can see they've traded basically sideways ever since and just came down, tested that low that we saw close to their IPO day, and they've rebounded slightly. So here's what here's what Jefferies is saying about the move. They recommend the stock with a buy price target of $26. That's almost twice the current price. They're saying the approval is a clear positive catalyst and demonstrates the confidence of the OCC and Federal Reserve in their business model. The change will improve SoFi's flexibility to hold offsets on their balance sheet when appropriate, improve its cost of funds through acceptance of deposits, and allow SoFi the opportunity to offer more products to its customer base. So for a personal finance company, kind of the holy grail here, finally getting that banking charter. Guys?
Okay, Jared Lickery, thank you so much, and we'll see you back here in a bit. We want to keep it on the markets and bring in our next guest, Bob Dahl, Crossmark Global Investment Chief Investment Officer. Mr. Dahl, thank you so much for stopping by. I think I have to start with just asking for your reaction to all of the volatility that we're seeing in the markets today, and big banks also sort of wrapping up their earnings season. What do you make of the earnings that we've seen so far, and then what do you think we should be looking out for in earnings as they roll out?
Well, let's start at the back end. Earnings growth and good earnings are necessary to buffet the headwinds coming from depressing valuations on the back of rising rates and rising inflation. So far, the earnings have been pretty good, a little bit more mixed. You mentioned the banks, and there were some issues there, as you know. But by and large, earnings are coming through reasonably well. Companies able to pass on some of the cost pressures through price increase. We need to see more of that to repeat counter the headwinds from valuations.
Yeah, one of those companies was Procter & Gamble. We had the new CEO on earlier talking about how, for at least for now, consumers are willing to pay those higher prices. When do you think that's going to be a real problem for the economic recovery? When is it going to be too much for folks to pay these higher prices? And what will the impact be on companies' bottom lines?
Yeah, if we get or when we get to that point, that won't be great news for the stock markets because the market is depending on these good earnings profiles. I will say, if you go back to even the release of the third quarter earnings 3 months ago, I was surprised how many companies actually passed along their cost pressures through higher prices. So far, it's not been a problem at all. I think there's more of that to go. Remember, consumers have $2 trillion plus of excess savings in their pockets, so they may be less price sensitive in these days than we think.
I was surprised as well that they're able to, drive up prices, and people for right now are paying for them. But at some point, you sort of see that that's going to shift and change. I want to turn your attention to the bond market and ask you what is going on. We saw the 10-year stuck below 1.5. Suddenly, it hit 1.5. Now today, touching 1.9 before retreating a little bit. On the front end, the 2-year crossing 1%. What is this telling us about what investors are feeling? And how many hikes do you think are coming this year?
So that rates haven't moved up more and quicker till now has been the surprise to me, not that we're where we are. Remember, the Fed put in 0 Fed funds rate when we had an emergency. And I would make the case that emergency has long since passed. And of course, we had that period where the Fed tried to convince us that inflation was transitory. Thankfully, they've abandoned that word because it's not all transitory, and therefore we need higher rates across the curve as the Fed seeks to begin the normalization process. The Fed moved from fighting unemployment to fighting inflation almost overnight, which is pretty unusual and pretty rare, but I think they've come to the conclusion they are behind the curve. And so you're right. 3 months ago, we would debate, is the Fed going to raise rates in 2022 or not? Now the debate is at 3 or 4 or 5. Will the first one be 25? Might it be 50 basis points? But the trend is certainly higher. And if you're a bond investor, you got to remember when rates go up, bond prices go down. The pace at which that happens is very debatable. My guess is it's 3 or 4 this year, and probably all 25s, no 50s.
We know that volatility remains at a high level. That so-called fear gauge, the VIX index, last I checked, up about 1%, now topping 22. Where are the opportunities for investors in a volatile market, and how can you either take advantage of that or protect the portfolio?
Yeah, so I'd say a few things. One, if you have money that is earmarked for the market, wait for pullbacks. Don't chase it. Conversely, if you need to take money out, don't panic into the lows. Wait for some green days. I think we're going to get some of both. My view for the full year is that the more cyclical side of the market will do best, financials and energy. My hesitation to say that short term is they're so far ahead and perhaps a bit overbought and may need to take a bit of a pause. So I wouldn't go chase those financial and energy stocks, wait for a pullback, but that's where the action is. That's where the cheapness is. We need in a higher interest rate inflation world to peel back a bit on our very high PE growth stocks that depend on very low interest rates.
Bob, I hear from my producers that you are a great prognosticator. So what are some of your other predictions for 2022?
Well, you see, you've got a few of them up there. Let me highlight just a few. Inflation, that's the real investment question for this year. Our guess is that, ironically, inflation will fall during the course of this year, but don't be mesmerized by that. Core inflation is likely to remain above 3%, not going back to 1 to 2 where we've lived before. For the stock market, our view coming into the year was we're not going to realize the consensus view that stocks go up with earnings because of the valuation headwind. So I think it's going to be a more frustrating year, hard to make money. There's a chance, especially if the dollar weakens some, that international stocks do a bit better.
And what are you doing with commodities right now, which we know are inflationary? They continue to go up, including energy. We're going to talk a little bit more about these high energy prices in a moment. But what are you playing in that space, if anything? And are you using anything there as an inflation hedge?
Well, so the inflation hedges are, in fact, the two sectors I mentioned. Let's spend a second on energy. We know it's a supply and demand determined price. And we have a globe that's doing reasonably well, so demand is picking up. And supply, some places it's kind of curtailed, some for political reasons. So if you have limited supply and increasing demand, you know what happens to price? It goes up, and that's what we're seeing.
All right, we will have to leave it there. Bob Dahl, Crossmark Global Investment Chief Investment Officer, thanks for stopping by today. We've got much more coming up after the break. Housing starts on unexpected rise last month. So why is KeyBank bearish on some home building stocks? We'll ask an analyst ahead.
Welcome back. New home construction unexpectedly rose in December to a 9-month high. That's even as builders had to deal with higher costs for materials and labor, and of course, those ongoing supply shortages. Here with an outlook on the home builders for 2022 is Mark Fleming, chief economist at First American. Mark, thanks for being with us. I would like to get just your reaction to that surprise jump in home construction last month. And do you think that we're going to see that sustained momentum this year?
Yeah, I think obviously it's good news. The housing market writ large can never need enough new homes at this point. We have significant shortages of the housing stock we've underbuilt for a number of years now. So the more, the merrier when it comes to home building. Not only was it good news this year, but we've seen, basically a 50-50 split in multifamily and single family homes under construction that are at paces not seen since the 1970s. So an impressive and good number, and more is needed.
What do you expect as far as home appreciation this year? Do you expect that to continue? And then do you expect to see more people being able to switch homes, or are they going to be locked into staying where they are because of higher costs?
Yeah, it's the simple supply and demand 101 dynamic that you were talking about in the last segment is playing out in the housing market as well. A shortage of supply relative to a lot of demand, largely driven by millennials aging into home ownership. And that's why we've seen so much house price appreciation in the past year. That's expected to continue. We might see some easing of supply inventory and maybe some reduction in demand as rates rise and affordability is curtailed a little bit, but the imbalance is so big that house prices are expected to continue to rise, albeit not at the same pace as last year. It's sort of the fundamentals of the market, and it's been that way for a number of years now.
We know that affordability continues to be an issue, and a big part of that is supply. We know that there are not enough homes on the market for the entry-level homeowner, those millennials that you're talking about. Did some of that home construction, I know it was fueled by multifamily projects, apartment buildings, but were builders busy building entry-level homes last month and last year, or was it more of the high-end luxury homes?
Historically, home builders have traditionally not even attempted to serve the lower end of the market. That's done through existing home sales of the smaller homes to entry buyers. But in the last couple of years, because of the dearth of homes for sale in the inventory on the existing side, home builders have done a much better job of also building at the lower end. But I think what's really interesting here is the relative share of multifamily, that we're still building so many multifamily units. And I think that largely gets to the fact that if you think about it, we all love shelter, whether we rent it as an apartment or own it as a home. If there's a shortage of homes or you can't find something to buy, then you're going to rent instead. And so that substitute good is playing out between the two segments, multifamily and for sale owned homes, because of the shortages.
And then we know rate hikes are coming, right? So what will higher mortgages do to demand and demand for home building, and what other macro risks are there in the year ahead?
Well, we've actually seen a significant move in mortgage rates in the last few weeks. In fact, we're already above 3.5%. But what's most interesting there in the mortgage application data that also came out today, even though rates have gone up, there's a big surge in purchase demand. We've all heard of the concept FOMO. Well, that's what's in play right now. People are rushing in saying, oh my goodness, I can see that rates will clearly go up more in the year to come. And therefore, we're basically putting a lot of purchase demand now for fear of missing out on those low rates today.
Now, we saw an analyst at KeyBank downgrade a number of the home builders today, citing those impending rate hikes and higher inflation. And typically, we do see home builder stocks pull back during cycles of tightening by the Federal Reserve. Do you think as the year goes on, business will get tougher for those home builders?
That may be true in a balanced supply market, but given the supply imbalances, I continue to see strong demand for both new and existing homes this year. That said, if we get major moves in mortgage rates well beyond 4 or even to 5%, which nobody is forecasting, that would be, we can handle gradual change in the market. It's much more difficult to handle sudden changes. That being said, there's no reason to believe that there'll be a sudden move in rates to significantly higher levels. And we have to keep in mind that while rates are going up, they're going up from, historically low levels to begin with. Wasn't too long ago that a 6% mortgage rate was considered phenomenally good. And all indication is it's unlikely we will be well below that, even though rates have risen by the end of this year.
I remember when rates were double digits. I remember that, right? So, I mean, historically speaking, the rates right now, even though above 3.5%, still pretty good. All right, Mark Fleming, first American chief economist, thanks for being with us. And coming up, we're going to speak with the nation's top doctor, Anthony Fauci, about whether the Omicron variant has peaked. We'll be right back.
Welcome back. Well, believe it or not, we are at the doorstep of the second anniversary of the first confirmed COVID case here in the U.S., which, if you remember, happened to be in Washington state. Yahoo Finance's Anjali Khemlani sat down with Dr. Anthony Fauci recently as we enter the third year of the pandemic. Anjali?
That's right, Karina. Unfortunately, we are entering that third year, and that's something that Dr. Anthony Fauci admitted, he was kind of surprised about, not expecting that we would be where we are now, considering we have the tools available here in the U.S., namely vaccines, to help really curb the trajectory of the pandemic. But we also talked about a couple of other things, one being specifically the amount of misinformation and the hate that has come his way, and how he's really handled all that in the past 2 years. Listen to what he had to say.
Well, right now we've seen a disparate surging in this country. We've seen it surge in the big cities like New York and Chicago, Los Angeles, places like that. And even in New York, it's already peaked and started coming down. The areas in the South that have not yet been hit as badly likely will see a gradual increase and will reach their peak later than the peaks that we're seeing in the big cities like New York. So I think ultimately it's going to spread throughout the entire country for the simple reason it's a very, very transmissible virus. Hopefully the impact will not be as severe as we've seen with Delta. But remember, One of the reasons why we can't be complacent about the concept that it is inherently less severe is that the sheer volume of numbers of people that are getting infected with Omicron because of its high degree of transmissibility might supersede and obviate the lesser degree of severity. So let me give you an example. If a virus infects 50 people and 10% of them are severe, that's 5 severe people. But if another virus infects 500 people and is only 1% severe, even though it's 10 times less severe than the other virus, you still have a lot more people severely involved. So we've got to be careful that we don't get complacent about a virus that inherently is less severe, but quantitatively gives you so many more infections.
Absolutely. Moving on to one thing that I know you've been really big on since sort of the start of the pandemic, which is equity and access. When it came to vaccinations, I know that was something that was thought about within the White House response team. But now we're looking at a number of things. And I know it's a couple of disparate things, but let's get to them. One is the masking. There's different sort of ideas around whether or not we should be pushing for N95s or KN95s and what that means for access for individuals who may not be able to afford them. Meanwhile, we also know that while the at-home request site launched today, there were some issues with people in apartment buildings, which we know affects those in vulnerable communities more, as well as the idea of reimbursement for at-home tests being printed or faxed based on the insurers, also another access issue, and then no phone line for those at-home tests. So it just seems like despite a lot of progress in getting these things to the American people, there's still some barriers left. Have you talked about this within the White House response team or just generally and how to overcome them?
Well, obviously, there has been a major improvement with what you're seeing getting launched tomorrow, namely the January 19th beginning of the distribution of 500 million tests free, followed soon thereafter with another 500 million for a total of 1 billion tests. So there's also going to be about 20,000 testing centers. There's the online issue that you created. So things are going to get a lot better. It's never going to be perfect. Nothing is perfect when you're dealing with such a formidable challenge as we are right now. But a real attempt has been made to address the equity problem in every aspect of this pandemic.
Dr. Fauci, a final question for you. We know we've seen you personally attacked throughout the pandemic, both by congressmen as well as really the misinformation army that's out there. I just wonder how you've been able to handle it all and really how it's affected, the response and your day-to-day.
Well, I'm fine, first of all. And the way you get through those kinds of ad hominem attacks and distractions is you focus on what your main purpose and what your responsibility is. And for the last 40 years or so, my responsibility as a scientist, a physician, and a public health person is to do whatever I can through the institute that I direct to do safety and health of the American public. And indirectly, when you do that, it's for the rest of the world, because we're leaders in that regard. So I focus like a laser beam on what my purpose is, the health of the American public. All the slings and arrows and ad hominems, they are certainly not comfortable, but they also are not getting in the way of my job.
So as you can hear, a lot to deal with there, and specifically on the point of sort of what the trajectory of this pandemic currently is. I did get a chance to ask him about the conversation. I know we've been hearing a lot in the finance world about the pandemic becoming endemic. And he really said that there is that possibility if vaccinations go well throughout the world for the rest of the year, but there is always that worst case scenario still sort of hanging out in the background, which is we could see a variant of concern pop up that completely eludes any kind of protection. So definitely a lot to still, unfortunately, keep waiting and watching on. Back to you.
That's something we definitely don't want to see, Anjali. That was great reporting. I have to say, because you touched on the interview, I logged on yesterday for my free at-home test. It took me 60 seconds, put my information in, and hopefully they show up. It was really easy to do. All right, we will leave it there. Anjali Khemlani, thank you so much. We are going to take a quick break and then shift gears. Oil rising to a 7-year high. We'll discuss the broader energy sector and where crude settled coming up next.
Another volatile day in the oil pits. We've got crude oil now hitting a fresh 7-year high. Jared Blickery is here with a recap for us. Jared?
That's right. WTI futures for February settlement, they just closed at $86.96 per barrel. Haven't seen anything like that since October of 2014. Let's go to the Wi-Fi Interactive, where we can see our commodities heat map has a lot of green on it. Some of the biggest gainers today are in metals, but we're here for the oil close. So let's take a look at crude oil, up about 1.5%. I like showing this 3-month chart so you can see the considerable rise we've had since the beginning of December, wiping out those losses from Omicron and just building on them. There's going to be a lot of concern about energy prices this year because it is an election year. Midterm elections get swung by energy prices. So it really puts pressure on the Fed in terms of inflation. And while energy is flagging today as a sector, you can see most of these stocks in the red. They have had a banner year. In fact, let's take a look at the 12-day performance. You can see Exxon already up 20% on the year. So is ConocoPhillips and British Petroleum. Some of these guys up even more. Halliburton up over 23%, and Occidental Petroleum just a little bit more. So energy still in the driver's seat for the year, but flagging a little bit today.
All right, I'm going to bounce off that driving situation and talk about the bumpy ride it's been for drivers this year. According to AAA, the average price for a gallon of regular unleaded, $3.31. That's up more than a penny from the prior week. And experts are warning there could be more pain ahead at the pump this spring. Here with his outlook on gas prices and the overall energy market is Stephen Schork, the Schork Group principal. So, Stephen, how high are we talking here? How high do you see gas prices going? Could we have a national average well above $4 a gallon come springtime?
Trending that way. We have to keep in mind that what we're consuming now in the United States at the retail level is quote unquote winter grade gasoline. This is a gasoline where the feedstocks that go in to make it are abundant, therefore cheap relative to other feedstocks later in the year. So we're now consuming the cheapest manufactured gasoline of the year. As we roll into next month and as we get into the spring and then the summer, we begin to transition over to what is called summer grade gasoline. This gasoline is much more expensive to manufacture. So just from that standpoint alone, we're looking at probably a 20 to 25 cent increase when we roll over to these newer fuels. Now, when you factor in where crude oil prices are and where they're likely going, we're forecasting in our modeling a 13% probability that oil will be above $100 a barrel by the start of the summer, which would add another 20 cents to the average price. So when we take into account the rollover in the specifications for gasoline, 20 cents, and the potential 13% that will be over $100, we're looking at a potential 40 to 45 cent increase in gasoline prices as we get ready to head to our summer vacations.
Hey, Stephen, it's Karina. Thanks so much for coming on. So look, it's primarily the Fed's job to try and rein in inflation, right? But these are unprecedented times. So the White House has stepped in. They've opened up the strategic reserves, and that did very little to help lower the price of gas. They did it just before the holidays to try and appease consumers. But has the administration done enough? And what more can they do? They can't just, can they just ring up OPEC and say, open the spigot a little bit more?
Absolutely not. And the White House is doing everything they can to keep and propel oil prices higher. The SPR was a political stunt. We have to keep in mind that the SPR was not created to manipulate gasoline prices. It was created in the wake of the 1973 Arab oil embargo to mitigate a short-term unforeseen disruption in the supply of crude oil. That's not the case. So the SPR was never designed to manipulate price, because when we look at the global demand of oil, 50 million barrels is nothing. It's a drop in the hat. Therefore, since the SPR was not designed to manipulate prices, the decision by the White House was bound to fail, as we noted at the time. We did get a significant sell-off the Friday after Thanksgiving when that decision was made, but we've rallied 40% since those lows. So what can the administration do? They can throw out an olive branch to the industry, because based on their DNC, the platform before Mr. Biden was elected president, they made it quite clear they wanted to violate in the energy market the first law of economics, and that is capital goes where it is welcomed and stays where it is well treated. And the move to go away from oil has sent a clear signal to the industry that investment should not be made or should be limited. So when we factor in the wrong message that the White House is sending to the industry, and then we couple that with the inflation. For instance, the PPI numbers from last week showed us that domestic crude oil producers were paid an extra 50% year over year because of rising inflation. So the cost to produce, the cost to manufacture ethanol, a key feedstock in gasoline, has more than doubled year over year because of inflation. So yes, inflation is a driver, but the White House is sending out the wrong signals. Stay away from political gimmicks like the SPR and send out an olive branch and induce the industry to invest in future production. Because where we're standing right now, production is not able and will not be able through the 2023 to offset rising demand. So get ready. We are looking at higher oil prices longer than anyone had anticipated 6, 7, 8 months ago.
But Stephen, what about the idea that about a dozen congressional Democrats had, and that was they're urging President Biden to ban U.S. oil exports? Does that have the chance of perhaps backfiring and working out pretty badly for the oil markets?
Oh, absolutely. That proposal is economic ignorance on stilts, because we have to keep in mind the United States produces a very high quality oil. That is to say, it's very easy to refine. Therefore, it trades at a premium. United States, the majority of our refineries are engineered to process a heavier, sour grade of crude oil, which is harder to manufacture, and therefore it is cheaper. So the United States is in the enviable position of exporting our high-priced oil. We're exporting caviar, and then we buy back the oil that we don't necessarily produce. We're buying back tuna fish at a discount. So if you just clog up and we maintain that high quality oil here in the United States, hey, that's great. But guess what? U.S. refineries can't use it, and it absolutely will backfire because you will prevent the United States from buying that cheaper oil, which would then trade at a premium because we are embargoing our own exports. And yes, of course, it will absolutely backfire and will only drive oil prices further higher.
Stephen, not much time left, only about 30 seconds. How much of a threat do geopolitical tensions pose, particularly in the Persian Gulf? We know Iran, and then now with the Ukraine and Russia border.
Yeah, absolutely. The Russian-Ukraine border is more of a natural gas story. But that said, because of extremely high natural gas prices, we're seeing natural gas to oil switching, which is increasing demand for oil. So that geopolitics is a plus, a positive, bullish indicator for oil. And of course, as what we're seeing with just the rebel attack, the Houthis over the weekend on an oil tanker in the Gulf. So those geopolitics are coming into the fore. I have it on a good source that the Iranians are now investing back into dollars, devaluing their currency. This is an implicit tell that the Iranians are expecting to reach a deal with the White House, which could help soothe what is right now a raging oil market. But that said, currently we're seeing too much demand, not enough supply making to the market, and we have a scenario for higher oil prices well into the summer and into next year.
All right, you heard it here, drivers. Brace for those higher prices in the weeks and months ahead. Stephen Schork, the Schork Group principal, thanks for your perspective today. A lot more people turning to yoga and walks during the pandemic. Coming up, we'll speak with the CEO of Strava, the social platform for athletes.
Welcome back to Yahoo Finance. Global activity rates on Strava's social platform for athletes rises to new record levels in 2021, with over 95 million registered athletes worldwide. For more on this business momentum, we bring in Strava co-founder and CEO Michael Horvath, along with Yahoo Finance's Brooke DePalma. Michael, thank you so much for being here. So you've seen strong revenue growth, 68% up in 2021. And I wonder, how has your platform managed to grow during the pandemic, and how are you propelling that momentum going forward?
Well, thanks for having me. First of all, appreciate the opportunity to talk with you all. During the pandemic, we saw a lot of people look for community and connection when they couldn't find it through their regular life, and they look for ways to be active. And Strava really fits that. It's built around the principle that people keep people active, and enables you to build a community of people who help motivate you to reach your fitness goals.
5 million athletes who have downloaded the app. You're seeing 2 million new athletes per month. Now, it does come at a cost to be a subscriber and get all the whistles and bells of Strava. It costs $59.99 per year. How many users are you seeing switch from that free trial to be a full subscriber?
Well, that's right. We're a subscription business. You can use Strava for free and get access to many key features and that connection to help motivate you. But to get the best of what Strava has to offer, everything we've built over the last 13 years, that's in that subscription. So for about $5 a month, you get extra motivation and more fun, more discovery of what's around you. And so we keep adding more features to make it valuable. We don't release the number of subscribers or the percentage, but we can tell you it grows with our community. As we add 2 million new members to our community a month, our subscription count grows in direct proportion.
And Strava was created back in 2009, I believe. But in recent years, we've seen so many new players in the game, like Apple Fitness Plus, Peloton, Nike Run Club, a longtime player there. How is Strava diversifying itself among all that noise?
Well, we say we connect connected fitness. So many of those companies you just mentioned are great partners of ours. Your activity on Peloton, or what you do indoors with another app, even Apple Fitness, shows up as a workout on Strava. You get kudos from your friends who follow you. You can share photos from your activities on Strava, and it lives on and celebrates your active life and is the record of your activities. So for that way, we connect with over 400 different devices, apps, partners who help make Strava the center of the athlete's athletic life.
I'm curious what exercise patterns have looked like throughout this pandemic, especially at times when we go into lockdown. Do you see, more activity on the app, and what are some of the exercises that folks seem to be gravitating towards?
Yes, pandemic really has shaken up the way people live their lives across the board, and that fitness is no different. In extreme cases of lockdown, people have to resort to working out indoors, or we've seen marathons run on top of apartment buildings. If that's the only place you can safely exercise. Really, people who want to be active, they're going to find the way, and Strava's there to meet that need. You can upload over 30 different activity types, indoor, outdoor, from the gym, from the home gym, anywhere. So in that sense, it's really a record of how people are coping with all the disruption that's going on in their lives. What we've seen in the last 2 years is a rapid rise in things like walking, yoga, hiking. Those are exploding on Strava, doubling in terms of the percent of activities on Strava and total number of activities coming in from our community worldwide.
And Michael, really quickly, you call your users athletes, many of which may have imposter syndrome, including myself, who is a new runner. And so how many of your users are new athletes who are first-time, half marathon runners?
Most people who join Strava would say, hey, I'm just getting started to meet my goals. Anyone who sweats is an athlete in our world. What we are building is something that is universal. For anyone who wakes up saying, I'd like to have some activity in my life today, Strava is the place for them.
Okay, we will have to leave it there. Michael Horvath, Strava co-founder and CEO, and Brooke DePalma from Yahoo Finance. Brooke, you're going to stick around for the next segment, so we'll see you in just a bit. On the other side of a break, global activity rates on Our global rates of coffee are picking up, and it seems like Americans can't live without their professionally brewed Java Jolt. Find out why coffee houses are bouncing back faster than other sectors. Stay with us.
Looks like people prefer their cup of joe from a professional barista. According to a new report from the data intelligence firm Placer.ai, the coffee space is actually rebounding faster than the dining sector. Brooke DePalma here to break it all down in Brooke's Bites. So what are some of the trends we're seeing with these coffee houses, Brooke?
Alexis, well, it turns out that more people are going outside of their house to get their morning joe as opposed to brewing it up at home. According to this new report from Placer.ai, the coffee sector can be classified as quote unquote a proven necessity based upon customers' visits, even though during the pandemic, there was a lot of major shifts in work-life schedules. For example, we're not commuting into work anymore. I'm not stopping by my local Starbucks at Astor Place, but foot traffic at the top 10 performing coffee giants did see a bit of a drop in early 2021. Now, as we made way into the last year, into the end of the year, coffee giants visits were up a whopping 7.5% in the end of December 2021. Now, that did surpass the dining sector by nearly double the foot traffic in November 2021. Now, Placer.ai experts noted that this could mean that coffee at home just simply does not compare to the trip, the experience of going to a coffee shop. Now, another trend pointed out in this right here is the difference in time in which consumers are heading to their coffee shops, noting that a COVID-induced shift may be happening. Instead of going during those early hours in the morning, I know we were going at 5 a.m. Now they're shifting towards getting their coffee later on after a bit of a start to their morning between 9 to 12. And that did come at the expense of going in late afternoon and evening coffees. Now, because of those shifts, it does leave room for lots of innovation. Perhaps we're grabbing different items. So Placer.ai expects that this could lead to seeing different cravings among consumers.
Now, Brooke, I've got to say I'm not a coffee drinker, so it gives me more the jitters than a jolt. But the report also dove into trends of some other major coffee brands, including Starbucks, Dutch Brothers, and Dunkin'. What did you find there?
Karina, that's right. And, I'm a tea drinker myself, but I have to admit over the past few years, I have gotten into coffee and many new consumers are seeing Dutch Bro as one of their new favorites. It seems to be giving Dunkin' and Starbucks a run for their money. Compared to 2019, the Oregon-based coffee chain saw a major spike in monthly visits, reaching as high as 160% in December. Now, Karina and Alexis, all things into consideration, there has been a lot of growth for Dutch Bros, but it was a big year for Dutch Bros. This past year, it listed on the New York Stock Exchange in September, and over the past 5 years, it expanded its presence from 250 stores to 500 stores. So as expected, that it would be a lot more foot traffic into its locations. Now, I do want to note that even though there is seeing explosive growth at Dutch Bros, it has not come at the expense of two coffee giants, Starbucks and Dunkin'. If we take a closer look at the month-over-month visits, in March of 2021, we saw a major spike from spring menus being released at Starbucks and Dunkin'. And also worth noting, Starbucks still has that excitement around its fall pumpkin spice latte season, in addition to its red cup season that comes around November and December. So it's seeing a boost of foot traffic there. It also suggests that despite all the noise, all the excitement, there's enough room for everyone in this game. All national leaders can make way because coffee right now is apparently the big thing among consumers. It's always been considered the third place. And so now it's trending as that third place in a more work hybrid model.
All right, sounds good. It definitely is an experience when you go out to get your coffee. Also more expensive, we might add, than making the Java at home. All right, thanks for that roundup, Brooke DePalma, in today's Brooks Bites. Let's take another look at the markets. We've been talking about it all day long. Another volatile one. Stocks have been all over the map. The Nasdaq looking at a closing in correction territory, which would mean it was down 10% from its recent high. It is now off just about 11 points. We'll work our way backwards here. The S&P 500 down 5. Dow, though, off 110. We have got Procter Gamble, one of the big winners for the Dow today after that better than expected profit report and strong guidance. But on the downside, we have got the financials once again, also Boeing and American Express, Caterpillar also lower. That's going to do it for us. We've got much more Yahoo Finance Live to come right after this.
Investors await President Biden's press conference as markets struggle to recover losses and anticipate the Fed raising interest rates. Heritage Capital President Paul Schatz will help us all assess next steps to protect and grow our portfolios. Then the energy sector is up more than 50% over the last 52 weeks. Oil is gushing. WTI futures trading at more than $86 a barrel are just part of the story. We will drill down with Pure Exposure's Bob Iacchino. And McClaren, America's President Nicholas Brown, will help us shift into the fast lane as the supercharged sports cars that continually break records at auctions may soon team up with VW Group to produce a new F1 racer. Go, Speed Racer, go. We have an hour left in the trading session. I'm Adam Shapiro.
And I'm Emily McCormick. It's been a choppy day in the markets with the three major stock indexes fluctuating between gains and losses throughout the session. And looking at where things stand now, as you can see, a lot of red across the screen. We have the Dow down more than 100 points, or about 0.4 percentage points. The S&P 500 currently down about 0.2 percentage points, and the Nasdaq Composite down about 0.25 percentage points as we speak. And then taking a look at the sector action, leading to the downside, at least in the S&P 500, again, financial, the big laggard during today's session, followed by consumer discretionary and industrials, whereas on the flip side, we do have consumer staples, utilities, and communication services outperforming. But for more on where things stand in this final hour of trading, we have Yahoo Finance's Jared Blickery standing by with more. Jared?
That's right. It looked like we had the makings of a relief rally earlier this morning, and it just kind of fizzled out. And that's pretty common. Usually the day after you get a lot of heavy selling like we did yesterday, you do tend to see things take a pause. But really, this is not the most encouraging price action. First of all, this is a 3-month chart of the S&P 500. Looks pretty sideways. You could make the case that we're in an uptrend here. But unfortunately, that uptrend was just broken to the downside. We got a close yesterday, another close today would probably seal the deal on that. But looking at the VIX, also reached the highest level in about a month. So seeing some investor fear there. And then we're getting a little bit of relief on the bond side. So we're seeing 10-year yield retreat about 4 basis points. We know that surging yields have been a source of pain for the market, and we really saw mega caps take it on the chin recently, but not necessarily today. We're seeing a mixed picture. Tesla's down 2.5%, Apple and Amazon each down more than 1%, but Microsoft is up more than 1.5%, and Facebook almost there with it. In fact, software really getting a boost today, bucking the trend over the last couple months. We're seeing a little bit of love for CrowdStrike, that's up 3%. Also Take-Two, that's up about 7%. But you look at the travel sector, we have seen a lot of red in this space recently, and that continues today. Carnival Cruise Line's off 2.5%, American Airlines down nearly 3%, and Southwest down 1.75%, also announcing that they are canceling 15 flights of their over 3,000 flights today because of the issues with 5G. So interesting situation there. I want to check out the sectors because Staples is the big flyer today, and that's partly off of the Procter Gamble earnings. The expectation that they're going to meet their profit goals, really giving that stock a boost. Margins under control there. So Staples up over 1% today, followed by utilities. Guess what? That's a defensive structure right there. Then we got communication services, and materials. And when we talk about materials, that's commodities. Commodities really flying high today. You can see in the top left, that's palladium and platinum. Each of those are up over 5%. Then we got wheat, silver, orange juice, cotton at multi-year highs, and so is sugar. So all in all, we're feeling the pinch of inflation today, and that has been helping energy stocks, but not today. Check out the energy board, kind of a mix. So this was actually more in the red even just 30 minutes ago, but we can see Chevron just climbing into the green there. Exxon up over 0.5%, guys.
Jared, thank you very much. We're going to be checking in with Jared throughout the hour as we head toward the closing bell. Let's bring in Paul Schatz, Heritage Capital President. Always good to have you here, Paul. And just want to put into context a little bit of what we're witnessing here. Nobody likes when they see the value of anything they've got go down, unless they're, defrauding the insurers. But here's the deal. When we look at the S&P 500, it's down a little over 1% if you look at the past month. It's up, if you go back 3 months, roughly 1.5%. You are expecting, and you're telling people, get ready, there's going to be a 5% drop, maybe even greater. And the way you said it to us was there's going to be some damage, and it's going to take time to repair it. So As an average investor, what should we be preparing for looking forward?
And it's good to see you too. Look, I was on with you a couple of weeks ago to begin the year. Market was at an all-time high. And what I said was, I fully expect a 5% plus pullback in the first quarter. And I think the S&P is probably down roughly 4 and change right now, along with the Dow. The other indices are down much more. And my roadmap would be something like a pullback in the first quarter, we regain it in the second quarter. The bigger decline comes in the third quarter, we regain it in the fourth quarter. The year is all about patience, frustration, and quality. It's not going to be a fun year. But regarding right now, the market's trading, there has been damage done, and it's going to take time to repair. But given what the Fed has thrown at it, the market's done fairly well. Given the inflation numbers, the market's done phenomenally well. The average investor, if you're nimble enough to prune, to harvest some acorns for the winter, I think you'll be well served. The problem, Adam, is that the average person is overloaded with and over-owned and over anything else you want to call it, with the mega cap tech stocks. And so many of those people, similar to the refrain I heard 20 years ago 21 years ago now, I'm not selling them. They've been great. Well, you quoted returns, and it all depends on the context. Are you looking at the 1 week, the 1 month, the 1 quarter, the 1 year? So some of these tech stocks are going to be in for some hurt this year. So the individual investor, you shouldn't be overweighted in mega cap tech. Use what rallies we get to feed the ducks, to sell a little bit. But don't sit back and think that this year is going to be hugely rewarding for big tech. It's not.
Paul, as you mentioned, we have a Fed that's set to start raising rates and tightening financial conditions. We've received disappointing earnings results from many of the big banks and other early reporters so far. Are there positive catalysts you see coming up for the market, or should investors be bracing for more volatility for a while?
Yes, to answer all your questions. So one, bank earnings are notoriously difficult to read, way above my pay grade. But let me say, and we own JP Morgan and some others. I would not overreact because of what happens right around earnings. Bank earnings, difficult. You normally see a pullback. I wouldn't read too much into that. Regarding everything else, yes. I mean, earnings are going to slow. GDP is going to slow this year. The Fed is the main culprit here. It's not Omicron. I said this back on October 28th with you guys. The spin can be Omicron. It's not. This is all about the Fed. They should have begun the taper in the summer of 2020, very slowly and gradually, so they could slowly and gradually raise rates, so they can slowly and gradually feed some of their assets into the market. They denied inflation was an issue. Now they're playing over catch up, just like they did in Q4 of 18 when the stock market went down 20%. And while I don't think 20% is a decline in the cards for the first quarter, any decline we get, the volatility, we're going to have a volatile year. You want to blame someone? Blame Jay Powell. And this is all at Jay Powell's feet. He saw what the government was doing. The government was stimulating the economy and overstimulating it. And I get it. It's not a partisan statement. Both Republicans and Democrats did it. But the Fed just kept pouring gasoline on it, and they're fully to blame for this and what comes the rest of the year.
When we talk about these kinds of things, especially interest rates, most of us experience interest rates through the loans, whether it's a car loan, credit cards, or mortgages. We have a video up right now, the housing market demand driven by millennials aging into home ownership. I want to get your analysis of what should, again, as average investors, how do we play what we know is coming? There's going to be an increasing interest rates, but we also have on the other side, mortgage rates going up. We have great demand from a whole class of people who are forming families and want to get out of their parents' homes or out of their roommate situation. Is there a way to appropriately use that very on-the-table fact to invest?
So you brought up interest rates, and you specifically said mortgage rates, I think credit cards and auto loans. Our thesis for this year is the bond market is going to form a low in the first quarter. Whether or not the 10-year gets above 2%, we can argue. It doesn't matter. I think you can buy any yield spike above 2%, and I think you'll be rewarded this year. I think mortgage rates will actually trend lower the second half of the year and reward those millennials are actually, there's a generation behind it. I can't remember the name of it because they call me the boomer now. But I would not worry if I were younger, looking to get out of my parents' house, my roommate situation, buy a car, take out a mortgage, because I think those rates, while the short-term rates the Fed controls are going to go up, I think those long-term rates are going to stabilize and then trend lower last 3 quarters of the year and reward everybody. So I'm not so concerned there. The big problem, frankly, for those folks is the real estate prices are outrageously expensive. So patience is a virtue in the real estate market.
Okay, Boomer, you set yourself up for that when you called yourself.
My kids call me it all the time, Adam. I can't get away from it.
Well, I'm almost a boomer. I'm actually early Gen X, but behind us, Gen Z, millennials.
I'm 55. I'm not really I'm not a boomer, but
you're Gen X.
If you're 55, you're Gen X. House. Right, we're in the same.
Allowance. Paul Schatz, the president of Heritage Capital. All the best to you. Thank you for joining us. We'll be right back with the latest regarding COVID-19 and Omicron.
Welcome back. It's been 2 years since the first confirmed case of COVID-19 was found in the US, and the world has changed quite a bit since then. Yahoo Finance's Anjali Kamlani joins us now to break this down for us, and also the latest on the response from the White House as the Biden administration gears up to make 400 million N95 masks available free to the public. Anjali, take it away.
That's right, Emily. Let's start on that news first. President Joe Biden is set to speak in later today and discuss a lot of things about the response to the ongoing pandemic, but in addition, make an announcement that many health experts have been waiting for, and that is free N95 masks for the American public. And that is going to be about 400 million distributed through pharmacies as well as community health centers, which, if you recall, have been the sites for vaccines. It's 4 per house. The N95 mask is going to be through those vaccine sites, as well as the idea that shipping is going to be beginning this week, and we're going to start seeing these really in hand starting late next week is what we're hearing, and then the kickoff for the full program by February. So that's really important. We also know, of course, that the launch of that website for the test was today, and we have seen largely an easy process to get yourself in that queue to receive those at-home rapid tests. Some glitches for especially multifamily homes were reported, but those are being resolved according to the United States Postal Service. So a lot of movement on things that health experts have been calling for some time, and things that have actually been largely available in other countries throughout this pandemic. And of course, as we enter year 3, a lot of things to look back on and to gauge the progress. I had a chance to sit down with Dr. Anthony Fauci, who we all know, of course, is the director of the National Institute of Allergy and Infectious Diseases, and talk about his time in the last 2 years. And I asked him quite simply whether or not he's surprised if we, by the fact that we are where we are right now. Here's what he had to say.
Well, I think virtually everyone thought that when we had a vaccine as effective and safe as the vaccines we'd have now, that we would get enough people vaccinated that we would handle the variant that we were dealing with, and that we would have a diminution of infection, not only in the United States, but hopefully, if we were able to get vaccines to the low and middle income countries, that we could also essentially get our arms around, as it were, the pandemic globally.
So as you can hear, a lot of surprise, and considering we know there was multiple things that led up to why we are here today, but of course, vaccines still being viewed as the way out. Back to you.
Anjali, we're going to have you join us for our conversation with our next guest. Dr. Tyson Bell is Assistant Professor of Medicine in the Divisions of Infectious Disease and Pulmonary Critical Care Medicine at the University of Virginia. Dr. Bell, thank you so much for your time. I want to start off with some news in your home state. Virginia Governor Glenn Youngkin has issued an executive order allowing parents to opt their children out of school mask mandates. Democratic lawmakers, some school districts, and parents have already been pushing back against this. What's your response to this order and how this might impact COVID spread in your state?
Well, thanks for having me on. And I completely disagree with his executive order. So it's coming at the wrong time, right at the moment where we're about to hit our peak of cases in the state of Virginia. So I'm happy that my school board, Albemarle County, decided to stick with the CDC guidance, what they're required to do by law. But he argues that masks are both not effective and they're not practical. And he's wrong on both fronts. We have multiple studies now that have shown that using universal masking in schools is a way to decrease transmission. And it's part of an effective strategy of test, trace, isolate, and vaccinate, of course, because we need to do many things in order to try to prevent the spread of disease. And then when it comes to practicality, you just have to look at my 2 children. I have a 3-year-old and an 8-year-old. They've been wearing masks for over a year now. And let me tell you, it is the only thing that I can get them to consistently do. I ask them to pick their toys up off the floor, kiss it goodbye, but they will wear that mask. And so I think, the arguments that he make are not sound and they just don't make sense, and it's not the right time.
Dr. Bell, Anjali here. Good to speak with you again. I want to talk about, you mentioned, preparing for the surge there. I know a lot of focus has been on the Northeast and the states that have already possibly crested. And what you feel in terms of preparation right now, we know that while PPE is not in short supply as it has been in the past, the idea of treatments being available now and what is actually accessible, do you feel like we are at a point where there's enough to go around?
Well, we certainly aren't there yet because we have to ramp up production. And when it comes to treatment, we're really focusing on, at least for now, trying to prevent people that are high risk from going to the hospital. Now, there's recent news about the Paxlovid pill, which is Pfizer's pill, up to 90% effective at preventing death and hospitalization when used. And it's a pill which is much easier to administer than monoclonal antibodies, for instance. The production is going to be the issue, right? So making sure that it's in communities that are high risk and people have accessibility to it. It also needs to be given within 5 days of symptoms, like, similar to many of the other medications, they're better used early on in the course. So early testing is going to be very important as well. So these are all things that we need to do to combine together to keep in the toolkit so we can continue to beat back the wave.
Hey, Doc, it's good to see you again. When we look at where we stand with this wave, and a lot of us have fear when we hear Dr. Fauci say things about the worst case scenario is a variant that eludes vaccine protection. But what we know through other viruses and pandemics, how likely is that, worst case scenario? Don't these things tend to have a life where they become over time weaker and there is an immunity among the population as a whole?
Right. So one way or another, the waves of different variants are going to burn through the population. And the question we have to ask ourselves at a global scale is, do we get there through vaccination and people being protected, or do we get there through people going to the hospital and meeting people like myself in the ICU where their life is at threat? And so I would argue that vaccination is really the way that we need to go if we want to keep the economy open, keep hospitals from being overstrained and overwhelmed, and get through this and be prepared for the next wave. And when we talk about vaccination, the importance of it, I mean, all you have to do, if I had the ability to and have you come to my ICU, you would see the stark difference in who's coming to the ICU now. They are unvaccinated people by and large. My hospital, about 75% of the people with symptomatic COVID are unvaccinated. And if you go and find the other rest, or 25% who are vaccinated, these are people with things like organ transplants, stem cell transplants. There are multiple medications to suppress their immune system. So there's really is this stark difference now that vaccinations are out and who's getting sick with COVID.
Dr. Bell, I wonder your thoughts on specifically on that point. We saw a CDC report to just show that prior infection provides better protection in addition to vaccines against Delta specifically. But we also know that there are individuals who still remain unvaccinated, and some people think that Omicron, widely spread, could help with that catch up of some level of, herd immunity, I guess. I know no one really likes using that term, but tell me about how you see all that sort of unfolding and maybe the message it sends to potential patients.
Right. So natural immunity is a way to achieve some protection. And I think, what's been confabulated is that some people are promoting that natural immunity is the better alternative to vaccination, which it clearly is not. So the reason is just like when you have immune protection from the vaccine, it can wane over time and you get a booster. Well, you can't do that with infection, right? Once you get infected and your protection goes away, it's gone. And so the rate of reinfection is higher. And for folks who have been infected with COVID before, if they get vaccination, their chance of being infected again is lower by a factor of 2. And so there's really no arguing with the fact that vaccines are the way to go, even if you've been infected. And my concern is that if people are relying on getting immunity through infection and not following up with vaccination, we're going to be right back to square one when it comes to, being 6 or 8 months down the road, another variant comes, and the people who relied on natural immunity without vaccination are kind of left out to dry.
Dr. Tyson Bell is Assistant Professor of Medicine in the Divisions of Infectious Disease and Pulmonary Critical Care Medicine at the University of Virginia. And Yahoo Finance's Anjali Kamlani is our own healthcare reporter. And we thank you both so much for your time. Coming up, crude oil prices have soared, with West Texas Intermediate futures hitting their highest level since 2014 as energy demand picks up. We'll discuss the oil outlook on the other side of this break.
And welcome back to Yahoo Finance Live. We've got about 35 minutes to the closing bell, but we're already watching oil prices. I mean, oil is gushing. We saw the WTI, trading at higher than $86. The futures were trading higher than $86 a barrel. And Brent is up above $88 a barrel. Let's talk about what's happening in energy and much more, because a lot of investors are looking at opportunity here. Bob Iacchino is the Path Trading Partners co-founder and chief market strategist, as well as the stock think tank portfolio manager. That's a lot for me to say in one breath, but it's good to have you here. When we talk about oil, hello 2014, how are the wife and kids? I mean, this is where we were roughly 8 years ago. What does that mean about where we're headed, though?
Well, unfortunately, I don't think we're going to get a lot of relief in the price at the pump and other oil-related products anytime soon. We might get a $2 or $3 drop in the price of crude oil as we start to sift through exactly how much supply is going to be affected by the drone attack a couple of days ago on the UAE. But other than that, there's just not a whole lot of spare capacity out there. You really only have 2 OPEC nations that have spare capacity. One of them is the UAE. So they can clearly, the drone attack was on storage facilities, so they can clearly fill those storage facilities up if they have enough places to store the actual crude oil that they're going to pump. Saudi Arabia has been very reluctant, has not responded to overtures by President Biden and the administration to loosen production. And then, of course, we got the tension with Russia, where Russia knows, Vladimir Putin knows, that he can use oil production as another thing to kind of counteract the pressure he's getting from Western countries to kind of back off on the Ukraine. You add to that the sort of diminishing, especially in the Northeast, cases of Omicron, the global demand that's going to come from China, because they're actually engaging in easier monetary policy as their economy slows a little bit. It's likely prices are going higher, maybe not tomorrow, but in the very short to medium term.
As you alluded to in your answer there, this jump in oil prices has certainly posed a concern for the Biden administration as it attempts to bring down inflation. Do you expect any further action out of the White House in the near term to try to bring down these prices?
Well, Emily, there's nothing they can really do other than releasing from the SPR, and that has to be something that's unscheduled and shocking rather than something that's a part of the scheduled releases that's just accelerated. So, and that would only be temporary anyway. I don't know what kind of pressure they can put on. I believe that the administration is taking the right path, considering that the problems with Russia via the Ukraine is much more important than short-term oil prices. However, they can exert more pressure on Saudi Arabia specifically. It's just a matter of whether it's going to work or not. In terms of U.S. production, we're still about 1.5 million barrels short of where we were at our peak, and still about 1 million barrels, maybe a little bit less than that as of this month, from where we were pre-pandemic. The Permian is now pumping out a record amount of oil, but the rest of the basins have been very cautious, whether it was from CapEx, new drilling, and as we all know, shale drilling. Those oils tend to produce a ton of oil in the beginning and then taper off very quickly. So you have to actually have capital expenditures to get those new oils, those new wells pumping. We had a lot of drilled but unconcluded wells. Those have pretty much come to their conclusion now and are pumping oil. So there's really no way for the oil to get to market fast enough to slow what we're seeing as potentially $100, $105 barrel of oil soon. As many analysts say, our target was 98. Goldman's right around 105. I think Goldman's looking more like they're going to be right.
Hey, Bob, help us understand what happens if Putin and Russia do invade Ukraine. What happens to energy markets? Would this be a black swan event? I'm not sure it's so black swan since everyone's anticipating it.
Well, not necessarily. It really depends on how Vladimir Putin wants to handle the situation, especially with natural gas. It would affect natural gas immediately. And I think one of the things you saw with the drone attack, and this relates to the Russia-Ukraine situation, is it showed the market and market participants like myself and others just how vulnerable we are to geopolitical shocks in the energy markets, unlike 2018, 2017, when the US was pumping. 2019, we almost reached 13 million barrels a day here in the US, down about 11.5 million, 11.4 million toward the end of last year. So I think it just showed the vulnerabilities of it. And that's really of Vladimir Putin question. You talk about Russia's contribution or participation in OPEC Plus. They haven't really reached an agreed upon quota of crude from their specific production levels in 12 months. Even though the production levels have been increasing at OPEC Plus meetings, Russia has not met their quota, whether that's by choice or just simply because they hadn't had the economic wherewithal to actually pump that much. I believe it's the former rather than the latter. I believe it was a choice.
Bob, what do you think the price action recently and going forward in oil means for energy stocks and the sustainability of this outperformance we've seen so far? Because for the year to date, and of course it still is just January, but the S&P 500 energy sector is up nearly 17% and definitely far outperforming the broader index.
I think it's definitely a little bit long in the tooth in terms of its outperformance. That's probably going to start to slow. We still have ESG concerns where you're going to see some of these stocks fall out of favor. That's still a very desirable type of investing, although it's fallen out of favor in terms of the amount of overperformance you're getting from ESG lately. That may change. We still have the desire for automobile companies, Ford especially, some of the new companies to get away from fossil fuels. So I think the energy rally in terms of outperformance is a little bit long in the tooth. But still, if you're looking at 98 as we are, 105 as Goldman is, you're still going to get some strength out of that energy sector.
Bob Iaccino, always good to see you, Path Trading Partners co-founder and chief market strategist, as well as the stock think tank co-portfolio manager. All the best to you. When we come back, $3.3 million. That's how much a 2020 McClaren just sold for at auction. But what does the future hold, especially if you have some cash to burn? We've got the CEO of McClaren Americas, the president of McClaren Americas, coming up right after the break.
Time now for our 2 and 2. Two stocks I'm watching and two stocks Adam is watching during today's session. And let's take a look first at shares of Sofi Technologies. Now, this stock is soaring after it received a bank charter to become a national bank from the U.S. Office of the Comptroller of the Currency overnight yesterday. Now, this comes after Sofi acquired Golden Pacific Bank as part of its plan to move toward receiving this banking license. And this is something that's going to allow Sofi to continue building on its suite of financial technology products. Now, Now, according to Anthony Noto, the CEO of Sofi, he said in a press statement earlier that, quote, with a national bank charter, not only will we be able to lend at even more competitive interest rates and provide our members with high-yielding interest in checking and savings, it will also enhance our financial products and services to ensure that they efficiently meet the needs of our members, business partners, and communities across the country while continuing to uphold a high bar of regulatory standards and compliance. Now, we should note, however, that this new license does not cover crypto transactions, but nevertheless, SoFi shares were up more than 18% today at session highs. They're holding on to most of those gains, and those shares are still on track for their best day since the stock went public via a SPAC merger in the middle of last year. Then there are shares of United Health. Now, this Dow component was one of the names to report quarterly results this morning, and the results were stronger than expected across almost all major metrics. Now, we saw fourth quarter revenue grow to $73.7 billion, whereas the estimate was for just under $73 billion among consensus analysts on Wall Street, and adjusted earnings per share came in at $4.48. Now, the big driver of these results came in United Health's Optum Health Services segment, which comprised more than half of United Health's annual operating profit last year, and also eclipsed its insurance business in terms of profit contributions for the full year 2021. Now, the company also reiterated its guidance for the current fiscal year, and it sees 2022 revenue of between $317 billion and $320 billion, or well ahead the about $316.9 billion that consensus analysts were expecting. Now, those shares are currently up about 0.6 percentage points this afternoon, erasing some of those earlier gains, but still outperforming the broader market. Adam.
Emily, take a look at what's going on with United Airlines, especially since they're going to report results for the fourth quarter after the closing bell. They won't have their investor meeting and the phone call till tomorrow, but shares right now are down about 2.25%. When you look at where the stock stands today versus 2 years ago, remember, this time 2 years ago, as Anjali reported, we had the first positive case of COVID found in the United States. Well, the stock is now off 50% since this day in 2020. So got to keep an eye on that. Some of where we stand, though, the company is rebuilding, as are all the airlines. We saw Delta had a much stronger quarter than some people had feared they would have. So the question for Scott Kirby and team is, where are you headed? Especially the 5G issue has been avoided, but there is still the Omicron waves, which had an impact on United as we ended the quarter. So we're going to be paying attention to that. Then take a look at Procter Gamble. Those shares are up today. They were up at one point about 5%. They reported for the most recent quarter that revenue was better than expected, came in at $20 would not be great, $20.95 billion. CEO was on Yahoo Finance Live this morning with Brian and with Julie and the team, and talked about the fact that they've had to raise prices, but they said that the consumer has been able to absorb those prices. So investors seem to think that Procter & Gamble is accurate in that. They've also said that they might take a little bit of a breather trying to figure out if they need to continue with the price increases, but not immediately. Emily?
Adam, let's shift gears now and talk about the outlook for autos, Formula One, and McClaren with Nicholas Brown, McLaren America's president. Yahoo Finance's own producer and auto reporter Prasu Romanian joins us as well. And Nicholas, thank you so much for your time this afternoon. McLaren sales were up 14% in 2021 over 2020, and your sales in North America just exceeded 10,000 as of December. What drove these results, especially in a year still impacted by the pandemic?
Yeah, so first of all, thank you for having me on today. So in terms of what drove these results, so we have an incredibly passionate and engaging owner base, and we launched some key models here in the US. So last year we launched the 765LT Spider, so our very much track-focused version of the 720. Now, this vehicle has 4 times the demand as we will have supply. So this was one of the key driving forces. Then we also launched the Elva at the beginning of last year. So this is our open cockpit hypercar. The Elva goes for over $2 million in the US and in the Americas. And this was also a key product for us last year.
Hey, Nicholas, Pras here. It's frankly amazing you guys were able to sell so many of these sports cars and hypercars last year when you guys don't have a sedan or SUV. Many of your competitors, Aston Martin, Ferrari, will soon have an SUV. Do you think that McLaren could have an SUV in its stable, or is that not part of the brand's DNA?
So we have no plans within our product plan to launch an SUV. So our focus is really on building and producing the vehicles that our customers long for. And these are driver-focused vehicles, track type vehicles or track vehicles for the road. And everything really revolves around this Formula One DNA that our customers love.
You know, speaking of that future and that DNA of the brand, I know electrification is a big part of McLaren's future, and the Artura is the next step, the hybrid supercar. So why go hybrid here instead of full EV, and what makes it so special?
Yes, so that's a great point, Pras. And the Artura, our high performance hybrid, which will go on sale at the end of Q2, beginning of Q3 this year, really represents the future of McLaren, and is the most significant launch that we've had since we introduced the 12C back in 2011. And when we look at Artura, and to answer your question regarding why not go full EV, one of the great things about being so interconnected with racing, with Formula One, is that for us, it's not about bringing out a hybrid simply for the sake of bringing out a hybrid. It's about answering the question as to how will this benefit the customer, and how will this enhance the visceral feeling that customers come to expect from McLaren. So this is a vehicle, a true supercar, has over 670 horsepower, 0 to 60 in under 3 seconds, an incredible car to drive, but you'll have over 50 miles per gallon. And the e-motor enables you to have just this ferocious throttle response. And actually the throttle response is the quickest out of any McLaren.
I love these adjectives, ferocious and supercar, because I quoted in the tease the fact that one of a 2020 McLaren just sold for $3.3 million at the Mecum auction. And I was curious, for the people who have the ability to purchase one of these incredible machines, should they look at it as an investment? Should they look at this as a reward for, I have arrived at a point in life where I can enjoy something spectacular? What's the outlook for that?
At the core, our customers are really focused on driving, and our customers drive their vehicles a lot. In terms of values, what we have seen is that values have gone up and strengthened considerably. And if we look at the 765 LT Coupe as an example that we launched in 2020, on the pre-owned market, those vehicles are now going 40 to 50% over the original MSRP, which is, of course, something that our customers love to see.
Hey, Nicholas, I know lots of talk out there about McLaren's future. I know you can't comment on it specifically, but would you prefer to be part of a bigger corporate parent, or maybe do you think McLaren prefers its independent roots? It's always an independent company, even in the racing car division too.
Yes. So I can't say that anything in the media currently is purely speculative. We do partner with obviously suppliers, and we also work with technology partners as well as some other OEMs in developing the technologies that we have. But the core of the brand, as mentioned, is always going to revolve around that track focus, racing, and really producing vehicles that our customers expect from us.
All right, we will leave it there for now. Nicholas Brown, McLaren America's president, and Yahoo Finance's own Pras Subramanian. Thank you both so much. Coming up, we'll get a check of the crypto markets as Bitcoin prices hover around $42,000. That's up on the other side of this break.
All right, 14 minutes to the closing bell and to President Biden's press conference, but we want to turn our attention to what's happening in the crypto markets, and we're going to do that now, me and Emily, as we bring into the stream Dominic Dante, CoinDesk Markets analyst, and it's good to have you here. For people who love Bitcoin, and we should always point out, Bitcoin might be the granddaddy of them all, but there's so many other ways to invest in crypto. Bitcoin, though, has been volatile, and it's recovering today. But you've pointed out to us that the spot trading volume at its lowest level in 6 months. So for crypto investors, what does that mean?
Yeah, it just means that there has been less trading activity relative to prior highs. The prior high in volume we saw was around December 5th. And that's kind of when Bitcoin had a little bit of a jump and then kind of phased out. December was a rough month, and then coming into January, a little bit rougher. So typically you have the seasonal effect where speculative assets like equities and cryptocurrencies tend to have a weaker start to the year in January. So we saw some of that seasonal headwinds come in. Of course, you had macro headwinds come in as well. And those are keeping traders on the sidelines for now. There's been some talk about a possible short squeeze because leverage has been sort of skewed towards the short side in the Bitcoin options market. So we are looking for that around the 40K level is where we've been stabilizing. But for now, we've had a trend of lower highs since the November peak around 69K. So the trend is pretty much towards the downside. So any upside we see from here might be limited.
Dominic, this is Emily here. One other trend that CoinDesk has been pointing out is this rise in accounts or addresses that have a relatively small amount of Bitcoin, so between 0 to 100 Bitcoin over the past month. What does this suggest about volatility going forward and price action? Because we know, at least in equities, that the rise in retail investors did drive some volatility last year. And is that the same for Bitcoin?
Yeah, that's been interesting. So typically, like you said before, like when we see the retail traders come in, that typically creates some volatility because they tend to be very short-term in nature. They buy and they sell pretty quickly, rather than the larger account holders who hold about 100 to 1K BTC in their address. Those account holders don't really have a lot of volatility. They tend to buy and hold for the longer term. The interesting dynamic that we saw was that the shorter term holders or the retail traders have been accumulating Bitcoin through the price dips. However, the whales or the larger Bitcoin holders have been relatively stable. So there hasn't been a lot of conviction behind the Bitcoin move like we've seen in prior bull runs. So we need to see both participations come to play, the retail traders and the long-term buy and hold investors. But for now, I think the long-term headwinds from the macro point is keeping a lot of investors a little bit skittish and on the sidelines. So until we see some capitulation by the short sellers, the buyers might be coming back to enter probably at lower support levels where they see more of a discount in terms of Bitcoin's price.
But for people who want to get into crypto, and I realize the prices of Bitcoin might be prohibitive unless you're doing some kind of fractionalization, but when you're looking at other cryptocurrencies, for instance, Solana, what are the differences that as an investor who might be, for the first time stepping into this, that I should consider as the differences between a Bitcoin and, say, a Solana, or are they pretty much the same thing?
Yeah, a lot of investors look at the use cases. So you want to see an increase in transaction activity and scalability over the long term. A lot of investors look to Bitcoin as a store of value, whereas these other tokens like the Ethereum killers are looking for more efficient solutions on the blockchain so that they can, spur off activities such as decentralized finance and things like that. So you want to really look at that use case and scalability potential that can increase the value over time. It's tough to value these tokens, But that's the general thing. It's very early, and you have a lot of these players. So the best will win somehow, and you really look at it in terms of a portfolio. So also the altcoins tend to be more speculative, higher beta, a little bit more risky, and then Bitcoin is the less riskier in the crypto space. So that's how you kind of look at it in terms of relative valuations.
I wish you were there holding our hands when we were about to jump into the cryptocurrency assets. All the best to you, Dominic Dantes, CoinDesk market analyst. We look forward to you coming back here to Yahoo Finance Live. All right, 9 minutes to the closing bell, and then, of course, President Biden's big press conference.
Welcome back. We're minutes away from the closing bell, and Yahoo Finance's Jared Blickery is here to tee us up for that. And Jared, it looked for a while like we were going to be getting a positive day out of the markets, but now it's looking like the Dow is heading for a fourth straight day of declines.
Yes, and all the more inauspicious because it looks like we had the beginnings of a turnaround after a day of very heavy selling. So when you get continuation on the second day, it is very telling. So let's take a look here. We got the Dow down about 300 points. We got the Nasdaq off about 1, and the S&P 500 down 0.8%. And we want to take a look at the 10-year T-note yield. That is still down about 4 basis points, pretty close to the session lows, wrapped up trading an hour ago at 3 p.m. And then the US dollar is weaker. And this is really a day about a couple of different narratives. And one of them is commodities. Just want to highlight WTI crude futures. Energy is a laggard today in terms of stock sectors, but WTI just closed at a fresh 7-year high. And you take a look at what gold is doing today. That is up and away as well. I'm going to put a 2-month candlestick chart, and you can see this big green candle. Haven't seen one of those in several weeks here. And here's a 6-month look at gold, which has been trending sideways, but a lot of focus on a potential breakout here. Do want to get a check of the miners. Speaking of gold, these are the gold miners today. Big breakout here, and we're also seeing some continuation elsewhere, but for the most part, everything in the red except for staples, and that's really a story surrounding the P&G earnings from earlier this morning. Now that stock is up 3.5%. It's a consumer staple, not a high flyer, but still holding on to gains of 21%, as Staples has been attracting some defensive money recently. What stands out here, industrials taking it on the chin. We got Boeing and also Caterpillar each off 3%, and a mixed picture for the mega caps. You take a look at Apple and Amazon each down more than 1%, but Microsoft still holding on to some small gains there, as is Facebook. But as stocks and indices sink into the red, a lot of these green names are flashing and switching over to the red side. Guys?
Yahoo Finance's Jared Blickery, thank you so much. We've got the closing bell and President Joe Biden's press conference coming up. Stick with us. Welcome back to Yahoo Finance Live. Let's bring in our market panel now to take us through today's trading action and where we may be heading. Andy Capron is Region Atlantic Co-Chief Investment Officer, and Rhea Thomas is Wilmington Trust Senior Economist. And just want to note as well that we are awaiting the start of President Joe Biden's press conference marking his first year in office. We'll be taking that live once it starts. But before we head to our panel, want to get one last check of the market action before the closing bell. As we can see here, we are accelerating to the downside on the three major stock indexes. The Nasdaq Composite is the laggard once again, seeing those tech shares coming under renewed pressure, down about 1.2% as we speak, with about a minute or just under a minute to go until the closing bell. The Dow Jones Industrial Average down more than 300 points, or about 1%, and the S&P 500 down about 0.9 percentage points heading into the close. And here's the closing bell.
Okay, we have a closing bell, we have a gavel, and put that in the history books. What's past is past. We're going to look to the future, but we got to see where we're going to settle. The Dow's going to be off almost 1%, accelerating, as Emily said, in the last few minutes of the trading session, down 339 points. S&P 500 is going to settle down 1%. It's off about 44 points. Nasdaq down a little bit more than 1%, losing 166 points. Let's get to the panel because we are awaiting President Biden. But let me start with you. Ria, the thing that I think catches a lot of us by surprise is the speed with which, and I realize it's a year to date and we're only 3 weeks into January, but the speed with which we have sold off, for instance, the S&P 500. As you know, as we look at this, are we overreacting?
Well, we're not actually surprised by the volatility in markets this year. You do have a Fed that is expected to raise rates, and not just raise rates, but also start running off its balance sheet. And during periods when the Fed is withdrawing accommodation, there is some expected volatility. We do think that the Fed will be able to remove this accommodation, though, while still keeping the economic recovery on track. We do expect the Fed to raise rates by 2 to 3 hikes this year, rather than the full 4 that the market seems to be pricing now. So we do think that the Fed will have a bit more of a moderate withdrawal of accommodation than the market's currently pricing, and we think that that will allow the economic recovery to continue in our view.
Andy, taking a look at the price action today, the Nasdaq Composite down 1.2% and entering a formal correction, down 10% from a recent record high. I'm wondering, do you think the selling pressure is potentially over, at least for now, for the tech shares and for the growth stocks, or do you think there still could be more volatility from here?
I think time will tell, and in particularly the next couple of weeks.
I've got to interrupt everybody.
Earnings.
President Biden is now at the podium and addressing the country through a press conference. Let's go to Washington, D.C. for the president.
It's been a year of challenges, but it's also been a year of enormous progress. We went from 2 million people being vaccinated at the moment I was sworn in to 210 million Americans being fully vaccinated today. We created 6 million new jobs, more jobs in 1 year than any time before. Unemployment dropped, the unemployment rate dropped to 3.9%. Child poverty dropped by nearly 40%, the biggest drop ever in American history. New business applications grew by 30%, the biggest increase ever. And for the first time in a long time, this country's working people actually got a raise. People, the bottom 40%, saw their income go up the most of all those that got a raise. We cut health insurance premiums for millions of American families, and we just made surprise medical bills illegal in this country. You know those bills you get that you don't expect of $2,000 to $5,000 from the hospital beyond what you thought you were going to have to owe because of the consultation you weren't told was going to cost that much? No more. They're now illegal. Thanks to the American Rescue Plan and other actions we've taken, we've seen record job creation, record economic growth in the past year. Now, thanks to the bipartisan infrastructure bill, we're about to make a record investment in rebuilding America to take us to be the #1 best infrastructure in the world. Well, now we're way below that. We'll be creating better jobs for millions of people, modernizing our roads, our bridges, our highways, our ports, our airports, everything from making clean water, removing lead pipes, so that every American can turn on a faucet and drink clean water. Urban and rural and suburban communities. It's going to make affordable high-speed internet available to every American in urban, rural, and suburban areas. We've never done that before. Now we are. We're in the process of getting that done. Still, for all this progress, I know there's a lot of frustration and fatigue in this country. And we know why. COVID-19. Omicron has now been challenging us in a way that it's the new enemy. But while it's cause for concern, it's not cause for panic. We've been doing everything we can, learning and adapting as fast as we can, and preparing for a future beyond the pandemic. All I know that after almost 2 years of physical, emotional, and psychological weight of this pandemic and the impact it's had on everyone, for many of us, It's been too much to bear. We're in a very different place now, though. We have the tools, vaccines, boosters, masks, tests, pills to save lives and keep businesses and schools open. 75% of adults are fully vaccinated. We've gone from 90 million adults with no shots in arms last summer and down to 35 million with no shots as of today. And we're adding about 9 million more vaccinations each week. We're going to stick with our vaccination efforts because vaccinations work. So get vaccinated, please, and get your booster. Look, we're also increasing testing. Should we have done more testing earlier? Yes, but we're doing more now. We've gone from 0 at-home tests a year ago to 375 million tests on the market in just this month. If you buy a test at a store, your insurance will reimburse you. On top of that, we're making 1 billion at-home tests available for you to order and be delivered to your home for free. Just visit covidtest.gov to know how to get that free test kit to your home. In addition, there are 20,000 sites where you can get tested in person for free now. And now we have more treatments that people can, for people to keep people out of the hospital than any other point in the pandemic, including life-saving antiviral pills. We purchased 20 million of these new Pfizer pills, more than any country in the world. The bottom line on COVID-19 is that we're in a better place than we've been and have been thus far, clearly better than a year ago. We're not going back to lockdowns. We're not going back to closing schools. Schools should stay open because the American Rescue Plan, we provided to states $130 billion, $130 billion to keep our students and educators safe and schools open. Funding for ventilation systems in schools, social distancing, hygiene for classrooms and the school buses. In addition, we've added another $10 billion for COVID-19 tests to be able to be administered at schools. And many states and school districts have spent this money very well. Unfortunately, some haven't. I encourage the states and school districts that use the funding to protect our children and keep our schools open. Use it. The COVID-19 is not going to give up and accept things. It's just not going to go away immediately. But I'm not going to give up and accept things as they are now. Some people may call what's happening now the new normal. I call it a job not yet finished. It will get better. We're moving toward a time when COVID-19 won't disrupt our daily lives, where COVID-19 won't be a crisis, but something to protect against and a threat. Look, we're not there yet, but we will get there. Now, the second challenge we're facing are prices. COVID-19 has created a lot of economic complications, including rapid price increases across the world economy. People see it at the gas pumps, the grocery stores, and elsewhere. So here's what we're going to do. A critical job in making sure that the elevated prices don't become entrenched rests with the Federal Reserve, which has a dual mandate: full employment and stable prices. The Federal Reserve provided extraordinary support during the crisis for the previous year and a half. Given the strength of our economy and the pace of recent price increases, it's appropriate, as the Federal Chairman Powell, the Fed Chairman Powell has indicated, to recalibrate the support that is now necessary. I respect the Fed's independence, and I've nominated 5 superb individuals to serve on the Federal Board of Governors, men and women from a variety of ideological perspectives. They're eminently qualified, historically diverse, and have earned bipartisan praise. And I call on the United States Senate to confirm them without any further delay. And here at the White House, and for my friends in Congress, the best thing to tackle high prices is a more productive economy with greater capacity to deliver goods and services to the American people. And a growing economy where folks have more choices and more small businesses compete and where more goods can get to market faster and cheaper. I've laid out a three-part plan to do just that. First, fix the supply chain. COVID-19 has had a global impact on the economy. When a factory shuts down in one part of the world, shipments to shops and homes and businesses all over the world are disrupted. COVID-19 has compounded that many times over. A couple of months ago, in this very room, we heard dire warnings about how the supply chain problems could create a real crisis around the holidays. So we acted. We brought together business and labor, and that much predicted crisis did not occur. 99% of the packages were delivered on time, and shelves were stocked. And notwithstanding the recent storms that have impacted many parts of our country, the share of goods in stock at stores is 89% now, which has barely changed from the 91% before the pandemic. I often see empty shelves being shown on television. 89% are full, which is only a few points below what it was before the pandemic. But our work's not done. My infrastructure law will supercharge your effort upgrading everything from roads and bridges to ports and airports, railways and transit, to make the economy move faster and reduce prices for families. Second thing, my Build Back Better plan will address the biggest cost of working families face every day. No other plan will do more to lower the cost for American families. It cuts the cost for childcare. Many families, including the people sitting in this room, if they have children and they're working full-time, many families pay up to $14,000 a year for childcare in big cities, less than that in smaller ones. My plan cuts that in half. That will not only be a game changer for so many families' budgets, but it will mean so much for the nearly 2 million women who've left the workforce during the pandemic because of things like childcare. My Build Back Better plan cuts the price of prescription drugs. So insulin, that today costs some people as much as $1,000 a month, will cost no more than $35 a month. It cuts the cost of elder care. It lowers energy cost. And it will do all this without raising a single penny in taxes on people making under $400,000 a year or raising the deficit. In fact, my plan cuts the deficit and it boosts the economy by getting more people into the workforce. That's why 17 Nobel Prize winners for economics say it will ease long-term inflationary pressure. The bottom line, if price increases are what you're worried about, the best answer is my Build Back Better plan. Third thing we're going to do, promote competition. Look, in too many industries, a handful of giant companies dominate the market in sectors like meat processing, railroad, shipping, and other areas. This isn't a new issue. It's not been the reason we've had high inflation today. It's not the only reason. It's been happening for a decade. But over time, it has reduced competition, squeezed out small businesses and farmers, ranchers, and increased the price for consumers. We end up with an industry like the meat processing industry, where 4 big companies dominate the markets. Pay ranchers less for their cattle they grow, charge consumers more for beef, hamburger meat, whatever they're buying. Prices are up. Look, I'm a capitalist, but capitalism without competition is not capitalism, it's exploitation. So I signed an executive order to tackle unfair competition in our economy, and we're going to continue to enforce it, along with working with Congress where we can. I'll close with this. We have faced some of the biggest challenges that we've ever faced in this country these past few years. Challenges to our public health, challenges to our economy, but we're getting through it. And not only are we getting through it, we're laying the foundation for a future where America wins the 21st century by creating jobs at a record pace. Now we need to get inflation under control. We have developed an extraordinarily effective booster shots and antiviral pills. Now we need to finish the job to get COVID-19 under control. I've long said, it's never been a good bet to bet against the American people or America. I believe that more than ever today. We've seen the grit and determination of the American people this past year. but the best days of this country are still ahead of us, not behind us. Now, I'm happy to take questions. Yes.
Thank you, Mr. President. I know some of my colleagues will get into some specific issues, but I wanted to zoom out on your first year in office. Inflation is up. Your signature domestic legislation is stalled in Congress. In a few hours from now, the Senate, an effort in the Senate to deal with voting rights and voting reform legislation is going to fail. COVID-19 is still taking the lives of 1,500 Americans every day, and the nation's divisions are just as raw as they were a year ago. Did you overpromise to the American public what you could achieve in your first year in office, and how do you plan to course correct going forward?
Why are you such an optimist? Look, I didn't overpromise, but I have probably outperformed what anybody thought would happen. The fact of the matter is that we're in a situation where we have made enormous progress. You mentioned the number of deaths from COVID. Well, it was 3 times that not long ago. It's coming down. Everything's changing. It's getting better. Look, I didn't overpromise, but I think if you take a look at what we've been able to do, you'd have to acknowledge we made enormous progress. But one of the things that I think is something that, one thing I haven't been able to do so far is get my Republican friends to get in the game of making things better in this country. For example, I was reading the other day, and I wrote the quote down so I don't misquote him. A quote from Senator Sununu when he decided that he wasn't going, Governor Sununu, when he decided he wasn't going to run for the Senate in New Hampshire. Here's what he said. They were all, for the most part, content with the speed at which they weren't doing anything. It was very clear that we just had to hold the line for 2 years. Okay, so I'm just going to be a roadblock for the next 2 years? That's not what I do, Sununu said. He went on to say, it bothered me that they were okay with that. Then he goes on to say, I said, okay, so we're not going to get stuff done if we win the White House back, Why didn't we do anything in 2017 and 2018? And then he said, how the Republican Sununu spoke to answer the challenge? He said, crickets, yeah, crickets. They had no answer. I did not anticipate that there'd be such a stalwart effort to make sure that the most important thing was that President Biden didn't get anything done. Think about this. What are Republicans for? What are they for? Name me one thing they're for. And so the problem here is that I think what I have to do in the change in tactic, if you will, I have to make clear to the American people what we are for. We've passed a lot. We passed a lot of things that people don't even understand what's in it, understandably. Remember when we passed the Affordable Care Act and everybody thought that, it really was getting pummeled and beaten. And it wasn't until after we were out of office and that next campaign, when that off-year campaign, and I wasn't in office anymore. We went in a whole bunch of districts campaigning for Democrats and Republican districts who said they wanted to do away with health care, with Obamacare. And I started pointing out that if you did that, pre-existing conditions would no longer be covered. And they said, huh? We didn't know that. We didn't know that. And guess what? We won over 38 seats because we had explained to the people exactly what, in fact, had passed. Now, one of the things that I remember saying, and I'll end this, I remember saying to President Obama when he passed the Affordable Care Act, I said, you ought to take a victory lap. And he said, there's so many things going on, we don't have time to take a victory lap. As a consequence, no one knew what the detail of the legislation was. They don't know a lot of the detail of what we pass. So the difference is, I'm going to be out on the road a lot, making the case around the country with my colleagues who are up for re-election and others, making the case of what we did do and what we want to do, what we need to do. And so I don't think I've overpromised at all, and I'm going to stay on this track. One of the things that I remember, and I'll end this, I was talking with, Jim Clyburn, who was a great help to me in the campaign in South Carolina. And Jim said, and when he endorsed me, and there was a clip on television in the last couple of days of Jim, and it said that we want to make things accessible and affordable for all Americans. That's healthcare. That's education. That's prescription drugs. That's making sure you have access to all the things that everybody else has. We can afford to do that. We can't afford not to do it. So I tell my Republican friends, here I come. This is going to be about what are you for? What are you for? And I'll lay out what we're for. Mary Bruce, ABC.
Thank you, Mr. President. You mentioned your Republican colleagues, but right now your top two legislative priorities, your social spending package and voting rights legislation, are stalled, blocked by your own party after months of negotiation. You are only guaranteed control of Washington for one more year before the midterms. Do you need to be more realistic and scale down these priorities in order to get something passed?
No, I don't think so. When you say more realistic, I think it's extremely realistic to say to people, because let me back up. You all really know the politics in this country and your networks and others. You spend a lot of time, which I'm glad you do, polling this data, determining what the American people's attitudes are, et cetera. American people overwhelmingly agree with me on prescription drugs. They overwhelmingly agree with me on the cost of education. They overwhelmingly agree with me on early education. They overwhelmingly go on the list on child care. And so we just have to make the case of what we're for and what the other team's not for. Look, we knew all along that a lot of this was going to be an uphill fight. And one of the ways to do this is to make sure we make the contrast as clear as we can. And one of the things that I think is we're going to have to do is just make the case. I don't think there's anything unrealistic about what we're asking. I'm not asking for castles in the sky. I'm asking for practical things the American people have been asking for a long time, And I think we can get it done.
You're not going to scale down any of these priorities, but so far that strategy isn't working. You haven't been able to get some of these big legislative ticket items done.
I got two real big ones done, bigger than any president has ever gotten in the first year.
But currently, Mr. President, your spending package, voting rights legislation, they're not going anywhere. So
that's true.
Is there anything that you are confident you can get signed into law before the midterm elections?
Yes, I'm confident we can get pieces, big chunks of the Build Back Better law signed into law. And I'm confident that we can take the case to the American people that the people they should be voting for who are going to oversee whether the elections in fact are legit or not should not be those who are being put up by the Republicans to determine that they're going to be able to change the outcome of the election. So whether or not we can actually get election, and by the way, I haven't given up. We haven't finished the vote yet on what's going on voting rights and the John Lewis bill and others. But so, look, this is. I've been engaged a long time in public policy, and I don't know many things that have been done in one fell swoop. And so I think the most important thing to do is try to inform, not educate, inform the public of what's at stake in stark terms, and let them make judgments and let them know who's for them and who's against them, who's there and who's not there, and make that the case. And that's what I'm going to be spending my time doing in this off-year election.
You mentioned Republicans and reaching out to them. Some Republicans who may be open to major changes on voting rights, for instance, like Mitt Romney, he says he never even received a phone call from this White House. Why not?
I like Mitt. Look, Mitt Romney's a straight guy. One of the things that we're doing, I was trying to make sure we got everybody on the same page in my party on this score. And I didn't call many Republicans at all. The fact is that I do think that Mitt is a serious guy. I think we can get things done. I think I predict to you they'll get something done on the electoral reform side of this. But rather than judge what's going to get done and not get done, all I can say is I'm going to continue to make the case why it's so important to not turn the electoral process over to political persons who are set up deliberately to change the outcome of elections. Allison Harris, please.
Thank you, Mr. President. Speaking of voting rights legislation, if this isn't passed, do you still believe the upcoming election will be fairly conducted and its results will be legitimate?
Well, it all depends on whether or not we're able to make the case to the American people that some of this is being set up to try to alter the outcome of the election. And it's one thing, look, maybe I'm just being too much of an optimist. Remember how we thought not that many people were going to show up to vote in the middle of a pandemic? We had the highest voter turnout in the history of the United States of America. Well, I think if, in fact, no matter how hard they make it for minorities to vote, I think you're going to see them willing to stand in line and defy the attempt to keep them from being able to vote. I think you're going to see the people we're trying to keep from being able to show up, showing up and making the sacrifice that needs to be made in order to change the law back to what it should be. But it's going to be difficult. I make no bones about that. It's going to be difficult. But we're not there yet. We've not run out of options yet, and we'll see how this moves.
And on Omicron and education, teachers are in revolt in so many places. Parents are at odds over closing schools and remote learning. You say we're not going to go back to closing schools. You said that just moments ago, yet they're closing in some areas. What do you say to those teachers and principals and parents about school closings? And what can your administration do to help make up for learning loss for students?
First of all, I'd put in perspective the question you asked. Very few schools are closing. Over 95% are still open. So you all phrase the questions when people, I don't think it's deliberate on your part, but you phrase the question when anyone watches this on television. My God, there must be, all those schools must be closing. What are we going to do? 95% are still open, number one. Number two, the idea that parents don't think it's important for their children to be in school, and teachers know it as well. That's why we made sure that we had the ability to provide the funding through the Recovery Act, through the act that the first act we passed, to be able to make sure schools were able to be safe. So we have new ventilation systems available for them. We have the way they scrub down laboratories and I mean the laboratories kids go to the bathroom, cafeterias, buses, et cetera. All that money's there. There's billions of dollars made available. It's there. Not every school district has used it as well as it should be used, but it's there. And so in addition to that, there is now another $10 billion for testing of students in the schools. So I think as time goes on, it's much more likely you're going to see that number go back up from 95%, back up to 98, 99%. But the outfit, the individuals of the district that says we're not going to be open is always going to get, and I'm not being critical of any of you, it's always going to get front page. It's always going to be the top of the news. But let's put it in perspective. 95, as high as 98% of the schools in America are open, functioning, and capable of doing the job. How about Jen Epstein, Bloomberg?
Mr. President, thank you. Your top foreign policy advisors have warned that Russia is now ready to attack Ukraine, but there's still little unity among European allies about what a package of sanctions against Moscow would look like. If the U.S. and NATO aren't willing to put troops on the line to defend Ukraine and American allies can't agree on a sanctions package, hasn't the U.S. and the West lost nearly all of its leverage over Vladimir Putin? And given how ineffective sanctions have been in deterring Putin in the past, why should the threat of new sanctions give him pause?
Well, because he's never seen sanctions like the ones I promised will be imposed if he moves, number one. Number two, we're in a situation where Vladimir Putin is about to, we've had very frank discussions, Vladimir Putin and I, and the idea that NATO is not going to be united, I don't buy. I've spoken to every major NATO leader. We've had the NATO-Russian summit. We've had the OSCE has met, et cetera. And so I think what you're going to see is that Russia will be held accountable if it invades. And it depends on what it does. It's one thing if it's a minor incursion and then we end up having a fight about what to do and not do, et cetera. But if they actually do what they're capable of doing with the force amassed on the border, it is going to be a disaster for Russia if they further invade Ukraine, and that our allies and partners are ready to impose severe cost and significant harm on Russia and the Russian economy. And, you know, we're going to fortify our NATO allies. I told them on the eastern flank, if in fact he does invade, I've already shipped over $600 million worth of sophisticated equipment, defensive equipment, to the Ukrainians. The cost of going into Ukraine in terms of physical loss of life for the Russians, they'll be able to prevail over time, but it's going to be heavy. It's going to be real. It's going to be consequential. In addition to that, Putin has a stark choice. Either de-escalation or diplomacy, a confrontation of the consequences. And look, I think you're going to see, for example, everybody talks about how Russia has control over the energy supply that Europe absorbs. Well, guess what? That money that they earn from that makes about 45% of their economy. I don't see that as a one-way street. They go ahead and cut it off. It's like my mother used to say, you're biting your nose off to spite your face. It's not like they have all these wonderful choices out there. I spoke with the Prime Minister of Finland, and we're talking about concern on the part of Finland and Sweden about what Russia is doing. The last thing that Russia needs is Finland deciding to change its status. They didn't say they're going to do that, but they're talking about what, in fact, is going on and how outrageous Russia is being. We're finding ourselves in a position where I believe you'll see that there'll be severe economic consequences. For example, anything that involves dollar denominations, if they invade, they're going to pay. Their banks will not be able to deal in dollars. So there's a lot's going to happen. But here's the thing. My conversation with Putin, and we've been, how can we say it? We have no problem understanding one another. He has no problem understanding me, nor me him. And the direct conversations were, I pointed out, I said, you've occupied before other countries, but the price has been extremely high. How long? You can go in and over time, at great loss and economic loss, go in and occupy Ukraine. But how many years? 1, 3, 5, 10? What is that going to take? What toll does that take? It's real. It's consequential. So this is not all just a cakewalk for Russia. Militarily, they have overwhelming superiority as it relates to Ukraine. But they'll pay a stiff price immediately, near term, medium term, and long term if they do it. I'm sorry. Okay. David Sanger, New York Times.
Thank you, Mr. President. I wanted to follow up on your answer there about Russia and Ukraine. When you were in Geneva in June, you said to us about President Putin, I think the last thing he wants now is a Cold War. Now, since then, of course, you've seen him gather these troops, 100,000 troops around Ukraine. Your Secretary of State said today he thought he could invade it at any moment. You've seen the cyber attacks, and you've seen the demand that he have a sphere of influence in which you would withdraw all American troops and nuclear weapons from what used to be the Soviet bloc. So I'm wondering if you still think that the last thing he wants is a Cold War. And has your view of him changed in the past few months?
And if it has, and he does invade, would your posture be to really move back to the kind of containment policy that you saw so often when you were still in the Senate?
The answer is that I think he still does not want any full-blown war, number one. Number two, do I think he'll test the West, test the United States and NATO as significantly as he can? Yes, I think he will. But I think he'll pay a serious and dear price for it that he doesn't think now will cost him what it's going to cost him. And I think he'll regret having done it. Now, whether or not, I think that, how can I say this in a public forum? I think that he is dealing with what I believe he thinks is the most tragic thing that's happened to Mother Russia, in that the Berlin Wall came down, the empire has been lost, the near abroad is gone, etc. The Soviet Union has been split. But think about what he has. He has 8 time zones, a burning tundra that will not freeze again naturally, a situation where he has a lot of oil and gas, but he is trying to find his place in the world between China and the West. And so I'm not so sure that he has David, I'm not so sure he is certain what he's going to do. My guess is he will move in. He has to do something. And by the way, I've indicated to him the 2 things he said to me that he wants guarantees on. One is Ukraine will never be part of NATO. And 2, that NATO or there will not be strategic weapons stationed in Ukraine. Well, we can work out something on the second piece, pretending what he does along the Russian line as well, the Russian border in the European area of Russia. On the first piece, we have a number of treaties internationally and in Europe that suggest that you get to choose who you want to be with. But the likelihood that Ukraine is going to join NATO in the near term is not very likely, based on much more work they have to do in terms of democracy and a few other things going on there, and whether or not the major allies in the West would vote to bring Ukraine in right now. So there's room to work if he wants to do that. But I think, as usual, he's going to, well, I probably shouldn't go any further, but I think it will hurt him badly.
Sounds like you are offering some way out here, some off-ramp, and it sounds like what it is at least an informal assurance that NATO is not going to take in Ukraine anytime in the next few decades. And it sounds like you're saying we would never put nuclear weapons there. He also wants us to move all of our nuclear weapons out of Europe and not have troops rotating through the old Soviet bloc. Do you think there's space for there as well?
No, there's not space for that. We won't permanently station, but the idea we're going to actually increase troop presence in Poland or Romania, et cetera, if in fact he moves. Because we have a sacred obligation in Article 5 to defend those countries. They are part of NATO. We don't have that obligation relative to Ukraine, although we have great concern about what happens in Ukraine. Thank you. Maureen, USA Today.
Thank you, Mr. President. I wanted to follow up on your comment on Build Back Better and also ask you a question about the pandemic. You said that you're confident you can pass big chunks of Build Back Better this year. Does that wording mean that you are thinking about, you're looking at breaking the package up into individual portions? And then on the pandemic, now that the Supreme Court has blocked the vaccination or test rule for larger businesses, are you reconsidering whether to require vaccines for domestic flights as a way to boost vaccination rates?
No, look, first of all, on the last part of the question, the Supreme Court decision, I think, was a mistake, but you still see thousands and thousands of people who work for major corporations having to be tested as a consequence of the decision made by the corporation, not by the standard ISET that is there. I think you'll see that increase, not decrease, number one. What was the first part of your question?
On your comment that you made, that you're confident
Yes.
that major chunks of Build Back
Yes.
Better can pass, are you breaking it up? Does that
Yes,
mean?
it's clear to me that that we're going to have to probably break it up. I think that we can get, and I've been talking to a number of my colleagues on the Hill, I think it's clear that we would be able to get support for the $500+ billion for energy and the environmental issues that are there, number one. Number two, I know that the two people who've opposed, on the Democratic side at least, support a number of the things that are in there. For example, Joe Manchin strongly supports early education, 3 and 4 years of age, strongly supports that. There is strong support for, I think, a number of the way in which to pay for these, pay for this proposal. So I think there is. I'm not going to negotiate against myself as to what should and shouldn't be in it, but I think we can break the package up, get as much as we can now, and come back and fight for the rest later. Ken, Wall Street Journal, Ken Thomas.
Thank you, Mr. President. I wanted to ask you about the economy. As you said earlier, Americans are feeling the squeeze of inflation. Oil prices have been at about a 7-year high recently. How long should Americans expect to face higher prices when they're at the grocery store, when they're at the gas pump? Is this something that they're going to see into the summer, into next fall? And separately, you talk about the importance of the Fed, but isn't that an acknowledgement that you're limited in what you can do? If you're relying on the Fed to make decisions and you're unable to get a Build Back Better proposal through, aren't you simply limited in what you can do to deal with inflation?
Well, look, as you know, Ken, the inflation has everything to do with the supply chain. And I think what you're seeing is that we've been able to make progress on speeding up the access to materials. For example, 1/3 of the increase in cost of living is the cost of automobiles. The reason automobiles have skyrocketed in price is because of the lack of computer chips. So we have the capacity, and we're going to do everything in our power to do it, to become self-reliant on the computer chips that we need in order to be able to produce more automobiles. That's underway. We've already passed, within the context of another bill, money for that in the House of Representatives, before the House of Representatives now. But I think there's a way we can move to, if we can move to get, for example, that one thing done, it can make a big difference in terms of the cost of, the total cost of living. Now, with regard to the whole issue of energy prices, that gets a little more complicated, but you saw what happened when I was able to convince everyone from including China, India, a number of other countries to agree with us to go into their version of their petroleum reserve, to release more into the market. So that brought down the price about 12, 15 cents a gallon, some places more. There's going to be a reckoning along the line here as to whether or not we're going to continue to see oil prices continue to go up in ways that are going up now relative to what impact that's going to have on the producers. And so it's going to be hard. I think that's the place where most middle-class people, working-class people get hit the most. They pull up to a pump and all of a sudden, instead of paying $2.40 a gallon, they're paying $5 a gallon. That's going to be really difficult. But so we're going to continue to work on trying to increase oil supplies that are available. And I think there's ways in which we can be of some value added in terms of the price of gas, natural gas and the like, to take the burden off the European countries that are now totally dependent on Russia. But it's going to be hard. It's going to be very hard. But I think that we have to deal with, for example, like I said, you have a circumstance where people are paying more for a pound of hamburger meat than they ever paid. Well, one of the reasons for that is you don't have that many folks out there that are the ones that are got the big four controlling it all. And so you're going to see more and more, we're going to move on this competition piece to allow more and more smaller operations to come in and be able to engage in providing, buying and providing the access to much cheaper meat than exists now. But it's going to be a haul. Now, and I assume the reason you said if I can't get Build Back Better relates to what those 17 Nobel laureate economists said, that if in fact we could pass it, it would actually lower the impact on inflation, reduce inflation over time, et cetera. So there's a lot we have to do. It's not going to be easy, but I think we can get it done, but it's going to be painful for a lot of people in the meantime. That's why the single best way to take the burden off middle class and working class folks is to pass the Build Back Better piece that are things that they're paying a lot of money for now. If you get to trade off higher gases, you're putting up with higher price of hamburgers and gas versus whether or not you're going to be able to pay for education and or childcare and the like. I think most people would make the trade. Their bottom line would be better in middle class households. But it's going to be hard, and it's going to take a lot of work.
Sir, you mentioned China. Do you think the time has come to begin lifting some of the tariffs on Chinese imports, or is there a need for China to make due on some of its commitments in the Phase 1 agreement? Some business groups would like you to begin lifting up those tariffs on China.
Well, I know that, and that's why my trade rep is working on that right now. The answer is uncertain. It's uncertain. I'd like to be able to be in a position where I could say they're meeting the commitments or more of their commitments and be able to lift some of it, but we're not there yet. Nancy, CBS.
Thank you so much, Mr. President. This afternoon, the Senate Minority Leader, Mitch McConnell, said that the midterm elections are going to be a report card on your progress on inflation, border security, and standing up to Russia. Do you think that that's a fair way to look at it? And if so, how do you think that report card looks right now?
I think report cards can look pretty good if that's where we're at. But look, the idea that Mitch has been very clear. He's going to do anything to prevent Biden from being a success. I get on with Mitch. I actually like Mitch McConnell. We like one another, but he has one straightforward objective. Make sure that there's nothing I do that makes me look good in his mind, with the public at large. And that's okay. I'm a big boy. I've been here before. But the fact is that I think that I'm happy to debate and have a referendum on how I handle the economy, whether or not I've made progress on. Look, again, how can I'm taking too long answering your questions. I apologize. I think that the fundamental question is, what's Mitch for? What's he for on immigration? What's he for? What's he proposing to make anything better? What's he for dealing with Russia? It's different than I'm proposing that many of his Republican friends or his colleagues are supporting as well. What's he for on these things? What are they for? So everything's a choice, a choice. I think look, I've laid out a proposal on immigration that if we passed it, we'd be in a totally different place right now. But we're not there because we don't have a single Republican vote. My buddy John McCain's gone. So, I mean, it's going to take time. And again, I go back to Governor Sununu's quote. How long? I mean, a rhetorical question. I know this is not fair to ask the press a question. I'm not asking you. But think about, did you ever think that one man out of office could intimidate an entire party where they're unwilling to take any vote contrary to what he thinks should be taken for fear of being defeated in a primary. I've had 5 Republican senators talk to me, bump into me, quote unquote, or sit with me, who've told me that they agree with whatever I'm talking about for them to do. But Joe, if I do it, I'm going to defeat it in a primary. We got to break that. It's got to change. And I doubt you're all, it sounds like I'm being solicitous, you're all bright as hell, well-informed, more informed than any group of people in America. But did any of you think that you get to a point where not a single Republican would diverge on a major issue? Not one? Anyway.
Can you tell us who those 5 Republican senators are?
Sure. No, are you kidding me? I maintain confidentiality.
On voting
but I'm
rights,
sure you've spoken to some.
on voting rights, sir,
Yes.
at your first press conference 10 months ago, I asked you if there was anything you could do beyond legislation to protect voting rights. And at that time you said yes, but I'm not going to lay out a strategy before you and the world now. Now that legislation appears to be hopelessly stalled, can you now lay out your strategy to protect voting rights?
Well, I'm not prepared to do that in detail in terms of the executive orders I may be able to engage in and other things I can do. But one of the things we have done, we have significantly beefed up the number of enforcers in the Justice Department who are there to challenge these unconstitutional efforts, in our view, unconstitutional efforts on the part of the Republicans to stack the election and subvert the outcomes. We have begun to organize in ways that we didn't before the communities beyond the civil rights community to make the case to the rest of the American people what's about to happen, what will happen if, in fact, these things move forward. If I had talked to you, not you, I'm using you in an editorial sense, if I had talked to the public about the whole idea of subversion of elections by deciding who the electors are after the fact, I think people would have looked at me like, whoa. I mean, I taught constitutional law for 20 years, a 3-credit course in separation of powers, and on Saturday mornings when I was a senator. And I never thought we'd get into a place where we were talking about being able to actually, what they tried to do this last time out, send different electors to the state legislative bodies to represent who won the election, saying that I didn't win, but Republican candidate won. I doubt whether anybody thought that would ever happen in America in the 21st century, but it's happening. And so I guess what I'm saying is, Nancy, is that I think that there are a number of things we can do, but I also think we will be able to get significant pieces of the legislation, if we don't get it all now, to build to get it so that we get a big chunk of the John Lewis legislation as well as the fair elections process.
Sir, on COVID, if you don't mind, you touted the number of Americans who are now fully vaccinated with 2 shots, but even some of your own medical advisors say that people aren't fully protected unless they have that 3rd shot, a booster. Why hasn't this White House changed the definition of fully vaccinated to include that 3rd booster shot? Is it because the numbers of fully vaccinated Americans would suddenly look a lot less impressive?
No, it's not that at all. It's just this has become clearer and clearer. And every time I speak of it, I say, if you've been vaccinated, get your booster shot. Everybody get the booster shot. It's the optimum protection you can have. You're protected very well with 2 shots. If it's the Pfizer, anyway, you're protected. But you are better protected with the booster shot.
The definition right now.
I'm following what the answer is yes, get the booster shot. It's all part of the same thing. You're better protected. Okay, Alex Alper, Reuters.
Thank you, Mr. President. I wanted to follow up briefly on a question asked by Bloomberg. You said that Russia would be held accountable if it invades, and it depends on what it does. It's one thing if it's a minor incursion. and we end up having to fight about what to do and what not to do. Are you saying that a minor incursion by Russia into Ukrainian territory would not lead to the sanctions that you have threatened, or are you effectively giving Putin permission to make a small incursion into the country?
Good question. That's how it did sound like, didn't it? The most important thing to do, big nations can't bluff, number one. Number two, the idea that we would do anything to split NATO, which would have a profound impact on one of Putin's objectives is to weaken NATO, would be a big mistake. So the question is, if it's something significantly short of a significant invasion, or not even significant, just major military forces coming across. For example, it's one thing to determine that if they continue to use cyber efforts, well, we can respond the same way with cyber. They have FSB people in Ukraine now trying to undermine the solidarity within Ukraine about Russia and to try to promote Russian interest. But it's very important that we keep everyone in NATO on the same page. And that's what I'm spending a lot of time doing. And there are differences. There are differences in NATO as to what countries are willing to do depending on what happens, the degree to which they're able to go. And I want to be clear with you. The serious imposition of sanctions relative to dollar transactions and other things are things that are going to have a negative impact on the United States, as well as a negative impact on the economies of Europe as well, a devastating impact on Russia. And so I got to make sure everybody's on the same page as we move along. I think we will, if there's something where there's Russian forces crossing the border, killing Ukrainian fighters, et cetera. I think that changes everything. But it depends on what he does, is actually what extent we're going to be able to get total unity on the NATO front.
If I may ask a quick one on Iran, I just wanted to get your sense of whether the Vienna talks are making any progress, if you still think it's possible to reach a deal for both sides to resume compliance with the Iran nuclear deal, or if it's time to give up on that. Thank you.
I'll do it in reverse. It's not time to give up. There is some progress being made. The P5+1 is on the same page, but it remains to be seen. Okay, Kristen, NBC.
Very quickly on Russia, I do have a number of domestic policy issues, but on Russia very quickly, it seemed like you said that you have assessed, you feel as though he will move in. Has this administration, have you determined whether President Putin plans to invade or move into Ukraine, as you said?
Look, the only thing I'm confident of is that decision is totally, solely, completely a Putin decision. Nobody else is going to make that decision. No one else is going to impact that decision. He's making that decision. And I suspect it matters which side of the bed he gets up on in the morning as to exactly what he's going to do. And I think it is not irrational, if he wanted to talk about dealing with strategic doctrine and dealing with force structures in Europe and in the European parts of Russia. But I don't know whether he's decided he wants to do that or not. So far, in the 3 meetings we've had, OSCE, and anyway, have not produced anything, because the impression I get from my Secretary of State, my National Security Advisor, and my other senior officials that are doing these meetings is that there's a question of whether the people they're talking to know what he is going to do. So the answer is, but based on a number of criteria as to what he could do. For example, for him to move in and occupy the whole country, particularly from the north, from Belarus, he's going to have to wait a little bit till the ground's frozen so he can cross. To move in a direction where he wants to talk about what's going. We're continuing to provide for defense capacities to the Ukrainians. We're talking about what's going on in both the Baltic and the Black Sea, et cetera. There's a whole range of things that I'm sure he's trying to calculate how quickly he can do what he wants to do and what does he want to do. But he's an informed individual. And I believe he's calculating what the immediate, the short term, and the near term and the long term consequences of Russia will be. And I don't think he's made up his mind yet.
I want to ask you about your domestic agenda. You've gotten a lot of questions about voting rights, Mr. President, but I want to ask you about Black voters, one of your most loyal constituencies.
Yep.
I was in Congressman Clyburn's district yesterday in South Carolina. You opened this news conference talking about him. I spoke to a number of Black voters who fought to get you elected, and now they feel as though you are not fighting hard enough for them and their priorities. And they told me they see this push on voting rights more as a last-minute PR push than it is a legitimate effort to get legislation passed. So what do you say to these Black voters who say that you do not have their backs, as you promised on the campaign trail?
I've had their back. I've had their back my entire career. I've never not had their back. And I started on the voting rights issues long, long ago. That's what got me involved in politics in the first place. And I think part of the problem is, look, there's significant disagreement in every community on whether or not the timing of assertions made by people has been in the most timely way. So I'm sure that there are those who are saying that why didn't Biden push John Lewis bill as hard as he pushed it the last month? Why didn't he push it 6 months ago as hard as he did now? The fact is that there's a timing that is not of one's own choice. It's somewhat dictated by events that are happening in country and around the world as to what the focus is. But part of the problem is, as well, I have not been out in the community nearly enough. I've been here an awful lot. I find myself in a situation where I don't get a chance to look people in the eye because of both COVID and things that are happening in Washington, to be able to go out and do the things that I've always been able to do pretty well. Connect with people, let them take a measure of my sincerity, let them take a measure of who I am. For example, I mean, as I pointed out in South Carolina, last time when I was chairman of the Judiciary Committee, I got the Voting Rights Act extended for 25 years, and I got Strom Thurmond to vote for it. That's what I've been doing my whole career. And so the idea that I didn't either anticipate or because I didn't speak to it as fervently as they want me to earlier. In the meantime, I was spending a lot of time, spent hours and hours and hours talking with my colleagues on the Democratic side, trying to get them to agree that if in fact this occurred, if this push continued, that they would be there for John Lewis. And anyway, so, but I think that's a problem that like every community. I'm sure that there are those in the community, and I'm a big labor guy. I'm sure there's people in labor saying, why haven't I been able to do A, B, C, or D? So it's just going to take a little bit of time.
You put Vice President Harris in charge of voting rights. Are you satisfied with her work on this issue? And can you guarantee, do you commit that she will be your running mate in 2024, provided that you run again?
Yes and yes.
Okay. You don't care to expand?
Pardon me?
Do you care to expand on voting?
No, there's no need to. I mean, I asked the question. She's going to be my running mate, number one. And number two, I did put her in charge. I think she's doing a good job.
Let me ask you Big picture, particularly when you think about voting rights and the struggles you've had to unify your own party around voting rights, unity was one of your key campaign promises. In fact, in your inaugural address, you said your whole soul was in bringing America together, uniting our people. People heard the speech that you gave on voting rights in Georgia recently, in which you described those who are opposed to you to George Wallace and Jefferson Davis, and some people took exception to that. What do you say to those who were offended by your speech? And is this country more unified than it was when you first took office?
Number one, anybody who listened to the speech, I did not say that there were going to be a George Wallace or a Bull Connor. I said we're going to have a decision in history that is going to be marked just like it was then. You either voted on the side that didn't make you George Wallace or didn't make you Bull Connor. But if you did not vote for the Voting Rights Act back then, you were voting with those who agreed with Connor, those who agreed with and I think Mitch did a real good job of making it sound like I was attacking them. If you notice, I haven't attacked anybody publicly, any senator, any congressman publicly. And my disagreements with them have been made to them, communicate to them privately or in person with them. My desire still is, look, I underestimated one very important thing. I never thought that the Republicans, like for example, I said, they got very upset. I said, there are 16 members of the present United States Senate who voted to extend the Voting Rights Act. Now, they got very offended by that. That wasn't an accusation, it was stating a fact. What has changed? What happened? What happened? Why is there not a single Republican? Not one. That's not the Republican Party. So that's not an attack.
Is the country more unified than when you first took office?
The answer is, based on some of the stuff we've got done, I'd say yes, but it's not nearly unified as it should be. Look, I still contend, and I know you'll have a right to judge me by this, I still contend that unless you can reach consensus in a democracy, you cannot sustain the democracy. And so this is a real test, whether or not my counterpart in China is right or not when he says autocracies are the only thing that are going to prevail because democracies take too long to make decisions and countries are too divided. I believe we're going through one of those inflection points in history that occurs every several generations or even more than that, even more time than that, where things are changing almost regardless of any particular policy. The world's changing in big ways. We're going to see, if you heard me say this before, we're going to see more change in the next 10 years than we've seen in the last 50 years because of technology, because of fundamental alterations in alliances that are occurring not because of any one individual, just because of the nature of things. And so I think you're going to see an awful lot of transition. And the question is, can we keep up with it? Can we maintain the democratic institutions that we have, not just here, but around the world, to be able to generate democratic consensus on how to proceed? It's going to be hard. It's going to be hard, but it requires leadership to do it. And I'm not giving up on the prospect of being able to do that. Thank you.
Mr. President. Thank you, sir. There are deep questions among Americans about the competence of government, from the messy rollout of 5G this week to the Afghanistan withdrawal to testing on COVID. What have you done to restore Americans' faith in the competence of government? And are you satisfied by the view of the competence of your government?
Look, let's take Afghanistan. I know you all would like to focus on that, which is legitimate. we were spending $1 trillion a week. $1 billion a week in Afghanistan for 20 years. Raise your hand if you think anyone was going to be able to unify Afghanistan under one single government. It's been the graveyard of empires for a solid reason. It is not susceptible to unity, number one. So the question was, do I continue to spend that much money per week in the state of Afghanistan, knowing that the idea that being able to succeed, other than sending more body bags back home, is highly, highly unusual. My dad used to have an expression. He'd say, son, if everything's equally important to you, nothing's important to you. There is no way to get out of Afghanistan after 20 years easily. Not possible, no matter when you did it. And I make no apologies for what I did. I have a great concern for the women and men who were blown up on the line at the airport by a terrorist attack against them. But the military will acknowledge, and I think you will, who know a lot about foreign policy, that had we stayed and I had not pulled those troops out, we would be asked to put somewhere between 20 and 50,000 more troops back in. Because the only reason more Americans weren't being killed than others is because the last president signed an agreement to get out by May the 1st. And so everything was copacetic. Had we not gotten out, and the acknowledgement is we'd be putting a lot more forces in. Now, do I feel badly what's happening as a consequence of the incompetence of the Taliban? Yes, I do. But I feel badly also about the fistulas that are taking place in Eastern Congo. I feel badly about a whole range of things around the world that we can't solve every problem. And so I don't view that as a competence issue. The issue of whether or not there's competence in terms of whether or not we're dealing with 5G or not, we don't deal with 5G. The fact is that you had two private enterprises, that had one promoting 5G and the other one are airlines. They're private enterprises. They have government regulation, admittedly. And so what I've done is pushed as hard as I can to have 5G folks hold up and abide by what was being requested by the airlines until they could more modernize over the years, so that 5G would not interfere with the potential of the landing. So any 5G tower within a certain number of miles from the airport should not be operative. And so I understand, but anything that happens that's consequential is viewed as the government's responsibility. I get that. Am I satisfied with the way in which we have dealt with COVID and all the things that go along with that? Yeah, I am satisfied. I think we've done remarkably well. You know, the idea that on testing we should have done it quicker, but we've done remarkable since then. What we have more testing going on than anywhere in the world. And we're going to continue to increase that. Did we have it at the moment exactly when we should have moved, and could we have moved a month earlier? Yeah, we could have. But with everything else that's going on, I don't view that as somehow a mark of incompetence. Look, think of what we did on COVID. When we were pushing on AstraZeneca to provide more vaccines. Well, guess what? They didn't have the machinery to be able to do it. So I physically went to Michigan, stood there in a factory with the head of AstraZeneca and said, we'll provide the machinery for you. This is what we'll do. We'll help you do it so that you can produce this vaccine more rapidly. I think that's pretty hands-on stuff. We also said right now, when the hospitalizations are overrunning hospitals and you have docs and nurses out because of COVID, they have COVID. We put thousands of people back in those hospitals. Look at all the military personnel we have there, first responders. Nobody has ever organized. Nobody has ever organized a strategic operation to get as many shots in arms by opening clinics and being able to get so many people vaccinated. What I'm doing now is not just getting significant amounts of vaccines to the rest of the world, but they now need the mechanical way is how they get shots in arms. So we're providing them to know how to do that. Now, should everybody in America know that? No, I don't necessarily know that. They're just trying to figure out how to put 3 squares on the table and stay safe. But so I do think the place where I was a little disappointed, I wish we could have written it differently, is when we did the legislation to provide the funding for COVID and the money we provided for the states to be able to deal with keeping schools open. Some of them didn't do a very good job. Some are still holding the money. I don't have the authority to do anything about that. I think that's not particularly competent. There's things that could and should have been done. They could have moved faster. So I understand the frustration. You know, I remember, I think it was, I forget which cabinet member saying to Barack Obama where something was going on. And he said, well, you're going to be sure, Mr. President, of the millions of employees you have out there, somebody's screwing up right now. Somebody's screwing up. So, you know, it's just but I think you have to look at things that we used to look at it on balance. What is the trajectory of the country? Is it moving in the right direction now? I don't know how we can say it's not. I understand the overwhelming frustration, fear, and concern with regard to inflation and COVID. I get it. But the idea, if I told you when we started, I tell you what I'm going to do, first year I'm going to create over 6 million jobs. I'm going to get unemployment down to 3.9%. I'm going to generate, and I named it all. You'd look at me like you're nuts. Maybe I'm wrong.
President, at least in our recent memory, with as much Washington experience as you entered this office with, but yet after we sit here for more than an hour, I'm not sure I've heard you say if you would do anything differently in the second year of your term. Do you plan to do anything differently?
Yeah, look, the thing I have to do...
Are you satisfied with your team here at the White House, sir?
I'm satisfied with the team. There's 3 things I'm going to do differently now that I've gotten the critical crises out of the way in the sense of that knowing exactly where we're going. Number 1, I'm going to get out of this place more often. I'm going to go out and talk to the public. I'm going to do public fora. I'm going to interface with them. I'm going to make the case as what we've already done, why it's important, and what we'll do what will happen if they support what else I want to do. Number 2, I'm bringing in more and more now that I have time. I mean, literally, like you, I'm not complaining. It's, 12, 14 hours a day, no complaints. I really mean that sincerely. But now that certain of the big chunks have been put in place and we know the direction, I'm also going to be out there seeking more advice of experts outside, from academia to editorial writers to think tanks, and I'm bringing them in, just like I did early on, bringing in presidential historians to get their perspective on what we should be doing, seeking more input, more information, more constructive criticism about what I should and shouldn't be doing. And the third thing that I'm going to be doing a lot more of is being in a situation where I'm able to I'm going to be deeply involved in these off-year elections. We're going to be raising a lot of money. We're going to be out there making sure that we're helping all of those candidates, and scores of them have already asked me to come in and campaign with them, to go out and make the case in plain, simple language as to what it is we've done, what we want to do, and why we think it's important. How many more hours am I doing this? I'm happy to stick around. You always ask me the nicest questions. I know you do.
All right.
None of them make a lot of sense to me, but
well, let's try.
Fire away. Come on.
A new year. Why are you trying so hard in your first year to pull the country so far to the left?
Well, I'm not. I don't know what you consider to be too far to the left. If in fact we're talking about making sure that we had the money for COVID, making sure we had the money to put together the bipartisan infrastructure, making sure we were able to provide for those things that in fact would significantly reduce the burden on working class people, but make them, they have to continue to work hard. I don't know how that is pulling it to the left. If you may recall, you guys have been trying to convince me that I am Bernie Sanders. I'm not. I like him, but I'm not Bernie Sanders. I'm not a socialist. I'm a mainstream Democrat, and I have been. And mainstream Democrats have overwhelmed. If you notice, the 48 of the 50 Democrats supported me in the Senate on virtually everything I've asked. Yes, sir.
I wanted to clarify. A moment ago, you were asked whether or not you believed that we would have free and fair elections in 2022 if some of these state legislatures reformed their voting protocols. You said that it depends. Do you think that they would in any way be illegitimate?
Oh yeah, I think it easily could be illegitimate. Imagine if in fact Trump has succeeded in convincing Pence to not count the votes. Imagine if.
In regards to 2022, sir, the midterm
2022. I mean, imagine if those attempts to say that the count was not legit. You have to recount it, and we're not going to count. We're going to discard the following votes. I mean, sure. I'm not saying it's going to be legit. It's the increase in the prospect of being illegitimate is in direct proportion to us not being able to get these reforms passed. But I don't think you're not going to see me, and I don't think you're going to see the Democratic Party give up on coming back at assuming that the attempt fails today.
And then one more, sir. You campaigned and you ran on a return to civility. And I know that you dispute the characterization that you called folks who would oppose those voting bills as being Bull Connor or George Wallace. But you said that they would be sort of in the same camp.
No, I didn't say that. Look what I said. Go back and read what I said and tell me if you think I called anyone who voted on the side of the position taken by Bull Connor that they were Bull Connor. And that is an interesting reading of English. I assume you got into journalism because you like to write.
So did you expect that would work with Senators Manchin or Sinema?
No, here's the thing. There's certain things that are so consequential. You have to speak from your heart as well as your head. I was speaking out forcefully on what I think to be at stake. That's what it is. And by the way, no one forgets who was on the side of King or Bull Connor. No one not done that. The history books will note it. And when I was making the case, don't think this is a freebie. You don't get to vote this way and then somehow it goes away. This will stick with you the rest of your career and long after you're gone.
And Mr. President,
folks.
One more on Ukraine, please, sir.
Okay. Whoa. Hang on, guys. We've only gone an hour and 20 minutes. I'll keep going. But I'm going to go. Let me get something straight here. How long are you guys ready to go? You want to go for another hour or two? Okay. I'm going to go. I tell you what, folks. I'm going to go another 20 minutes till 1:15. Okay? Yes, sir.
Thank you. I'll wait for the microphone. President Biden, on the...
I want to thank my communications staff for the great help here.
Well, President Biden, on the coronavirus, we're tragically approaching nearly 1 million Americans who died. And I'd like to ask you why it is during your 3.5-hour virtual summit in November with the Chinese president, you didn't press for transparency. and also whether that has anything to do with your son's involvement in an investment firm controlled by Chinese state-owned entities.
The answer is that I did raise the question of transparency. I spent a lot of time with him, and the fact is that they're just not being transparent.
Transparency on the coronavirus origins.
Yes.
And you did during the virtual summit. Is there a reason your press staff was unaware of that? And what did you say to the Chinese president?
And they weren't with me the entire time. Look, I made it clear that I thought that China had an obligation to be more forthcoming on exactly what the source of the virus was and where it came from. Yes.
Mr. President, I would like to ask you about foreign policy. One of the first priority that you declared when you came to office was to end the war in Yemen, the catastrophic war in Yemen. You appointed a special envoy. Today, one of your allies, United Arab Emirates, is asking your administration to put back the Houthi rebels or militias back on the terror list. Are you going to do that? And how are you going to end the war in Yemen, sir?
The answer is it's under consideration, and ending a war in Yemen takes the two parties to be involved to do it, and it's going to be very difficult. Yes.
Thank you very much for this honor. James Rosen with Newsmax. I'd like to raise a delicate subject, but with utmost respect for your life accomplishments and the high office you hold. A poll released this morning by Politico Morning Consult found 49% of registered voters disagreeing with the statement, Joe Biden is mentally fit. Wow. Not even a majority of Democrats who responded strongly affirmed that statement.
Well, I'll let you all make the judgment whether they're correct.
Well, so the question I have for you, sir, if you'd let me finish, is why do you suppose such large segments of the American electorate have come to harbor such profound concerns about your cognitive fitness? Thank you.
I have no idea. Yes, sir.
Thanks, Mr. President. I appreciate it. I wanted to sort of address or ask about a tension that's sort of been in this press conference on unifying the country, because you campaigned on two things. One of them is being able to accomplish big things, and the other is the ability to unify the country. And even today, you've talked about sort of a different posture with Republicans. And I wonder if you still think it's possible to do both of those things.
We have to. We have to. And I mean, I'm not, as long as I hold public office, I'm going to continue to attempt to do both things.
One more follow-up. Around this time last year when you were campaigning in Georgia, I think one of the things you told people was the power is literally in your hands. You know, if voters give Democrats the House and the Senate and the presidency, that all these big things can get accomplished. And, you know, we've seen stalemate, we've seen things being stymied. Why should folks believe you this time around?
Can you think of any other president's done as much in 1 year? Name one for me.
I'm asking you.
I'm serious. You guys talk about how nothing's happened. I don't think there's been much on any incoming president's plate that's been a bigger menu than the plate I had given to me. I'm not complaining. Knew that running in. And the fact of the matter is we got an awful lot done. An awful lot done. And there's more to get done. But look, let me ask a rhetorical question. No, I won't. Anyway. Okay. Thank you. Yes. Be careful. Don't get hurt, man.
No, I'm going to take care. Mr. President, thank you. Sebastian Smith from AFP. Another question on Ukraine. Ukraine borders 4 NATO member countries. How concerned are you concerned that a real conflagration in Ukraine, if the Russians really go in there, that it could suck in NATO countries that are on the border and you end up with an actual NATO-Russia confrontation of some kind? And secondly, are you entertaining the thought of a summit with Vladimir Putin as a way to perhaps try and put this whole thing to bed, address their concerns, and negotiate a way out of this?
The last question, yes. When we talked about whether or not we'd pick the 3 meetings we talked about, and we talked about we would go from there if there was reason to go to a summit. We talked about a summit as being before the Ukraine item came up in terms of strategic doctrine and what the strategic relationship would be. So I still think that is a possibility, number one. Number two, I am very concerned. I'm very concerned that this could end up being, look, the only war that's worse than one that's intended is one that's unintended. And what I'm concerned about is this could get out of hand, very easily get out of hand because of what you said, the borders of Ukraine and what Russia may or may not do. I am hoping that Vladimir Putin understands that he is short of a full-blown nuclear war. He's not in a very good position to dominate the world. And so I don't think he thinks that. But it is a concern. And that's why we have to be very careful about how we move forward and make it clear to him that there are prices to pay that could, in fact, cost his country an awful lot. But of course you have to be concerned when you have, nuclear power invaded. If he invades, it hasn't happened since World War II. This is the most consequential thing that's happened in the world in terms of war and peace since World War II. Yes.
Nearly 2 years have passed since the beginning of the global coronavirus outbreak, and you again today acknowledge that Americans are frustrated and they're tired. Based on your conversations with your health advisors, what type of restrictions do you imagine being on Americans this time next year, and what does the new normal look like for social gatherings and travel to you?
Well, the answer is, I hope the new normal will be that we don't still have 30-some million people not vaccinated. I hope the new normal is people have seen what their own interest is and have taken advantage of what we have available to us. Number two, with the pill that is a problem that appears to be as efficacious as it seems to be, that you're going to be able to deal with this virus in a way that after the fact you have an ability to make sure you don't get very sick. Number three, I would hope that what happens is the rest of the world does what I'm doing and provides significant amounts of the vaccine to the rest of the world, because it's not sufficient that we just have this country not have the virus or be able to control the virus, but that we can't build a wall high enough to keep a new variant out. So it requires one of the things that I want to do, and we're contemplating figuring out how to do, we are contemplating how to get done, and that is how do we move in a direction where the world itself is vaccinated. It's not enough just to vaccinate 340 million, fully vaccinate 340 million people in the United States. That's not enough. It's not enough to do it here. We have to do it, and we have to do a lot more than we're doing now, and that's why we have continued to keep the commitment of providing vaccines and available cures for the rest of the world as well.
And if I could, sir, and I should have said this before, Francesca Chambers McClatchy, how do you plan to win back moderates and independents who cast a ballot for you in 2020, but polls indicate aren't happy with the way you're doing your job now?
I don't believe the polls. Well, why don't you just go down the road there?
Thank you, Mr. President. To follow up on some of the questions about the vaccination program, you've given dozens of speeches this year urging Americans to get vaccinated. You've talked to reluctant Republicans. You've said it's people's patriotic duty. There have been very few mentions of the fact that young children under the age of 5, still in the third year of this pandemic in this country, don't have access to the vaccine. Can you speak to frustrated parents a little bit about why that continues to be the case and when that might change?
Because the science hasn't reached the point where they're convinced that, in fact, it is safe. So that's what they're doing now. You could have asked me that. I got asked that question about 3 months ago about people between the ages of 7 and 12. Well, they've got to the point where they felt secure in the number of tests they had done and the tests they had run, that it was safe. So it will come. It will come. But I'm not a scientist. I can't tell you when, but it is really very important that we get down to that next piece.
One more follow-up on Build Back Better. When you said it's going to likely be broken up into chunks, you mentioned that the climate pieces seem to have broad support. You mentioned that Senator Manchin is a supporter of early child care. You left out the child tax credit, and I wonder if it's fair to read between the lines and assume that that is a piece, given Senator Manchin's opposition to it, that the extension of that is likely one of those components that may have to wait until sometime down the line.
There's two really big components that I feel strongly about that I'm not sure I can get in the package. One is the child care tax credit, and the other is help for cost of community colleges. They are massive things that I've run on, I care a great deal about, and I'm going to keep coming back at whatever floor I get to be able to try to get chunks or all of that done. Yes, sir. Next man next to your left.
Thank you, Mr. President. My name is Pedro Rojas. I'm with Univision National News. This is actually my first press conference here. It's good to meet you in person.
We always have long press conferences.
Awesome. Awesome. I got a couple of questions for you. Number one, you said that you want to convey your message by getting out there in the country. I wonder if you're planning on traveling also to South America and other countries in the Western Hemisphere, given the fact that China has gained a lot of influence in the region. And the second question is, what will be your message for residents in this country that are struggling every time they go to the gas station, every time they go to the grocery store and see the prices going high, and the pharmacy? I happen to come from South Texas, where I saw a lot of people struggling financially in the last few months, and so I wonder what is the message you want to spread to them?
Well, I try to express, I've tried to answer that 7 different ways today about how to deal with inflation. But let me answer the first question. I spent a lot of time in South America and in Latin America. When I was vice president, I spent the bulk of my 8 years basically in Europe and/or in Latin America. I'm in contact with the leaders of the countries in South America. We're working closely with making sure that we do everything, for example, with to deal with helping the countries in question, particularly those in Central America, to be able to help them with their ability to deal with the people don't sit around in Guatemala and say, I got a great idea. Let's sell everything we have, give the money to a coyote, take us across a terribly dangerous trip up through Central America and up through Mexico and sneak us across the border, drop us in the desert. Won't that be fun? People leave because they have real problems. And one of the things I've done when I was a vice president, got support with, although I don't have much Republican support anymore, is provide billions of dollars to be able to say to those countries, why are people leaving? And how are you going to reform your own system? And that's we've worked on a long time. It still needs a lot more work, and we're focusing on that. I also believe I've spent a lot of time talking about and dealing with policy having to do with Maduro, who is a little more than a dictator right now, and the same thing in Chile and not the same thing, but with Chile as well as Argentina. So look, I made a speech a while ago when I was vice president, saying that if we were smart, we have an opportunity to make the Western Hemisphere a democratic hemisphere. And we were moving in the right direction under the last administration, the Obama-Biden administration. But so much damage was done as a consequence of the foreign policy decisions the last president made in Latin America, Central America, and South America, that we now have, when I call for a summit of the democracies, I call that, and a number of nations showed up for this summit of democracy. What is it that's going to allow us to generate? We've actually had a reduction in the number of democracies in the world. And it seems to me there's nothing more important. We used to talk about when I was a kid in college about America's backyard. It's not America's backyard. Everything south of the Mexican border is America's front yard. And we're equal people. We don't dictate what happens in any other part of this continent or the South American continent. We have to work very hard on it. But the trouble is we're having great difficulty making up for the mistakes that have been made the last 4 years, and it's going to take some time. Yes, gentleman in the back. And then I'll go to this side, okay?
Thank you, Mr. President. Alexander Nazarian, Yahoo News. And thank you for holding this press conference. I hope there's more of them.
Anytime you have extra 3 hours, we can do it.
We'll stay for a couple more. You said you were surprised by Republican obstruction of your agenda, but didn't the GOP take exactly the same tactic when you were vice president to Barack Obama? So why did you think they would treat you any differently than they treated him?
Well, first of all, they weren't nearly as obstructionist as they are now, number one. They stated that, but you had a number of Republicans we worked with closely. From John McCain, a number of Republicans we worked closely with. Even back in those days, Lindsey Graham. And so the difference here is there seems to be a desire to work with them. And I didn't say my agenda, I'm saying what are they for? What is their agenda? They had an agenda back in the administration when the 8 years we were president and vice president. But I don't know what their agenda is now. What is it? The American public is outraged about the tax structure we have in America. What are they proposing to do about it? Anything? Have you heard anything? Anything. I haven't heard anything. The American public is outraged about the fact that we're the state of the environment, the vast majority of the public. What have they done to do anything to ameliorate the climate change that's occurring other than to deny it exists? So what I'm saying is the difference between then and now is not only the announcement that was made, anything to stop Barack Obama. I get that part. But what eventually happened, we were able to get some things done. We were able to work through some things. On the stuff that was really consequential in terms of ideologically divisive, it was a real fight. But I don't think there's a time when I wonder what would be the Republican platform right now? What do you think? What do you think their position on taxes are? What do you think their position on human rights is? What do you think their position is on whether or not we should do about the cost of prescription drugs? What do you think? I honest to God don't know what they're for, yet I know a lot of these senators and congressmen, and I know they do have things they want to support, whether they're things I want or not. But you don't hear much about that. And every once in a while, when you hear something where there's a consensus, it's important but a small item, and it doesn't get much coverage at all where it occurs. I'm not mean coverage. There's not much discussion about it. So I just think it's a different, and I don't know that no matter how strongly one supports, as a Republican and/or supports the former president of the United States, I don't know how we can't look at what happened on January 6th and think that's a problem. That's a real problem.
One more question, Mr. President.
By the way, it's a quarter of, guys, so I'm going to do this. If you answer me easy questions, I'll give you quick answers.
There's an increasing concern, I think, among some Democrats that even if schools do continue to open, and I get that most of them are now open, Republicans will weaponize this narrative of you and other leading Democrats, allowing them to stay closed in the midterms next year. Obviously that issue has a lot of traction with suburban parents, as I think
we saw in Virginia. I'm confused by the question. I'm sorry.
Well, could school reopenings or closures become a potent midterm issue for Republicans to win back the suburbs?
Oh, I think it could be, but I hope in God that look, maybe I'm kidding myself, But as time goes on, the voter who is just trying to figure out, as I said, how to take care of their family, put 3 squares on the table, stay safe, be able to pay their mortgage or their rent, et cetera, is becoming much more informed on the motives of some of the political players and some of the political parties. And I think that they are not going to be as susceptible to believing some of the outlandish things that have been said and continue to be said. You know, every president, not necessarily in the first 12 months, but every president the first couple of years, every president, of the last presidents, at least 4 of them, have had polling numbers that are 44% favorable. So it's this idea that, but you all, not you all, but now it is, well, Biden's at, one poll showed him at 33%. The average is 44, 45%. One poll him at 49%. I mean, the idea that the American public are trying to sift their way through what's real and what's fake. And I don't think I've never seen a time when the political coverage, the choice of what political coverage the voter looks to has as much impact on as what they believe. They go to get reinforced in their views, whether it's MSNBC or whether it's Fox or whatever. I mean, and one of the things I find fascinating that's happening, and you all are dealing with it every day, and it will impact on how things move, is that a lot of the speculation in the polling data shows that the cables are heading south. They're losing viewership. No? Well, Fox is okay for a while, but it's not gaining. And a lot of the rest are predicted to be not very much in the mix in the next 4 to 5 years. I don't know whether that's true or not. But I do know that we have sort of put themselves in certain alleys. And they've decided that, you know, how many people who watch MSNBC also watch Fox, other than they're a politician trying to find out what's going on in both places? How many people, again, I'm no expert in any of this, but the fact is, I think you have to acknowledge that what gets covered now is necessarily a little bit different than what gets covered in the past. I've had a couple, well, I shouldn't get into this, but the nature of the way things get covered has, in my observation over the years I've been involved in public life, changed. And it's changed because of everything from a thing called the internet. It's changed because of the way in which we have self-identified perspectives based on what channel you turn on, what network you look at, not network, what cable you look at. And it's never quite been like that. Anyway.
On behalf of the Correspondents Association, thank you very much for standing for our questions. We hope the public has found it as enlightening as those of us in the room have. I want to ask you, sir, about one of the overriding...
I mean, I can still stand. It's amazing.
We appreciate it. We very much do. So the question I want to ask you gets to accountability, sir, on one of the top public concerns, of course, which is the coronavirus and the government's response to it, whether it's confusion over what style of mask to wear, when to test, how to test, where to test. The public is confused, sir, and you see that in the drop-off in the polling on this question. Why did you tell Jeff that you were satisfied with your team? Why are you not willing to make or interested in making any changes, either at the CDC or other agencies, given the fact that the messages have been so confusing?
Well, first of all, the messages, to the extent they've been confusing, is because the scientists, they're learning more. They're learning more about what's needed and what's not needed. And so the fact is that the one piece that has gotten a lot of attention is the communications capacity of the CDC. Well, she came along and said, look, I'm a scientist and I'm learning. I'm learning how to deal with stating what is the case that we've observed. But look, I think that it's a little bit like saying when we went through the whole issue of how to deal with polio and the polio shots. What was said in the beginning was, oh no, it's changed a little bit. We moved this way or that way. Or when we dealt with anything else. I mean, this was a brand new virus, a brand new phenomenon. Some of it was deadly, other was more communicable. This is an unfolding story. It's the nature of the way diseases spread. We're going to learn about it in a lot of other areas, not just COVID-19. And so I think, I look at it this way. Think about how astounding it was within the time frame that it took to be able to come up with a vaccine. You used to write about that. Pretty amazing how rapidly they came up with a vaccine that saved hundreds of thousands of lives. Did everything get right? No. And by the way, the idea whether anyway, I'm talking too much.
Thank you, Mr.
Yes,
President.
ma'am.
I have two really simple questions, I promise. You campaigned on canceling $10,000 in student loans. Do you still plan to do so, and when? And then my second question is, now that you've clarified the Bull Connor comments, do you plan to reach out to Republicans like Mitt Romney to talk about reforming the Electoral Count Act?
Yes, I'm happy to speak out. I've met with I've talked to Mitt on other occasions, and by the way, I reached out to the minority leader as well at the time that he made his speech. And so I have no reluctance to reach out to any Republican and anyone and I've made it clear. Look, I've now had the opportunity to travel because of funerals and eulogies I've made and attended, and congressmen and senators have come along with me. Don't hold me to the number, but somewhere between 20 and 25 senators and congresspersons have traveled with me. And I find you should get the list of them and ask how I said for the 2, 3, 4, 5 hours that we've flown together, sit back in that conference table and talk to them. Ask them questions. They ask me questions. I learn a heck of a lot. But as president, you don't quite have that ability to do that as often as I'd like to be able to do it. And one of the things that I do think that has been made clear to me, speaking of polling, is the public doesn't want me to be the president's senator. They want me to be the president and let senators be senators. And so if I've made many mistakes, I'm sure. If I've made a mistake, I'm used to negotiating to get things done, and I've been, in the past, relatively successful at it in the United States Senate, even as vice president. But I think that role as president is a different role. Folks, it is now almost 6. With all due respect, I'm going to see you next conference, okay? Thank you.
Thank you, Mr. President.